continuing with our conversation series, special conversation series for this Diwali. I have another market veteran of many years, Nilesh Shah from Kotak AMC. Nilesh, thank you so much for joining us this morning.
Thank you for having me over here.
Absolutely a delight. So Nilesh, first of all, I wanted to start with investor experience this year, because when you look at the indices, it has a very mixed picture. The frontline index, Nifty, has given you about 6-7% return, nothing to talk home about, on par, perhaps a little lower than debt returns this year. And the mid caps have given you more than 25-26%, small caps even better, 30-32%. And the money has come into mid caps and small caps, at least in the latter part of this year. So when you go to conferences, distributors, address investors, what is the feeling you get in terms of, investor experience? Is it happy experiences? Are they compelled to invest more? Or because of the performance of the money that came into mutual funds last year, and perhaps large cap funds have not done so well, is it an unhappy experience? What is the pulse?
So Mahalakshmi, now we get a complete range of experience. Yesterday I was at a function and suddenly a fund manager from a very, very reputed FPI asked me, "Are you Nilesh?" I said, "Yes." He said, "You told my parents 3 decades ago about mutual fund. And even today, every time you come on television, they send me a message that if we had followed Nilesh, we would have been much richer."
Right.
Now, this kind of experiences, I am sure all fund managers are getting from really old investors. Correct. Who have seen that these people have given us the right advice. On the other spectrum, not now, but I do remember in 2000 when our technology funds had crashed, and I was a fixed income fund manager then, but I had seen the pain of my equity fund management guys.
Yeah.
There were, posters of fund managers being put up in public places that these people destroyed wealth.
Yeah.
They should be prosecuted. So this is a big journey where dissatisfied investors have been converted to happy investors. And we are one of that rare industry where investor, distributor and manufacturer, their interests are aligned. You have new pension scheme where margins are very poor for manufacturer and distributor.
Yeah.
Hence it requires tax concessions. Hence it requires committed allocation from government employees. On the other side, you have insurance industry where, manufacturer and distributors probably have a little bit better terms than investor. Mutual fund is the perfect alignment. So we are bound to have happy investors over a period of time. Of course, there will be some dissatisfied investors because they would have traded on mutual funds rather than invested in mutual funds. They'll be more short-term in nature rather than long-term.
And what does this mean? It is fairly clear that this SIP campaign from the mutual fund side has really worked wonders, right? People have also had good experiences, like you're talking about. People who have stayed invested and continued with their SIPs over the last 10 years, 20 years, 30 years have benefited hugely, and they have experienced that effect and power of compounding. So that money continues, but there is always discretionary money that is fungible, money that comes from HNIs, which perhaps now goes also into PMSAF, but a portion of that also comes into mutual funds. What is the mood like amongst those investors, FIIs, corporates, who also look at equities?
So we are seeing, again, like India is so heterogeneous that whatever you say opposite is also true. So I have said no wise investors who believe mutual funds they can trade, and we have to tell them that no, mutual fund is for long-term investment. I have seen people who stopped their SIP in March 20 because returns had turned negative.
Right.
I have seen investors who topped up their SIP because returns have turned negative. Completely two opposite spectrum.
Right.
I have seen investors who have invested only based on past performance and feeling disappointed. I have seen investors who have actually encouraged us during the underperformance, saying that here is now my money because I believe portfolios will do well. So we are becoming a matured market. If we see from March 20 till today and divide the market in two parts, by and large in bottom half it is SIP plus subscription, by and large. And suddenly fund managers get 15, 20, 25,000 crore to invest. In the top half, by and large it is SIP minus redemption. Suddenly we'll invest only 5,000, 7,000, 8,000 crore.
Correct.
The maturity of investors has improved tremendously. And I keep on praying that this financial awareness keep on spreading. Today, 5 or 6 out of 10 parents will advise their kids who are starting their career that beta, beti, ek SIP kar dena, that's the best thing you can do.
Right. And I know the new full form of SIP now. And you can say, you should say it.
So, someone told me that SIP is Sab Ichha Ki Purti. SIP.
Absolutely. Truly, it can be the new, the next campaign for the mutual fund industry.
In my opinion, Mahalakshmi, we started SIP 40 years late. Look at how American household got financial security through 401k plan.
Yeah.
We ran our pension fund not allowing them to invest in equity. Globally, people invest, global pension funds invested in India and made money for their customers.
Yeah.
And our pension funds, our provident funds were not investing in equity.
Yeah.
Individually, SIP is 401k equivalent for the local investors.
Correct, correct. So, looking at the way the markets are right now, the incremental money, what would be your advice? Should it be put into equities? Should it be put into debt? I'm not talking about, savers who saving out of their salary depending on their age and, goals in life, etc. will have to definitely commit certain amount to equity mutual funds. But that apart, the tactical money that is there, where do you think it should go?
So we are at a market where long term there is consensus. I think our critics are also accepting that yes, you are on the move and you will grow.
Right.
Now consensus can sometimes be misleading, but in this case I think consensus will prevail. If you look at market, large caps are at around historical average valuation, mid caps are at little premium to historical average valuation, and small caps are at about 20% premium to historical average valuation. The earnings growth in small and mid cap will outpace large cap, but certainty of large cap earnings growth is far higher. So my recommendation is that this is time where you be marginally overweight large cap, equal weight mid cap, and marginally underweight small cap. My recommendation will be again to avoid all those stocks where floating stock is limited and valuations are high. There are many counters where floating stock has gone into the hands, in the few hands.
Yeah.
And that's why valuations are crazy.
Right.
Please book profit on crazy valuations and come back into reasonable valuations. Over next 12-18 months, I think that trade will play out.
Sure. So this cap thing, we will talk. I want to talk a little more on that. But before that, between equities and debt, because debt today is at 8%. I mean, if you go to a fixed deposit, it's 8%. So your return expectation from a 1 to 3 year perspective in equities, does it compare favorably with when you compare it with debt?
So one again policy, Mahalakshmi, 8% or 7.5% is only for 1 year.
Right.
Moment you go to 3 year and 5 year, the curve starts dropping. It's only in bond market where curve is flat. It is not dropping like bank deposits. So if you're really looking to lock into fixed income, you'll have to look at target maturity funds or dynamic bond funds kind of funds where duration can be extended without compromising coupon. In bank deposits, duration, moment you extend, coupons will start coming down. My feeling is that as of today, markets are at fair value, so your equity allocation should be according to your risk profile and investment objective.
Okay.
And rest of the money you can put it into debt.
Sure. And as far as rates are concerned, do you think this is the peak? Are we headed for lower interest rates from here on?
So my feeling is yes. The Fed has been indicating higher for longer because they are fighting for credibility.
Right.
And after losing part of that credibility in early 21, they have regained it quite nicely. They have maintained inflation and growth in equilibrium. But challenges for central banks are mounting. US debt is expanding at a fast pace. Treasury has to, fund those deficits.
Correct.
And hence interest rates will remain higher. But higher interest rates will mean more insolvency.
Yeah.
Higher interest rates will mean more pressure on banking balance sheet as
Right.
they have taken the hit of
Yes.
rising mortgage rates. My feeling is that US at some point of time will be looking to cut rates, and that will create a roadmap for Indian rates to come down. Our growth and inflation is in equilibrium. RBI has luxury of time to wait and watch what global central bankers do, and thereafter they can move. So my feeling is that we have reached peak of rates for this cycle,
Right.
and somewhere towards mid-24 we will see rate cutting cycle.
Sure. And when do you see FIIs decisively turning positive on Indian markets? I mean, is it a question of valuations? Is it just a question of, the environment and interest rates and where dollar is headed? What do you think will trigger sustained buying again?
So again, when we see FPIs, there's now no longer one homogeneous community. There are hedge funds, there are momentum traders, there are India dedicated funds, there are global emerging markets funds, there are global funds, and so on and so forth. But if we have to take a broad call, I think declining interest rates globally will release flows towards emerging market. So that's point number one. Second, our own benchmark weight in emerging market indices.
Yeah.
HDFC Bank has been included at 50% weight.
Correct.
There's no precedence for that. There's no rationale behind it.
Right.
Someday agencies can correct it. Second, Korea has banned short selling in their market. Now, some people feel that their movement to developed market may get restricted because of that. But my feeling is that how can you include Korea in emerging market? It's already developed world. Someday agencies will see it. So if Korea gets upgraded, if HDFC banks get entered at full weight, then we will see increase in India's weight and hence increase in flows.
Right.
The third thing will be related to our own performance. As long as we deliver on 3G of growth, governance and green, that means my earnings growths are better than my peer group over a period of time. My governance standards respect capital which is coming in, and I am doing a green transformation of my economy without putting pressure on environment.
Right.
These three things put together, every FPI will be buyer of India.
Sure. Going back to the point you made on large versus mid versus small cap, one way to explain why large caps have not performed and mid cap, small caps has performed is surely looking at, just purely looking at the fund flows, right? Obviously, all the selling has come from the FPIs and all the buying has come from domestic investors, and all the money into mutual funds has also come through, mid cap funds or small cap funds particularly. So there is buying here, there is selling there, so that explains it. Now, for this to really change, will it be the trigger for that will be sustained flows from FPIs? Is that a necessary condition for reversal of this trade?
So,
or can there be circulation within the domestic institutions and the mood of the market and the mood of the retail investors, the way products are sold to retail investors that can, decisively change the trajectory of flows?
my hope will be that let there be recirculation among domestic investors. Please don't invest looking at the past, you have to look at the valuations. Fund flows and sentiments can drive prices for a while, but eventually fundamentals need to back it. And time and again we have seen that when stocks run up ahead of fundamentals, eventually they correct. So if the retail flows itself changes, if small cap and micro cap and mini cap prices stabilize for a while so that earnings can catch up with them. So we need not have price correction, even time correction is good enough. I hope rebalancing happens with domestic flows, and when FPIs come to buy, they buy at 20-30% higher prices from us than what they have sold.
Right. So, do you see that happening? Because, retail frenzy always is such that people just go by near-term performance and say, boss, we have to be here. How hard is that to correct? Do you see that happening on ground?
So, one retail investor is right now like Glenn Maxwell. They are hitting the balls for 4 and 6. There was a time when markets used to correct. We will go out in public to our partners, our investors, saying that don't worry, this thing happens, long term looks good, blah blah blah. Now they call up saying that markets have corrected, we are putting money, ab ghabrana mat, go and buy out FPIs.
Right.
The maturity of retail investors is truly unbelievable. Earlier the questions will come about all kinds of things. Now you have to go fully prepared because they can ask you really tough questions, how AI is changing world, and many of them are better read than you, so you can't do bullshit with them. I think the maturity of retail investors at the core is truly remarkable. Yes, there will be some people who are no-wise and who will learn from experience, but by and large I will say Mahalakshmi Indian markets have matured. They will know when to take a U-turn. They will know when to do the rebalancing.
So, you see domestic money also flowing into large caps, and this whole trend of money flowing only into small caps will reverse this year?
I will say that money will continue to come in small cap, but more money will move towards larger cap.
Sure.
But this is part hope also. It's a part hope, part prayer and part maturity of investors.
Correct. And if it does continue to come into small caps, of course, a lot of funds have shut their purchase window. Only the SIPs continue. Is that a problem of? Is there a real problem of plenty out there? Is there a challenge in investing in small caps anymore from an institutional perspective?
So there are a couple of risks over here. One is the valuation. We believe in small caps certain parts have become expensive, but there are still opportunities. The second is liquidity. I think there is higher impact cost in small cap, and hence entry and exit will create undoubtedly impact cost. The third is governance. Today, hand on heart, can I say that all the small cap companies have better governance system? Answer is no. Can there be hidden minefields which we have not discovered?
Yeah.
When we go into large cap, by and large we know businesses, by and large we know promoters. Our chances of going wrong will be very, very rare.
Right.
But in small caps and mid caps you could go wrong.
Yeah.
So small and mid caps is not just about valuation, it's also about liquidity and impact cost. It is also about ensuring that your reputation risk doesn't suffer.
Correct.
In 2000, I think we really made a terrible mistake as an industry of investing into many fly-by-night operators.
Right.
2008, by and large, we had corrected it. 2024 or 25, we should not go like 2000. Every company which we have invested should be real business, real governance.
So also the fact that, in 2000 and 2008, you still had like an avalanche of new fund offerings being launched based on those themes that were working. This time you have the opposite, that, proactively funds are saying, let's put let's put the shutters down on some of these excesses. Okay. One question related to sectors. In the last 2-3 years, if you see, there has been a lot of buoyancy around industrials, obviously predicated on the fact that there is a capex recovery out there, and this is also the pocket where a lot of mid caps and small caps have done very well because they see order books becoming bigger and bigger, and part of it is also because, in fact, a chunk of it is because of increase in public spending. Ahead of elections, do you see a change in the way government spends happen, and what does it mean for sector performances going forward?
So one, in the past we had seen that generally ahead of election, government's capital expenditure will expand. There will be urgency to execute project, complete project. This government is different. They have been front-loading investments and the focus on execution is relentless. between 2014 to 24, 10 odd years, will create as much infrastructure which was built before 2013. I mean, what would you have built over 100 years is getting replicated in 10 years. That's the speed of execution. My feeling is that this time for capital goods company, opportunity is not only domestic market but also global markets. Many of global companies have their listed subsidiaries in India. They have been sourcing goods from China, and now there is active encouragement from their government, their buyers, that please diversify out of China. Every country in the world is trying to become part of China plus one. India is one of them.
Right.
But we have serious opportunity to become a manufacturer to the world in capital goods, thanks to one, our own ability to master the engineering, and second, the connection with global companies. Capital goods companies which will have access to technology through their parents or otherwise, and which can cater local as well as global market by becoming part of global supply chain management, I think has a good runway.
Sure. And all these pockets that are purely driven by government expenditure, for example, the railway pack, defense pack, some of the stocks in the defense sector, are they looking fatigued to you now, or can they run further?
So valuations are expensive there, and in many such companies, the floating stock is limited, and hence prices are here. There is no divestment, hence prices are here. My feeling is that you have to be very, very selective in this two space. Undoubtedly, government expenditure will continue, but the valuation which is demanded out there is very, very high. This valuations can be only justified if all these companies also become global exporter.
Right.
Not only local market, but if they start covering global markets, then yes, maybe these valuations are justifiable. But how many companies will be able to do that transition?
And that's a big assumption to make in today's
assumptions to make in today's time.
Sure, sure. And do you see any obvious pockets of value in this market?
See, there are some values like oil marketing companies, but I don't know whether they can be called value or not. They should not become valuation trap like a government telecom company.
Right.
So I will say, don't fall into this fallacy of value in today's market. India is a growth market. If you can get companies which can be bought at reasonable prices, that should be good enough.
And tell us your thoughts on autos, because I did hear you talk about autos. What is your view? Because from most mutual funds, what we pick up is that, you know, a lot of institutions seem to be favoring whatever is here and now, you know, companies which have a very sturdy EV plan for the next 1 to 2 years, wherever they see traction in terms of volumes in the next 1 to 2 years. What is your view? And this whole transition, you know, it's a big thing, because for a lot of incumbent companies, it means new businesses coming and taking away and eating into their, you know, original business. So how do you look at it? How do you guard yourself from valuation declines going forward?
So one, the near-term trend is premiumization.
Yeah.
If you sell entry-level car, you will probably raise 5 lakh rupee and you will make 10% margin, 50,000 rupee. But if you sell a 30 lakh rupee car, you will make 3 lakh rupee. So same volume of production, you will make more money. So companies which have transited into premiumization of the cars or bikes will be the best opportunity. The second medium to longer term trend is technology. The petrol diesel car will continue to decline over a period of time. Hybrid, electric or hydrogen or something else will be the future.
Right.
Now, whether it will be electric cars or hybrid cars or hydrogen cars or something else, we don't know. And hence we are diversifying our portfolio. We have seen that there are companies which are not able to make that transition. That's clearly avoidable, even though in the near term they may do well. The focus is not on putting all eggs in one basket. I don't know whether EV is the future or something else. We will keep on building positions across all those companies which are preparing for the future, And once we see that, okay, this technology is now becoming successful, we'll go and invest. If I remember correctly, in the beginning of 20th century, there were electric cars. There were cars with fifth wheel which will help you in parking. But those innovations didn't sustain. The electric car gave way to petrol and diesel because of bulky battery. The fifth wheel disappeared, maybe because parking space in those days was not a challenge.
Correct.
So don't put all eggs in one basket. We don't know how future will evolve. We are putting, our rumal everywhere.
Right. Okay, now coming back to risks that markets face today, I mean, what are the risks that you think are really lurking around? Are they real? Are they, some of it has turned out to be imaginary in hindsight, because we kept thinking about US recession, it hasn't happened. What are the real risks that?
So as of today, I feel as if the God is Indian. We were worried about monsoon. August rains were poor. We had double-digit deficiency. September rains recovered. I hope and pray in the southern India, when the monsoon comes, it's good enough to fill the reservoir, because right now the southern reservoir water levels are about 50%, 40% lower than 10-year historical average. So praying for a miracle over there. Second worry was oil. It was threatening to go to triple digit. US proposed releasing sanctions on Venezuela. And then Saudi probably ensured that supply increases and oil prices remain in 80s, not hundreds. So some of our problems are getting resolved on its own. But in the market, you should never become complacent. I think our worry is not about earnings growth. Our worry is on valuation. In valuation, we have to ensure that growth, governance and green, this 3G keeps pace. Growth will come. Governance, I think regulators have done a fantastic job. Company Law Board, FinMin and SEBI has empowered institutional investors to enforce regulation, governance on companies. The worry is our own valuation premium which we are enjoying.
Correct.
Today, every political party is looking at providing freebies to win election. We are still a developing economy. We don't have budgets which can provide unlimited subsidy to people. We still have to make investments for future. Our fiscal prudence during COVID time is giving us today's relatively better economic trajectory and premium valuation. If I let go that fiscal prudence because you want to provide freebies to people, then my valuation will get hit at some point of time. I just hope and pray that political parties keep on talking about freebies, but they'll repackage existing subsidies which is necessary to the citizens, and our fiscal prudence we don't drop.
Sure. So talking of that, how big a risk, if at all, is the election next year, and when does the market start to discount that? Because a lot of research has been, sell side has come up with numbers like 20 to 40% market drop if the current administration doesn't come to power, etc. What is your view? When does the market really start to focus on these uncertainties?
I'm sure market is processing all the information every day. And in 2004 as well as 9, we have seen that when market got a result different from expectation, there was up move or a down move. 2004, 20% down because expected government didn't come. 2009, 20% up because government came with more number of seats than expected. But eventually elections play an impact on the result. Thereafter your fundamentals prevail. The work done by government, work done by corporate is not going to go away because government changed. It will be there. Yes, the directions can change, the speed can change, and that will impact the overall valuation. But after the correction, your fundamentals will still prevail. As of today, based on the valuation, I think markets are discounting continuity of government. If there is a surprise, markets will go higher. If there is a shock, markets will come down. But eventually, the fundamentals will still continue to hold good for India.
And what could be that number like? I mean, is it in your mind, is it like a 20% premium for current administration? Is it a 30-40% premium for current administration? Because when we talk about government policy, fiscal prudence, all of this also has got demonstrated in the last few years, and that is what the market has also taken cognizance of. So what is that premium that could be at risk?
So it's very, very difficult to figure out what that number is. We had seen in 2004 as well as 2009 markets going up and going down, but it fell down 20% or went up 20% because that was the circuit.
Right.
Who knows how to price this kind of things? My feeling is that in this kind of election uncertainty scenario, which is binary event, it's better to focus on your asset allocation. This is fair value market. Go with equal weight allocation into the event.
Sure.
If there is surprise, you can book profit. If there is shock, you can put more money.
You're talking like the retail investor now. We have all taken a lesson from the retail investor.
Yes.
Fair enough. By next Diwali, where do you expect frontline indices to be? Let's say the Nifty.
So I have no ability to predict future. And my recommendation to investor is don't look at it as Samvat to Samvat. This is India's journey from $3 trillion economy to $30 trillion economy. Just participate in that. Ek Samvat idhar udhar ho gaya wouldn't matter. Next Samvat we will cover up and deliver return of 2 years in just 1 year.
But would you take a bet this year Nifty will do better than the mid cap and small cap indices?
I will say the gap will narrow down significantly.
Sure.
Now it's possible that small and mid cap may still deliver slightly better return because earnings momentum is there in small and mid cap.
Right.
But will they get derated from 20% premium to somewhere around historical averages? Answer is yes.
Sure. अभी अपने गानों का पिटारा खोलो. One for last year and one for next year.
Tough one. But next year and beyond that is very easy one. जहाँ डाल डाल पर सोने की चिड़िया करती है बसेरा, वो भारत देश है मेरा. I think if we have to make India golden again, सोने की चिड़िया, then all of us should aim to invest in India growth story. Businessmen should invest as an entrepreneur. Retail should invest their savings to support those entrepreneurs. And with collective effort of entrepreneurs and investors, we will create golden India. For the past, I will say, छोड़ो कल की बातें, कल की बात पुरानी, नए दौर में मिलके हम लिखे नई कहानी, हम हिंदुस्तानी, हम हिंदुस्तानी. We have a glorious past, but we have to write a new chapter, and we can't take anything for granted. We can't be complacent. We are still a poor developing nation, and we all must work hard so that we can create golden India.
Oh, absolutely. Wonderful, wonderful. On that very sweet note, thank you so much, Nilesh. As usual, wonderful talking to you, and thank you for all the optimism that you bring in today. Thank you so much.
Thank you.
Well, hello and welcome to Moneycontrol. I'm your host, Nikki Mirchandani. Samvat 2079 was marked by volatility due to rising inflation, interest rates, global geopolitical tensions. How will the narrative of Samvat 2080 differ? Will it be characterized by higher for longer interest rates, volatile bond yields, geopolitical tension, or let's just say the state elections? How will the landscape of mutual fund industry differ? Let's find that out from the CEO of the second largest AMC, Nimesh Shah, who's the Managing Director and CEO of ICICI Prudential AMC. Thank you so much for taking out the time and joining us here.
Hi.
I'm going to start off by asking you quickly about Samvat 2079. It has been a year of the unexpected in the stock market, where you've seen mid-cap and small caps perhaps outperforming the larger counterparts. How different do you expect this Samvat?
So a lot of things in life as well as in the markets do average out. So funds which are over the last 2-3 years, whatever has given a lot of return, one will see them balancing out in terms of if the good thing that has happened in the last 3 years is that the growth in the share price has been linked to the growth in earnings. It's not that the share prices have run ahead of the earnings growth. Earnings growth is coming in and share price is reacting. So it's a very healthy growth in the markets that we have seen. Mid cap, small cap profitability has also grown, and that has led to a larger growth in mid cap, small cap vis-a-vis large cap. The mid cap, small caps have grown better than the large caps. So if the profitability continues, and now you can't talk on industries, right? It has become so company specific.
Absolutely.
So our ability to understand which companies will benefit in the new India that is coming up, in the new sectors which are coming up, which are the companies within the sector. When I'm talking to you, I also can't say that pharma will do well. I would rather say there will be some specific company in the pharma sector which will do well. So that's how it's going to be a very stock specific year going forward, while markets have generally done well in the last 3 years.
I believe the conversation that we had right at the start of the year, where you said that this is going to be a year where you will see sectors that have not done well typically doing well, and that's perhaps also came in true, right?
Correct.
Something like a private bank, which people do not, perhaps a darling of the markets, vis-a-vis PSU banks, which otherwise there was a distance from the portfolio. PSU banks have come back in a big way. What's your assessment towards themes like that? COVID, you had pharma, then you had the banking. What could be the specific themes essentially from a very aerial view that you could look at?
So themes wise, there are 3 very clear things that are happening in India. Indian banking system, because all the macros of India are well in place, whether when we are looking at inflation, we look at fiscal deficit, we look at current deficit, and another thing, corporates in India are also in a very healthy stage. So you have got banks which have written off their NPS completely. Banks running a very healthy balance sheet. Corporates are at an all-time low borrowing today. Corporates, their capacity utilizations are being used well, so they are ripe to grow their capacities further. So when corporates grow their capacities further, the banks need to lend more, right? So there is a growth expected that is to come to banks. On a clean balance sheet, banks are expected to grow. So I believe that any bank which can understand the credit risk well and is doing its business carefully will have a good run going forward. So one clear thought that we have is on the banking side, that banking would be a good space to invest in at the current levels. Another thought that we have is that manufacturing in India and infra in India. Manufacturing in India, last 20 years last 25 years we have been only taking the onslaught from China, right? China has been at a very low price. China has been exporting all across the world, and Indian producers had to match that or had to have the brunt of it. Now people who have survived competing with China for 25 years, they look like prospering, because what is happening is that there are a lot of inquiries coming from all across the world. I am not saying a revolution has already happened, right? We have to compete. Our corporates will have to compete with other countries, but definitely there are lots of inquiries for our corporates. When we are talking to corporates, they are getting many more inquiries today from across the world. What was supplies going from China? That China plus one strategy, I actually see it happening. So I actually see companies increasing their capacities, and over a period of time, it will be reflected then in earnings. So specific themes, if you ask me, one is banking, one is manufacturing in various sectors, wherever we have that competence, and it will be company specific. And third place that we like is also the power sector or the utilities sector. The way the demand is increasing for power, we believe that if we don't ramp up the capacities quickly, we again have a power deficit in the country. So power companies will have to, and that will again have its impact on the capital goods industries, as power companies need to increase their capacities. So capital goods industry, power, utilities, manufacturing, and banking. That's the space that one would look at.
And that's also the order that you would look at.
Order, it's very company specific. It's not, or no, you should not go by the order. Order can be in any ways.
So would you want to stack that up in the pecking order?
It won't, these are the sectors which look promising. After that, you need to get into company specific details, right? That's what we are paid for.
Right.
That's why the customer is investing with us, that within this broad sector, which are the companies that will identify.
Okay, this year also we saw a huge amount of outperformance coming in from the real estate index put together. So something which was PSU banks, these were themes that were really not, market was hoping for. It was on unexpected lines. Something like new age companies also have been in focus, right? Be it on likes of Paytm, Nykaa, and now Mama to the list. How do you view that now? Are you still going to be warning some amount of caution on these new age companies?
We are managing public money. I always say that we manage the common man's money. We manage the money of the retired school teacher in the small towns of India.
Absolutely.
So we need to be very careful the way we are investing. We should see a clear plan of them making money in the next 3 years, how they will execute it. The how and how much is very important. Right, it can't be a macro call saying that we are creating a highway. A lot of cars will run on that highway, so please come and invest with us. This is going to be future. Those kind of calls I can't do with public money. If it's an institution money where I've got a mandate to do such things, otherwise, without clear roadmap, we cannot be. So we have our research department. We have got a way of investing. We'll continue that way of investing. So it won't be based on, it will be based on how the company will make money over the next 3 years.
So right? None of them actually make it to the list for now?
I would say none of them make it the list. My mandate is such that I need to see a profitability coming into those companies over a period of 3 years. Okay. I can't do it only based on top line growth.
Fair point. Last Diwali, the talk was about rate hikes by global central banks. Of course, this Diwali, the narrative has shifted a little bit to Fed is done hiking the rates, but we're staying at that higher for longer levels. Do you think some amount of investor caution is warranted in this scenario? Also, are you hoping for FIIs to return in a big way? They've been stagnant in the markets thus far, but DII story has been intact, supporting the market. What kind of trend are you looking forward in this, Samvat?
See, FII is selling. Right now I talked to you about banking, but a reasonable correction has happened in banking. So FII is selling always leads to some opportunities. Remember the old days, 2011, 12, 13, 14, whenever they used to buy, markets used to go up, and whenever they would sell, the markets would go down. So it was giving very easy opportunities. So I'll always look at FII buying or selling as opportunities. So we practically, you said DII is so DII have now become a great counterbalance. So that is a comfort also today. What has happened in 21-22 when the FIS kept selling, they sold almost $4 to $5 billion every month, and still the market didn't correct to that extent.
Absolutely.
Right? It was a 10% correction despite so much selling. So that has created a very healthy and confident that there is limited downside to the market, I'll put it that way, because at any point of time, an Indian investor has become, if you see the behavior of the Indian investor, when the flows come into mutual funds, as soon as the market corrects, the flows start coming into mutual funds. Right? It happened in the near past also, and it has been continuously happening. So gone are the days when the investor in India will panic as soon as the market starts correcting. Right? It's not happening. It's happening the other way around, that investor has become smarter. He starts buying mutual funds, equity mutual funds, when the market's correct. So I think a lot of investor education, congratulations to Moneycontrol and all, that a lot of good investor behavior is also happening. Right? The smart guys are buying on dips.
Absolutely. And also correction is serving more as an opportunity to enter into the funds that perhaps one could be looking at, be it passive or be it active. But for Samvat 2080, before we move on to a bigger story there, which of the following themes according to you or factors according to you could be the growth drivers or will have a bearing on the markets? Would you think it's going to be state elections? It's going to be cues from US stocks and bond markets? You think it's going to be oil prices? You think it's going to be earnings, monetary policy? Please don't say everything put together. Just give me one out of the lot that you think will have a maximum bearing on the market.
We are mutual funds. We are not here to predict elections. We are not here. The only thing that we look at is earning per share. ultimately market, look at the last 10 years, look at the last 5 years, market has followed earnings. We are in a very healthy market today because market follows earnings. There will be some, in any market there will be some nuances about the mid cap, small cap, where there will be some people who are overvaluing stuff or are overexcited. Ultimately, if the earnings growth does not come, those stocks get corrected. Go back to 2020. There were certain companies which were going at 50 PE was becoming 80 PE, and people were justifying those companies even at 80 PE. What has happened in the last 3 years? Quality at any price companies have not done that well, right? There has been absolutely no, there may not have been severe price correction, but 3 years time correction has already happened, right? So, my take is that ultimately it's only one thing that one should bother about in the 3 to 5 year space, that is earning. Indian markets are very mature. If the earning growth does not come, nothing can keep the price of a share up if it is not followed. If the expectation is that earnings will rise, and if the expectation does not come right, nothing can stop from the share price from going down. So there are a lot of stocks, especially when you look at the F&O market.
Absolutely.
When you look at 260,000 crores of futures, stock option futures, individual stock option futures. When you look at 150,000 crores of call options in the market, open interest position call option. So you are talking about 4 lakh crores between the two of them, right? Which was hardly 150,000 crores 3 to 4 years back. So you're talking about such huge leverage in the market. So the only risk I see in the market is the amount of leverage that the local investors have put in, right? So at some point of time, on those stocks, if the earnings don't come, there will be a huge disappointments in those pockets, right? So that one should expect to, this year I would be very cautious on the mid cap side, where there are huge open market positions, because Indian investors are speculating a lot on those stocks. And when the expectations will not be fulfilled, we'll have problems in those stocks.
That's precisely what I was trying to capture through the conversation. You think there is some froth happening in the mid-cap space. Precisely that's the case right now. But moving on...
It's only because of the leverage positions in the market. So this Khelo India Khelo which is going on in this country, where the whole stock markets have been gamified, right? That is what people think it's a game, but when they lose money, right, it is all, we have seen it earlier, the same thing will happen in those speculative stocks. I'm not talking about the broad market. I don't see that froth in the large cap. I am only saying specific pockets of mid cap, small caps will see corrections during this year.
Point well taken. Let's move on to people actually chasing quick money, the F&O traders. Let's just put that into category. 9 out of 10 traders, F&O traders, have been making losses as per the data that we have. What's going to be your piece of advice coming for those traders? Do you think someone who is chasing quick money would want to eventually look at the longer term picture and start investing?
He will have no option. I think that trader, because every day you get calls from various parts of India saying that they can guarantee that how you will make money, right? Those are the kind of irresponsible calls that you keep on getting, saying that they'll tell you option trading. In smaller parts of the country, there are coaching classes which have come up for how to make money out of options and traders. So that's the fear. I am very clear you can't, and as you said, data is screaming that people don't make money. I have seen the psychology of these people. I have talked to a lot of people who have dealt with this one. When they lose around 30% of the money, right? When they lose, with whatever portfolio they come up with, whenever they lose around first 10-20%, they still play along, right? When they lose 30 to 35% of the money, that is where the alarm bells ring, that my hard-earned money is going away.
Absolutely.
At that point of time, they'll switch over. Then the problem is a lot of them will switch over back to the most safest products. It will be extremes when they lose money. So this is what has happened since last 30 years.
Playing out right now in this year itself, because we've seen the losses.
It's not I'm just looking at this volumes of speculation that is happening, the volume of leverage that is happening in the country, that is not coming down. So maybe new guys are coming in. What happens? New guys come in. As long as the new guys are higher than the old guys, right? So I always feel that there is a huge space for mutual funds, and I believe a lot of people are marketing for us today, because all those people who will lose money on individual stocks, which eventually come because their KYC has been done, everything has been done, so they are already in the SEBI fold. Ultimately, they'll buy mutual funds. So the young guys of today are much more smarter than what we were when we were 23. So they are already in the markets, but they are markets with stocks. At some point of time, you should be in stocks. It's a very healthy thing. You should be in stocks,
Absolutely.
but you should be in stocks only if you have the research capability of understanding what will be the company's earning will be going forward. That is the only thing that works, nothing else works. So if you don't have that expertise to understand what will be the company's earning over the next 2-3 years, then depend on the experts. That is my limited advice to the young people. They are smarter than what we were 30 years back, but if they should not lose money. My basic model is that one should not lose money, and we should not forget that first rule of not losing money. That is extremely important for the young people. It's hard-earned money. It's hard-earned money. That hard-earned money should not go.
So the first rule is don't lose money, and the second rule is remember the first rule.
That's
Okay, so let's talk about the cleaning that usually happens ahead of Diwali, right? Similar is the case also with terms of revamping of your portfolio in the run-up to Diwali, things that have been working for you, that have been meeting the financial goals versus the ones that have not. How would you assess this, and what's going to be your advice for those revaluations?
I've never seen it as Diwali cleaning time, but from last Diwali to this Diwali, one thing has changed. Debt has come under taxation. Right? Even if you invest in debt funds, you don't pay the capital gains, you pay the marginal tax that you pay. So if you are in the say 25% tax bracket or 20% tax bracket, debt will become very difficult to invest because the whole thing will get taxed. So in that scenario, one should look at multi-asset funds, which they get equity taxation, and they invest in equity, they invest in debt, they invest in gold.
Absolutely.
So we are firm believers. We have been, whenever I have come to the channel or whenever I go into the public fora, I always say, I used to talk about ICICI Prudential, who had become synonym that if we come on TV, we will only talk about one thing, balance advantage fund. That's a category that we created. Another category that we had created 21 years back was a category called as multi-asset category now. It is called multi-asset category now. When we had launched it, we used to call it ICICI Prudential Dynamic Fund.
Okay.
What happens in that fund? You invest in all three asset classes, as I was saying. And debt part, 65% is invested in equity, 25% is invested in debt, 10% is invested in gold. So with a single thing, you get an exposure to all three asset classes. We are positive on gold. As a company, we are very few times in life we say that we are positive on gold. So right now we are positive in gold.
Okay.
So you get a gold allocation. Debt, you get tax with the equity taxation on the debt product, the 25% debt that is there in the products, and 65% you get on equity. And that these strategies have got such a fantastic, the customer experience in these strategies has been so good. So that's why we prefer that there is some cushion. There is some, when you have got some debt and the gold part of it, there is some cushion if there is volatility, because people talk very aggressively, but when they face volatility, they are not Indian investors. To what extent they will be able to take volatility when there are hard earned income? So I think these products cushion the volatility quite well. So
point well taken. I also wanted to chat with you about gold, and you've spoken about it already in terms of the allocation. Of course, you're going to be giving in an allocation of 10% per se for gold, but maybe in the run up to Dhanteras, when people are actually buying in gold jewelry, would you actually advise them to go out there and buy in sovereign gold bonds or the product thereabout in terms of funds also? What's your outlook for gold? What's going to be your advice coming in that?
We are positive in gold for what is happening all across the world.
Absolutely.
In that background with what is happening in the US interest rates, etc.
And also the Israel Hamas, right? It's been over a month that we're looking at the concerns.
So while geopolitical, our understanding is limited, that we should admit, but for the economic cycle that the world is in, gold is not a bad asset class to have. I don't want to get into the details of why gold. So 5 to 10% allocation in gold should always be good, right? And we can invest in the central government bonds also. You get a return also, but your money gets locked for a long period of time, and I don't think there is a reasonable liquidity in the secondary market. So one is, but if you have got a long-term call, it's a good instrument to invest in. But there are ETFs also, gold ETFs, and there are funds also. So whichever route that one may want to invest, one can invest.
Okay, which is going to be more preferable amidst the three if you have a perspective over the number of years that one is actually looking to invest?
If you've got a very long-term perspective, 7-8 years you want to remain invested, then those central government bonds are good. This one, because you get a 2.5% return also on them. So that is in ETF, or if you give us money for gold funds, while you will have liquidity, but you cannot, you don't get a 2.5% return on that. Central government is giving that return. So the central government bonds are good if you have got a time span for maturity.
All right. An investment advice you think you can give or offer for someone looking to invest their Diwali bonus wisely this year? Is it going to be a mix between multi-asset funds along with the balance advantage? How are you looking at the split?
The difference between multi-asset category overall, say these are SEBI created categories, the difference between multi-asset category and say our balance advantage fund will be that balance advantage will be right now will be around 40% invested in equities, while multi-asset will be 65% invested in equities. So it's more, multi-asset I would say is more aggressive than balance advantage fund. So multi-asset fund normally you would invest expecting the full equity returns out of it. Because last 21 years also, we have created this category 21 years back. It was, last 21 years, the CAGR of that fund is 21%. So that's the kind of past returns that have been there.
Sure.
While past returns have got nothing to do with what will happen in future. I feel multi-asset is a good category because you make money out of volatility. We genuinely at ICICI Prudential, we believe volatility is good. Right? Absolutely. Volatility gives you opportunities to earn. So when the markets are down and you invest more into equity, right, it gives you that contra behavior. Contra behavior makes money. Balance advantage has got a super track year, 10-year record, right, of almost giving 85% of the Nifty returns. While investing only 50% in equity, it has given almost 85% of the Nifty returns, ICICI Prudential Balance Advantage Fund. But what does it do? It makes money out of volatility because you go to buy equities whenever it falls. When the market fell 10 days back, there was a huge amount of equity that was purchased. So continuously you are going against the market. And going against the market in India, in a volatile market like India, you will keep on making that money, which is completely within the mutual fund, it will be tax free.
Point well taken. Also, you know, I'd want to chat much about the competitive landscape, or let's just say the growing landscape of mutual fund industry. You've been one of the longest serving CEOs in the history of mutual fund industry, of course. What's going to be your piece of advice to one of the oldest fund manager, which is Samir Arora, who started a new mutual fund? And also, along with that, a young upstart like Nitin Kamath, they're also coming up with funds in a big way. What's going to be your piece of advice within the changing landscape of mutual fund industry? Because you've been holding the helm for a really long time and you've seen the whole evolution which has happened.
So neither Samir Arora nor Nitin Kamath, either of them don't need my advice. They are super smart people, and Samir Arora is definitely not the newest fund manager in the town.
Actually,
he was fund manager.
Oldest,
he started the mutual fund industry. The oldest. So I am nobody to give advice to him. He is and both of them are super smart people. But I feel that mutual fund industry, we welcome them to be part of this industry again. In Samir Arora's case again, because this is an infinite potential industry. The more people who come in, the better it is for this industry. Why I am saying, say 10 years back, we were 10% of the banking industry. Today, we are almost 24% of the banking industry, right? So in 10 years, we have moved from 10% of the banking industry to 24% of the banking industry. Say by 2030, we'll be 1/3 of the banking industry. Right, the way number of investors have come in, the number of investors who are investing in equity are going to future invest in mutual funds because they are making losses over there. Looking at all the data points, right, and looking at what has happened past, there is reasonable chance that will be 1/3 of the banking industry. But by the time banking industry will be 200 lakh crores, banking industry itself will be 360 lakh crores. 1/3 of that, we are talking about 100 to 120 lakh crores. So from 47 lakh crores, this industry over the next 7 years will be almost 2.5 times of what it is today, right? Or even if you discount 2.5 times, definitely double of what we are today. So that kind of growth, more players coming in, they will only expand the market. People who are very smart on the digital side have created a brokerage business. They themselves are coming into mutual fund business. That itself indicates what we have been discussing since last 15 minutes, that people who have done brokerage business very smartly are coming into AMC business. Why are they coming into AMC business? Because if 90% of their customers are losing money, you need to create another product where the customers make money. We are so happy when I'm sitting in front of you, I can very proudly say that 99% of my customers who have stayed with me for 3 years and invested in my equity and hybrid funds have made double-digit returns. So we are very happy. It gives us a lot of satisfaction. It gives us a lot of happiness that 99% of my customers have made double-digit returns. So we do not want to promise the moon to anybody. And if new people are coming into this business, it's a very, very healthy sign.
Absolutely, but would you want to have a piece of advice even for the young upstart Nitin Kamath, if not for Samir Arora, who's quite an old hand in the industry?
I don't believe that either of them. When I said either of them, Nitin Kamath also knows digital very well. He understands investments very well. So we have lots to learn from him.
Are you going to change your strategy with the new entrants coming in?
Unlike what the media feels, market is infinite. India, we are blessed with a country. It is where the market is infinite. I believe we have got only 4 crore investors in the country. We can get at least 10 crores investors with these people coming in. So there is market for everybody. All the existing players, anybody. SEBI has created a wonderful product. The regulator over the last 16 years that I have been part of this industry, regulations have become better and better for the final investor. Today the product is very pure. Why is the product growing? Not because we have done a great job of it, because the regulations are so good that whatever I can, hand on heart, I can say that 100% of my products are working for the benefit of the investor, right? The regulations are so good. So with
very transparent in nature.
So transparent, what you pay for is what you get, right? When I've very transparently created a product, you know exactly what you're paying. You get India growth story. So I think the product is so good that there is nothing that I need to tell either of these two experts. More people are coming in and we are very happy. They'll grow the market. So there is too much growth in the market. I'm telling you that it will become 2.5 times of what we are today.
By when?
That's what I'm saying. By 2030, that's what I was saying. By 2030, if the banking industry is 360 lakh crores, will be 1/3 of that.
So we do have space for more players, but do you think market is now bending towards should have rather more distributors than players to penetrate it further? What's your assessment?
Yeah, distribution is something that we have to work on. That
Absolutely.
Because one basic thing is that it is not a OTC product. I'm giving the analogy of a pharma industry. It is a prescription product,
okay.
right? People don't. If you do an OTC, people are going and losing money. Right? So while we give complete disclosure, that is important, it is very important to even explain people what is a benchmark, right? You need a distributor to do that. So I feel whether it is a distributor, whether it is a registered investment advisor, whether it is a bank, it is good to have an ecosystem where everybody is well remunerated and we have a good healthy distribution and well regulated and well compensated. Both the things happen, we'll have a robust distribution industry. It's a good business to be in. For the young people in the audience, they can also think of mutual fund, whether mutual fund distribution or mutual fund advisory as a profession, as a career, or investment professionals. You can become an investment professional and make it a career. People need advice.
Fair point. I'm just going to come back to the strategic part of the question in terms of traditionally your fund has been more focused towards active funds rather than passive funds. You think any of that would change now, or you would contemplate the idea of perhaps having more passive funds?
We have the highest number of passive products. We are as much a passive industry as we are in active. It is a different verticals. As long as why the growth has been very limited in the passive industry, because active fund managers have given good alpha, right? If I beat the index,
Absolutely.
right, I am very happy to state that a large percentage of our funds have beaten the index, right? If you have beaten the index, then people will invest in a product. If I don't, when will passive grow really? If the active fund managers are not able to beat the index.
Absolutely.
So since active fund managers are performing over the last 25 years,
Absolutely.
right? So this active industry is growing. If we don't perform, then passive industry will grow. So it's a very well regulated, let the best product win. What are the regulations in this country? What is happening? Suppose my fund does not do well, right? No amount of selling or marketing I will be able to sell the fund. Because the customer knows what he has to ask for when he's looking at a fund. So without performance, however good your marketing machinery would be, you cannot sell a product.
All right, I'm just going to sum up this conversation by asking you 3 key advices that you'd want to give out to the investors / viewers out there before investing into mutual funds in terms of their thought process, what kind of psychology they can adapt before entering into the industry. 3 piece advice on that.
See, one thing, you should be able to trust the brand with which you invest in. Because when you are managing, we are also very conscious when we are managing other people's money, it has to be the transparency and the ethical levels of the organizations have to be very, very clear.
Fair.
So whenever you are giving your money to somebody else, you should have the assurance, or you should look out for the kind of people who are managing the money, whether you can trust while the regulations are well in place, whenever you are giving money, the people should be trustable, that you should be able to trust those people. Second thing, don't depend only on past performance.
Absolutely.
Right? In fact, past performance, look at with some skepticism. Past performance indicates that we know our job. Right? And I am saying when my past performance is very good, so that it is not only past performance, whether you can trust the people, what is the outlook of that industry, what is the outlook going forward. You are don't come into mutual funds only because past performance looks good. If large cap is given average returns and mid cap is given heavy returns, it does not mean that it means actually that the mid caps are already run up.
Absolutely.
Then that may not be the time to invest in a mid cap fund. Just because mid cap fund has given a very good return in the last 3 years does not mean that you should invest in my mid cap return. I would urge the investors to invest more in large cap, this one. Second thing, always third thing is that too much aggression in investment. You should have, if you are getting too much aggressive or too concentrated or direct stocks, please have the knowledge before you invest. Because without knowledge, when people hear somebody, you take advice from somebody and you start investing, normally very few people have made money by that.
All right, Mr. Shah, we're just going to leave it at that. And thank you for taking out the time and to join us in the studio.
Thank you.
All right, with this, it's a wrap. We extend our warm Diwali wishes to our viewers out there. May the festival of lights bring joy, prosperity and happiness to your lives. Goodbye from us, but don't go anywhere else. Please stay tuned into more exclusive interviews coming in from Moneycontrol.
Hello and welcome to Moneycontrol. Well, part of our Diwali special series, I have with me an investment stalwart, the CIO of Prudential ICICI Mutual Fund, S. Naren. Naren, thank you so much for your time today. I mean, this is really precious. Thank you so much.
Wishing everyone a very happy Diwali.
Thank you, thank you. So, what I wanted you to do, Naren, this time is to just, traverse the last 1 year and tell us how has this year been in terms of making money? Because if you look at the market, the Nifty has really not gone anywhere. It's just up about 3% last Diwali to now. But it feels like the market went all over the place. It went higher, then it went sub 17,000 in March, and then there was this mid-cap, mad-cap rally, and now we are, 19,000 thereabouts. So lots of ups and downs, but in the end, you're at the same place. How has it been for you as a fund manager?
So it doesn't feel like that, I think if you have had such a big move in mid cap and small cap, maybe you don't feel like you are in a flat market or something like that. I think we have had one of the fairly bullish markets at this point of time. And I would say that the markets have done pretty well over the last 1 year. It is just that the mega caps have done pretty badly, and the mega caps, everything else has done very well over the last 1 year. And overall, you don't get that feeling, that markets have done badly, and that's not the way you feel, because almost every stock that you look at looks to be trading at 30 PE,
right,
and doesn't seem to be trading at low valuations.
Correct.
So having been in investing for long, when you try to look at stocks at this point of time, you don't get the feeling that
the market's not done
market
anything.
is not is very cheap or something like that. You don't get that feeling at this point of time.
Right.
So I don't get the feeling that you're in the midst of a bear market or something like that.
Tell me, rewind back to, let's say, last October or March, if you can recall, because I certainly agree with you that last few months, the frantic rally we have seen obviously makes us feel that, a lot has happened in a very short time period. But The rest of the year actually felt the opposite. In March, it was like, what is to come? Could it be the next 2008 and so on and so forth? How challenging was that period? And thereafter, was this period a super surprise?
See, everyone wants to equate everything with 2008. I think it is completely illogical. See, 2008 was special because a lot of things which happened in 2008 was unprecedented and may not happen on so frequently. And I think, to expect the markets to fall 50%, you need to have done a lot of mistakes. And I think Indian macro has been managed very well. I look at some indicators like, let's say, I look at current account deficit, I look at inflation. Look at current account and deficit and inflation, it has been managed in a very, very sensible way over a long period of time. When you have this kind of a situation, you're not going to have 2008. So to equate everything with 2008 is very unlikely. I think basically what has changed is that, everyone has focused their asset class on equity. So you have a very, very buoyant SIP inflow. You have so much of money coming from EPFO on a monthly basis into equity. You have a lot of money coming in from NPS, National Pension Scheme, into equity.
Correct.
You have so much of money coming into equity on a regular basis that it becomes, it's illogical to expect very large, big drawdowns in large cap equity at this point of time. So that's why I think the markets are different, and today the incentives which are there for investing in equity are much better than the incentives which is given for it, let's say investing in debt. That almost every investor wants to invest in equity and not in any other asset class at this point of time.
So you're bringing for two things, but let me take one by one. One is that you're saying that the risks in markets today are not as it was in 2008, primarily because you have a counterforce in terms of, domestic flows. Fair enough. But in terms of global macros itself, do you think there are any risks, or are those also exaggerated? Because the fact is also that the kind of interest rate rise we have seen in the US is absolutely unprecedented, right? When did you have an episode like this last? It was in the 80s, and such an accelerated. So those also create, and the debt levels at that time, the leverage was in the bank balance sheets. Today, the leverage is in, the biggest economy of the world, or, other world economies. So how do you size up this risk, and how do you reassure yourself that we are not in for some really deep correction? That is number one. So the global risk, how do we feel secure about it? Second is, of course, the India part, which we'll come to, but tell me about the global thing.
See, if there were no problems, that is, then we are not in a proper market. So I think you will periodically have problems. If you look at the kind of problems that we have had in the last 2 years, someone had told you there'll be a Ukraine war, there'll be a Hamas problem, there will be oil shooting up, you'll have interest rates shooting up, and people will tell you that the markets will not go down. Maybe I would have said, no, markets will be down. It didn't happen. So I think basically, markets are pretty resilient. Even across the world, I would say markets have been resilient. Because I think overall, people enjoy equities as an asset class today because it's a liquid asset class. And over a 10-year period from 2010 to 20, I think people did make money in equities as an asset class. So somewhere equities is a favored asset class of people, and I think that has had a role to play. I think that's why markets have been more resilient than what we would have ever thought of, given the kind of problems that happened. And that's why, I always think that if interest rates were to go from 0 to 5, as it has happened in US, why is it not that more people are not investing in debt in the Western world? It's not happening. Or it is that, there has been so much money still printed. See, after all, US printed not $1 trillion, printed multiples of trillions of dollars.
Correct.
And they have still not removed that trillions of dollars.
Yes.
That is the reason inflation doesn't go away so easily.
Correct.
Maybe that's the reason why even today markets are resilient, because they have not removed all the trillions of dollars that they have printed.
Yeah.
They are trying to remove some small amount of money which has removed out of the trillions of dollars printed.
Yes. Yes.
That's how maybe I look at it.
Sure. And in terms of India itself, do you see any risks? But more importantly, I mean, you touched upon when we started this conversation, you said that it doesn't, if you look at stocks, it doesn't really feel like it's a cheap market. So it is not a cheap market is one side of the story. And there is a lot more money that is coming in to support the markets. And, you know, every month this new money is coming into mutual funds, NPS and all of that is another part of the story. Is there a need for, you know, people who have been in the markets for 20 years or even today you look at all these historical P's and say last 10 years this was the P, last 20 years this was the P, and today we are, you know, 50% higher than that or 30% higher than that. Is it even a fair comparison? Is there a need to completely reset our thinking in terms of what we are equating today's valuations to?
I think you're using the word this time is different. Those are all words you should never use.
Right.
You know. I think it is.
But then this new money flow that is coming is indeed different, no? Or do you think it is not? Can it reverse?
New money is different, I agree. But at the end of the day, you know, it is built on the fact that people think that equity is riskless. So the moment people think that equities have risk, then money will change. So I always think of credit as an asset class in India. Till 2020, people used to invest in credit funds and mutual funds. After 2020, there's no money in credit. It is not that credit is a bad asset class. But no one wants to invest in credit now. So I believe that, you know, people are always conditioned by the past. So after 2011, there has not been a down year in equity per se.
Yeah.
So if you don't have down years, again for some more time, people come to a conclusion equities is riskless.
Yeah.
Then obviously more and more money chases. That leads to even higher markets. But that doesn't mean that it is markets are more safe. Markets are less safe. When people think that markets will never go down, it is less safe. So in different meetings, I tell them it's possible markets can come down sometime by even double digit. And people start doubting me as though I'm talking something which is illogical.
Right.
So that is the irony at this point of time. But having said that, let me tell you what is at the heart of this reason. The heart of this reason is macroeconomics has been managed very well for a decade. So when you manage macroeconomics well, some of the problems disappear. So if you manage macroeconomics badly, let's say current account goes into bad shape. Inflation goes into bad shape. Let's say fiscal deficit cannot be funded properly. Then, you know, you have a disaster ahead. That has not happened for a decade. So I believe that if at some point of time in the future, the macroeconomics gets into trouble, we will have big corrections. Actually, if you see across the world, there have been many countries where the macroeconomics have been managed badly, and then you have had big corrections. So if you look at even US, why did interest rates shoot up? Because they lost control on inflation. So I think it's one of the key things which I tell people is the macroeconomics being managed well is very important for markets to be well behaved. So even in countries like US, macroeconomics was not managed well enough. And that is the reason why inflation went up and interest rate shot up in many countries in the world. Whereas in India, interest rate hike has been very, very little because Indian macro has been managed much, much better.
So is that if at all we were to think about risks, is that the biggest risk you see, or is there anything else?
See, from an investor point of view, the risk in India is not macroeconomics. From an investor point of view, the risk in India is valuation is very high compared to any other country in the world. So, but that is macroeconomics is not the risk in India. Higher valuation relative to the world is the risk in India. That is a risk, and such risks no one can predict when it will play out. So it's very nice for me to say it is a risk, but I won't be able to tell you when high valuations results in money leaving India and going into some other part of the world. I can't predict that. Because the reality is valuations can stay longer, higher, because it's not under our control, because India is a good structural story. So when you have a good Indian structural story, you can have valuation stay higher for a long period of time. So you can't predict. First of all, it's very difficult to predict risk, and it's very difficult to predict the timing of the risk. So I think both are difficult, and that is the reality of what we have seen.
Sure. So how do you approach it? Because on one hand, you're saying that stocks are expensive. On the other hand, we are unable to see triggers that will, bust this, if at all. So how do you do this?
That is too simple, actually. In fact, if you had asked me this question 15 years back, I wouldn't have been able to answer. It is too simple. What we have learned over a period of time is we created categories like balanced advantage. Then there are categories like multi-asset, equity and debt, equity saving. These are very, very simple ways for investors to invest in. If you invest in these categories, you don't need to over worry about these risks, because no one knows when these risks will play out. The past experience says that these are easier ways to invest in the market. When you know valuations are high and you don't know when the higher valuation will actually affect market, choose categories which are slightly riskier than equity for lump sum investing, and then you don't need to worry. So I would say it's very, very easy from the point of view of an investor. From the point of view of a fund manager, it is simple. Focus on the larger companies, focus on the mega companies, which have not delivered any returns anyway.
Right.
So you get the more liquid companies, which are cheaper and who have not delivered any returns for 2 years.
Correct.
So choose those companies over the very small companies that have delivered huge returns and who are actually much more illiquid if you had to go and sell them in a downturn. So that is that is a second aspect. So it's easy both as a fund manager and it is very easy as an investor.
I'm very sure it's not as easy as you are making it out to be.
It is very easy. But the fact is that you can't look at your portfolio every day and measure yourself whether small cap has gone up. Every day you cannot ask yourself, why did this mega cap not go up as much as a micro cap? So in reality, it is easy. It is just like in 2007, it was easy to bet on value investing over infrastructure investing. In 2020, it was very easy to bet on value stocks over, let's say, quality stocks. It was very easy. But if you expect that the next day the return will, the whole idea will play out, it wouldn't have played out. But eventually it played out.
Correct. So the story about mid-cap also, now that they have done so exceptionally well over the last few months, there is this new narrative that this time, usually only at the fag end of the rally do you see mid-caps, small caps rise really sharply. But now there are a number of investors I talk to say that, this time this rally has, stronger legs, because there is something fundamentally that has changed and their longevity is more assured this time than last time. In your eyes, has something fundamentally really changed for a broadening of this rally?
So many times you're using the famous words, this time is different actually.
Yes.
You're not using those 4 words, but you said it in a different way.
Absolutely.
But in 2011 to 13, I used to tell a lot of people real estate is overvalued in India, physical real estate. So people said population growth is there. When population is going up, how can real estate fall? So I used to tell them real estate is still overvalued because the rental yield is so low compared to mortgage interest rates. So the same thing is true today in mid and small cap. Why did this happen? The reason is very simple actually. Between 2021 second half and now, who has sold maximum? FIIs. So what did they sell? They sold large caps.
Correct.
They didn't sell mid cap and small cap. Who are the buyers? Domestic. So what happened as a result was that it was only the large caps which saw selling. Correct. And mega caps which saw even more selling than large caps. So due to this reason, what happened was that it was the large cap and mega caps which corrected much, much more than mid cap and small cap.
Correct.
On the other hand, mid cap and small cap saw the benefit of SIP, SAHI, etc.
Correct.
So due to that, what has happened is it is the mid cap and small cap which have outperformed the large cap and mega cap. That's all. It's simple as that.
Right. So it's just buying and selling. There is nothing fundamentally that is really changed.
Fundamentally, there is nothing wrong with mid cap and small cap except that they have become much more overvalued relative to their past. but there is nothing fundamentally wrong with them. But this whole concept that mid caps alone will do well or small caps alone will do well, mega caps will never do well.
Yeah.
These all are
extensions
of some frameworks
yeah.
which don't work.
Correct. Tell me anything else that you can pluck out from the experience of last year. Were there any new learnings? Anything you found that was new?
I think it is important for investors to always stay rational. And that is the challenge. Like, for example, I have not understood this entire SME IPO boom. I'm not involved in it, but I'm not understood it at all. And so, that is an area where investors should show more discretion at all points of time.
Correct.
In my reading, whenever you look at any stock, what is it that I tell people to do is just look at trailing price to earnings, look at trailing price to book. You will get an idea. And you will get an idea of whether those stocks are reasonable or not. Those are all simple rules that we have used over a period of time. Those rules will still work. And I believe that, we have to always try. See, every time people think, they have to make money in the next 3 months, that doesn't always work.
Yeah.
To be rational in a big bull market is very important. And markets always give you opportunities. And that is a reality from an investor's point of view. And I think the entire mutual fund system that has been created, which allow investors to do small SIPs and get the entire benefit of the entire mutual fund system, has been very good. And you can invest 500 rupees also lump sum in the mutual fund industry.
Right.
And what's been happy is many of the large cap and flexi cap funds have also done reasonably well against benchmark. It is the mid cap funds which have done badly against the benchmark. And that is one thing which I noticed at this point of time. So it is interesting to see these kind of trends happen over a period of time. And I would have never imagined when I joined this industry in 2004 that the industry will keep growing in the pace it is.
Correct.
And what we have seen as our sponsor keeps saying, that you just focus on brand, trust and reputation. This industry will keep growing on a continuing basis, just like India has been growing consistently over the last decade.
Correct. And from an investment perspective, I mean, where do you see value today? You said in general, stocks are expensive, but where do you see pockets of value?
We definitely see pocket of value in mega caps at this point of time. If you look at the top 10 constituents of any index, the large cap index, I think they have underperformed the bottom 10 constituents of the 500 index by maybe 40-50% over the last few years. So I think mega caps are certainly very much more interesting at this point of time.
Any particular sectors or businesses that you find particularly exciting?
I think, we have had a very broad-based rally.
Right.
And that is the reason why we believe that, we believe much more in asset allocation, due to which we believe much more in hybrid fund investing at this point of time. Because we have had a very broad-based rally. Are we in a position to say any sectors? 3 years back, as you know, we used to be very positive on PSUs.
Correct.
PSUs have just gone up substantially. We used to be very positive on metals. They have gone up substantially.
Yeah.
We used to be positive on telecom. While we may still be positive, they have done extremely well. So, almost everything that we used to be positive on pharma has done well. So what has happened is that there has to be some pocket which we can say is extremely cheap.
Right.
There is no such pocket right now. So that is why we are in a phase where, you have to practice asset allocation. And there is no choice other than to practice asset allocation, because there is no pocket. Normally, when we tell people to make mega money, we want fear.
Right.
And valuation to be low.
Right.
If you can tell me which is that area where you can see fear and valuation being low, I'm happy to tell you whether that sector is very good or not. But you are not able to see any sector where the combination of fear and valuation being low exists at this point of time.
Correct. You think the best of the PSU rally is behind us? Is it overdone?
See, I would say that it has reached a stage where you have to be more selective. You cannot broadly say that you can go and invest in any stock, and whether it is in PSU, whether it is in metal, in many of the sectors which has done extremely well in the last 3 years, you have to be more selective. Like if you ask me, we are still pretty positive on all the PSUs in the power sector. Because what we see is that in power for the next 2 to 3 years, there is a problem that there aren't enough new capacities which are coming up in power.
Right.
So we are believers in PSUs in the power sector. So like that, you have to go in and look on a bottom-up basis and see whether the sector makes sense, whether the valuation implied in the current assumptions makes sense. So there are PSUs today which definitely look overvalued, whereas 3 years back, as almost as a group, they were undervalued.
Absolutely. Tell me, companies like PFC, I don't know, I've not seen your portfolio whether you own them or not, but REC, PFC and all, even today trade at decent 5-7% dividend yield. I mean, they used to be 15%, 20% some time ago. Is there something fundamentally flawed in these? Would you look at them because they've gone up 5-7 times or 4-5 times? Is it time to log off? Or, this based on the yields, they still make a good case?
So we are big believers in power generation because we believe that there's a big shortage. So could you make money in lenders to power generation and power discom company is something which requires deeper work.
Right.
Because for a period of time, people used to say that the discoms are not in good financial shape.
Correct.
So that's why it's a more complicated answer. Whereas power generation companies, there are very few of them. And all of them will have a good time for the next 2 to 3 years because there is virtually no capacity at this point of time.
Right. And how about PSU banks? Because there was severe undervaluation which has got corrected over the last 1 or 2 years. Now, I don't know, do you think they are undervalued or they're overdone?
So again, time to be selective because see, there was a superb way in which they brought down their non-performing loans.
Right.
So due to that, they got re-rated now. From here, actually you have to look at it individually and see what happens to their net interest margin. Can they continue to maintain the very low level of NPLs? So there have been companies which have declared results recently where there's almost no provisioning required because their book is so pristine. Can it remain like that forever in the financial system? Even in private sector, it won't remain. So I'm saying that it becomes, we are not in this phase where anything is cheap. So everything requires work. And that is the challenge of investing. So I keep telling people the easiest time to invest is when markets are very cheap and fearful.
Correct.
And tougher times are times like today, when markets are no longer fearful, but at the same time valuations are no longer as cheap as they were 3 years back.
Correct. But as a pocket now, for example, if you look at the banking universe, all these quality banks did very well when, 2014 to 20, when PSUs were obviously, all the wholesale banks were struggling. Today you see the reverse, even HDFC Bank or a Kotak Bank, all of them now, 2.5 times or 2.4 times or 5 times book. That's the range they quote at. Is there reason to believe they can be reset to what the kind of valuations they were used to earlier?
I doubt
was that relative gap we shouldn't think about anymore?
See, I doubt whether they can go back to the valuations that they were 10 years back. Simply because many of them are much larger today.
So growth itself.
So, at that scale to become to have very high price to book itself becomes a challenge because each of them are today much, much larger than they were 10 years back.
Right.
Does it mean that they are all secular growth stories in a country like India? Certainly. But can their price to book keep going up? The answer is no, because end of the day, they are not small. When you're small, you can have very high price to book. because they can grow at very high pace. If some of these banks were to grow at 30-40%, it would be almost impossible.
Right.
So that's the challenge that is there in some of the private banks which have now become very big right now. But does it mean is the outlook for these banks bad? Certainly not. Are they very good? Are they worth considering as investment opportunities? Yes. But can they become 4 to 5 price to book? I don't think so. I think that phase is over.
Right.
So that's why there's certain sectors, the smaller sectors sometimes are more interesting, sometimes because they can have very high valuation. Whereas some of the sectors have become mature. And that is the reality that some of the older private banks which used to have 6 price to book and 8 price to book, they cannot go back to that at this point of time.
Correct. You talked about, value growth, visibility in power. So are there any sectors where you clearly see they are in exuberant phase?
See, the reality is that we have to do the work. And see, the challenge is there is a certain implied assumption. So, for example, this entire electronic manufacturing listed companies. So, these kind of things, the implied assumptions are pretty high. So whether those companies are going to deliver on those implied assumptions or not is the question. So, I come from a contrarian, slightly value-oriented mindset.
Right.
So, I typically start thinking whether these companies can deliver this kind of growth easily over the next 3 years. They are already implied in it. So, that's how I start thinking. But it's possible that
they
we
might
are
surprise.
wrong. And at ICICI Prudential, we are trained to think to be skeptical at times.
Right.
It sometimes helps, sometimes doesn't work, because finally we are managing public money. So when we are managing public money, sometimes we err on the side of caution.
Right.
Slightly lower return with slightly lower risk is something which is more acceptable, is the framework that we are used to.
Right. Anything else where you have high degree of confidence from, let's say a 1 to 2 year perspective that they will do better? Of course, you called out mega cap companies, but any themes, for example, even IT has gone round, but not gone anywhere. Where do you see IT? Next year, definitely everybody is talking about a slowdown. Of course, all of this year we were talking about a US recession, which never happened. But definitely global growth is looking weaker. Last 2 quarters, the results have not been as analysts predicted. So there is some kind of softening in demand, deal closure and all of that. Would you still buy IT?
So I have been telling people, and people don't like to hear it from me, I believe we are in a more moderate return environment. Given that globally we are in a higher interest rate world, we have so many geopolitical issues on which we know nothing about. In India, we are in a higher valuation environment across market caps. So I tell people you will gain more by asset allocation and focusing on categories like multi-asset or equity and debt or balanced advantage. So as such, I believe that we should be in a lower, you should expect moderate returns. And most people don't want to hear that from us at ICICI. They want us to tell you will get high returns, and we tell them you'll get moderate returns. So it's something which people, I tell them, actually, 2 years, large cap has given very, very moderate returns. So now I'm saying across the spectrum, you will get moderate returns. Maybe in large cap, you will get reasonable returns relative to mid cap and small cap. But you are in a moderate return environment and people don't want to hear that.
No, true. I mean, definitely the mood on the street, retail investors is that, and that's how, just 2 days of, correction in the mid-cap rally, and the third day you saw, week before last, it was back up again. So every dip, somebody is willing to put the money there and pick up those stocks.
Yes.
So there is that kind of optimism. So, is this very clear that, this retail money is going to chase mid caps and small caps? That will be the space, because it's, because of, how do you even explain it? Today, is the Indian retail investor or even the fund managers, I guess fund managers have a bit of a problem because if the money comes into a small cap fund and a mid cap fund, you're forced to invest in that category of stocks. How does this reverse? How does the value in large caps really get discovered, or how does it start to perform? Does it mean that the foreign investors will have to indeed come back and then those stocks will go up, or some kind of reallocation can happen?
Don't worry about it. 3 years back, when we used to buy PSU stocks or value stocks or telecom stocks or metal stocks, people would ask me, how can quality stocks ever underperform? So every day, if I had started to think what will lead to this trigger, I would not have managed to think of these stocks. So I would ask, aren't these stocks cheaper than the quality stocks? The answer was yes. What happened that finally PSU stocks or metal stocks or telecom stocks or all these things outperform the quality stocks? Now no one knows. So like that, today when people ask me this question, I don't answer them because we don't know the trigger that results. In 2011 to 13, people would ask me, why should I not keep on investing in real estate? After all, real estate has done better than equity for the last 10 years, from 2003 to 2013. I used to say, I don't know what will make the trigger. Finally, it happened.
Yeah.
So what we have learnt over a period of time is, be rational, look at valuations. Like that today, for example, we don't know what will be the trigger which leads to moderate return. Maybe you have given the answer. Maybe it will be that mega cap money will come from foreigners and lead to it. Maybe that's the answer. It's possible. But we don't know for certain what turns out to be the trigger. Sure. If you ask people what resulted in quality stocks underperforming PSU stocks, you won't have the answer.
True. Any other pockets that you can call out? For example, autos, I saw you hold your top holdings are TVS and Maruti. So what is the play? Is it just you're looking at consumption and growth from a 1-2 year perspective? So those look fairly well poised in terms of growth, or is there anything?
See, if you look at the two-wheeler industry, got stuck in 2014-11. 14 to 21, there has been negative growth.
Right.
So we thought that why can't we take a bet on two-wheeler industry? People say India growth story. If you have India growth story and two-wheeler keeps declining, then where is the India growth story? That was a simple call. And if you take car industry, there was one semiconductor issue, this problem, that problem. Then some of the precious metal prices went up, which were used in making many of those platina converters and all that. So we thought there is some scope. And between all the discretionary sectors, the other discretionary sectors were all trading at 50p, 60p, 70p, 80p.
Right.
So we thought, let's take a bet on a cheaper discretionary sector.
Sure.
So that was the way we looked at it. And it worked luckily for us.
Sure. So another stock, I mean, you don't have to comment on the stock, but as a phenomena, DMart, it's a great story, great business model. The market loved the stock, but last few quarters, if you see, the story has not panned out. I mean, they're growing slowly. There are pressure points, and then we see some kind of disruption happening in that space also. So in these scenarios, how do you sort of, hold on, or how do you keep your faith in a stock?
That's why investing is difficult. I mean, I can tell you when we owned power in 2020, people told us that power is gone. I used to tell them, without power, I cannot live. So I believe that investing is not that easy an activity. There are times when you'll have doubts. Sometimes you have to believe in those doubts. Sometimes you have to disbelieve those doubts and double your position. So these are the challenges. Then you have to look at what are the implied growth assumption in that price at which you own the stock, or you currently the share price is. So that's how investing is about. And if investing was arithmetic, then we wouldn't be needed. So that is why it becomes complicated. And that is where I can tell you there were people who told us this quick commerce model is gone. But now suddenly now people tell us quick commerce is working. So now I don't know what changed in 1 year. People are now accepting quick commerce is working. Now 1 year from now what people will tell us we don't know, and how we will also change we don't know. So that is the beauty of investing, which makes us come every day to work, and we'll have to keep thinking what we thought yesterday, what we thought today, and somebody will tell us how you change your mind suddenly on this and that is the challenge, and we have to do better for our investors.
True. So talking of quick commerce, what are your thoughts on the, all these new age companies, Zomato, Paytm, PB, Fintech? All these three stocks have done exceptionally well. Nykaa, I think, is an exception, is not. So what are your thoughts there? Are they in your radar?
So we look at every stock and think about it on a bottom-up basis. And some of the new age stocks we own, some of the new age stocks we don't own. And I always tell people I'm not the only person looking at them. I find some of my younger colleagues do a better job of looking at them. See, it's like, each person, sometimes you don't understand how the younger people think of these sectors, how they use those products, etc. So we have garnered and utilized the knowledge and the thinking of the younger generation in looking at these stocks. Otherwise, maybe would have missed some of these opportunities. And so that's why I don't alone take these decisions. It is taken by some of my colleagues, and we have made money in some of them.
Wonderful. But what is the framework? I mean, what is the framework that they have come up with to evaluate? And
the framework is that you have to look at the industry. You have to look at how many players are there in the industry. Is there a long-term plan to make money in the industry? Is it a long-term plan to make money for the shareholders of the company in the industry? Then you have to understand all these things and then see whether it fits in. Then you have to see who's the seller in the stock. If you look at some of these stocks, they had private equity which needed to sell at any cost. So we used all these technical overhangs were there in some of these stocks. So we used all these frameworks to think about it. Did we miss some opportunities? Yes. Because of our own ignorance? Yes. Did we capitalize on some of the opportunities? Yes. Both happened.
Sure. One last question, which is, Jio. So do you see Jio really coming and disrupting the financial space? Is there a possibility of...
talk about a company which is entering the mutual fund industry and you are asking me to talk on it. That is very tough. See, I believe that, India has one of the best services infrastructure in the world. I think, I can tell you all my classmates tell me that India has the best infrastructure in the world. So I think due to that, you have more and more players entering every services industry. And due to that, we have a buoyant services industry. And as a mutual fund, when we are servicing our customers, we have to keep on preparing ourselves to handle our customers better and better. That's what my CEO says, and my CEO of my sponsor also says that. So that's what we have to keep doing. But otherwise, I can't talk on the question that you are raising.
Sure. Fair enough. Your top 3 picks for this year?
My top 3 picks have been very easy. I've been saying people, you have to focus on the hybrid category. And in the hybrid category, there are 3 categories which we like. One is the multi-asset category, which has gold, InvIT, REIT, exchange traded commodity derivatives. Then you've got the balanced advantage category, where we have keep on talking in a boring way all the time, every day, morning, afternoon, evening. And we've got the equity saving category, which is a bit more conservative. These 3 we keep talking. Actually, the 4th is equity and debt category, which belongs to the aggressive hybrid category. So we believe that this hybrid category is the way to put money for the long term. And what happens is, by investing in them, these categories are very, very interesting investment opportunities. And over a long period of time, I believe that these are all buy it, shut it, forget it, based on the riskometers that the regulator has rightly told us to talk about. That is my...
And for anybody who is investing directly in equities, what would be?
Investing directly in equity, I don't give ideas on directly in equity. I would tell them, unfortunately, so far we have only equity ETFs in the thing. So I would any day recommend a 500 ETF. The reason being that Warren Buffett was asked once, which is the best way to invest for the long term, for a 50-year period by somebody. So he said that the best way is to invest in a large number of stock ETF and a treasury. So that is a 500 ETF. So because if you invest
So
in
you're saying a mix of a broad-based ETF and treasury
and a gilt ETF.
Okay.
That is what he said. So I would say that that is what I would also recommend. We don't have a gilt ETF, I think, in our company. But this combo is what he recommended to people in US.
Okay.
So since he is both your and my all-time guru, I would say go with a 500 ETF and a gilt ETF.
Sure. Wonderful talking to you as usual, Naren. Thank you so much for your time.
So wish everyone a very, very happy, prosperous Diwali.
Absolutely. Thank you so much and same to you.
Thank you.
And welcome to Money Control. Well, as part of our Diwali special conversation series, I have yet another astute investor to talk to us today, reflect on last year and crystal ball gaze into the next year. Shankar Sharma. Shankar, thank you so much for your time this afternoon.
Thank you very much for having me, Mahalakshmi.
And where are you right now? You're not in India, you're in Turkey?
No, I'm going to Turkey next week, but I'm in Dubai right now.
Awesome. Thank you so much for joining us.
Likewise, and always a pleasure to speak with you, and a very happy Diwali in advance to you and all the viewers of Money Control.
Absolutely. Thank you so much and wish you the very same. So first of all, Shankar, just reflect on the last year, because at this point in time, if you look at it statistically, just look at the math of the last year to this Diwali, nothing, the market has done nothing in terms of Nifty. But it looks like a lot happened. You saw sub 17,000. There was so much fear on the street in March. And then stocks were going up like there is no tomorrow. In the last, few months, the mid-cap rally has been so sharp. So we've somehow seen, a lot of fear and perhaps some amount of greed in the last few months. How do you stack all this up? In terms of experience, was there anything new for you at all? So just take us through how you went through this year.
So it's interesting you mentioned the fact that last 1 year on the headline indices, the major ones, it's flat, and which is actually a fact. And in fact, if you go back even 2 years, I don't think the change is anything very remarkable.
Correct.
Both on Nifty as well as the Nifty. And that is primarily due to the fact that the banks and Reliance in particular, which probably are in aggregate maybe 55% of the index, have done nothing much of note in the last couple of years. And what was doing well were really the Adani Group companies, which had driven the Nifty up in the prior period. And obviously in the last, 1 year or so, that group has also been flattish to a bit down perhaps. So net, the market on the broad basis, if you look at the indexes, they have done nothing. But the point is, today I can see my net worth from last year to this year, it is substantially up. So the point is that, and I'm sure I am, along with millions of other investors who have become much wealthier in the last 12 months, despite the main market indexes not having done anything at all. And that's where is the interesting disconnect between large cap investors and small to mid cap investors. And for my personal investing, I do not look at large caps. And frankly, I'll be honest with you, I don't even know where the bank Nifty is trading at right now, if you ask me. I have no interest. I have not owned banks for a long time. I have no interest in owning them, and I have no interest therefore in the bank Nifty. And I don't trade FNO anyway. But I know prices of 200, 250 small cap, mid cap stocks, because that's where the action has been. And that action has been mind boggling, to say the least. It has been, like I said, tremendously good for my net worth, as it has been for many other people's net worth. So, I'm not complaining, Mahalakshmi. I'm feeling very happy this Diwali, to tell you the truth.
No, absolutely, because this mid-cap rally, even if you look at it from the domestic mutual funds perspective, because of lot of money has come into mid-caps and small caps and the traction has been there, at least there is a feel-good both amongst investors who have put in money in these funds as well as people who have participated in this rally. No question about that. So there is a section of the market, and notably a lot of fund managers think that because the last 2 years large caps have not done well, those valuations seem to be looking more attractive than mid caps and small caps. I know you don't invest in large caps, you just said it. Do you see value there at all?
I'll be honest with you, Mahalakshmi. I remember a meeting, and there was a round table in Bombay organized by a newspaper where there was a similar debate a few years ago. I'm thinking more like 2016-17. And my view at that point was that, again, I saw small caps as doing much better than large caps, and the CIO of a large mutual fund, who's a very old friend of mine, became very violent in that meeting. When I said this, short of catching hold of my collar and saying, no, small caps cannot do well, large caps are the only way to make money in India, he did something else. And I was frankly taken aback in the beginning. But then I figured out that, look, for an asset manager, you don't make much money on the fees when you manage small cap funds, because by size you're limited. To get a 15,000 crore AUM in a small cap is impossible to get, and more than that, if you get it, impossible to manage because of liquidity and all.
Correct.
So you're predisposed to being bullish on large caps because that's where your bread is buttered. So a lot of the noises you hear from asset managers, fund managers, the large caps will not do well, is a hope trade. It's a hope trade coming out of their own incomes, their fund management companies' incomes. It has nothing to do with the reality of what might happen. I just want to make this point very clearly to viewers. There are a lot of things which are said are driven by personal biases and personal interest of the people talking about it. I don't have any axe to grind either way for large caps or small caps. It is my belief small caps in India are the place to be in. And I say this because I am fundamentally of the view that large caps have hit a certain size ceiling, at least for a while to come. If you look at profits of an HDFC bank or a Kotak bank relative to, or banking in aggregate relative to GDP, you are at numbers which are astounding for still what is relatively a poor country like India. And therefore I believe that small caps have still got a lot of headroom to grow versus large caps, which are probably hitting the ceiling of their immediate near-term growth outlook. And that's where the whole discussion lies, that I think growth numbers will continue to surprise on the upside for small caps, while not so much for large caps.
Okay, I take your point on that. But statistically, if you see, last 20 years, we did the math and saw that, if you just look at 2003 to 2023, largely mid-cap indices, I'm not talking about specific stocks, the mid-cap index returns versus the Nifty is pretty much the same. It might be 1%, which you can still say that, the compounding of even 1% over long periods can be substantial. I'll agree to that. But largely, returns have not been very different. And what works against them is the fact that, there are periods of volatility or sharp down move, which sort of takes that away from, that compounding effect away from mid caps. And I think with retail investors, that's, for astute investors like you, that makes, you know how to navigate it. Tell us, how does a retail investor look at it and navigate it and emerge out of this profitably?
No, you're 100% right. On the long-term basis, the difference between mids and the smalls is not sharply different, and in small and mids you get a lot more volatility.
Right.
I get that point. That is not in debate, because that is data. It's not a matter of my personal opinion. That's what the data says. But that's the point. History cannot always be a perfect predictor of what the future holds for us. Okay? Particularly in a country which is still in a fairly strong growth phase like India. In both stable state countries, you can make a reasonable prediction of the future based on history. In India, I'm not sure that is a very smart way to do this. The reason being, and I've said this earlier on your shows as well as on your sister channel shows and other places, India today is a $3.5 trillion economy. It is adding $200 billion or thereabouts in GDP value every year, which was the entire GDP of the country when I entered the business in 1989. Now, what that does is a very important thing, and that's where the whole small cap story rests, long and short of it. $3.5 trillion divided by 5 regional parts of India, average $800 billion or so per region. It's not obviously equal. Different regions have different GDPs or GSDPs, but I'm just simplifying this for the purposes of this discussion. $900 billion per region. That is 4 times the size of the country I started my business in 89. 4 times the size of India itself. Think about it, right? Now, the point is this: companies which are only focused on servicing their own individual neck of woods, which is North India, Central India, East India, South India, Western India, they are now getting a market that's 4 times the size of the country that I came into as an entrepreneur. That means, and this is, by the way, the same size as Saudi Arabia, which is $850 billion, same size as Turkey, $900 billion. Each part of it equal to large countries, much larger than individual European countries. Therefore, small caps don't have to become pan-India plays for them to deliver very good top line and therefore bottom line numbers. They can operate in Calcutta, sell to Orissa, they can operate in Kerala and sell around southern India, and so on and so forth, and yet have markets large enough to drive 500 crores, 800 crores, 1,000 crore top lines, 100 crore bottom lines. 100 crore bottom line will trade at 3,000 crore market cap. If I've been lucky to buy some of those companies when they were 500 crores, I'm sitting on a 5x, 6x profit. That's the reason why I like small caps now. In aggregate, $3.5 trillion is a large economy. But when you break it up to individual parts, these sizes give you enough growth options as a small company in just one part of the country. And that is where this whole last 20 years being extrapolated to the next 20 years may not actually hold true. That's the reason why I say the past may not predict the future perfectly in the case of India and where we stand right now.
And so are you talking about regional players because the regional markets are larger, or are you talking about, regional players actually going for pan-India growth?
I'm saying regional players staying with regional growth. That's it. That's the play I am focused on. That's the play that has been excellent for me in the last 2 years' time. I'm not interested in pan-India companies because pan-India companies have to work with pan-India issues. And regional players are very strong in their own regions. Like, for example, I was talking to the jewelry company in West Bengal. I mean, they are opening shops in the smallest parts of West Bengal, and that region with Titan will not find it economical to open up in. Because at their overhead, their cost, it's not viable. But for a small, low-cost regional player, it is very profitable, and the company makes a decent margin selling just to the so-called underprivileged parts of India. So that's the point, making the case that the long-term returns of the past, that there's not much difference between small and large cap returns, may not hold true in the future. Not hold true.
Sure. So that is the growth aspect, Shankar. Now, again, statistics that got revealed, and we also reported on it in Moneycontrol, the fact that there are about 420 odd active mutual funds in the country, but the universe of stocks that they invest is only about 380. So, of course, from the fund's perspective, there are the rest of the universe is less liquid, so they can't hold large positions. That's not a constraint that individual investors have. But in terms of governance, how do you sort of evaluate, and how does an average investor navigate this? Are there any thumb rules that you would suggest for investors to follow?
We have got a good example in case of a recent company which you and I have discussed. We can, as minority investors, we do not know beyond what is reported publicly. What the company does behind the scenes is impossible. Even auditors get fooled. Forget about us holding 1%, 2%, or even independent directors get fooled. So that is a risk you have to accept. Rather, why even small caps? Even in large cap companies worldwide, there have been enough blow-ups. I mean, Enron and WorldCom were not tiny companies. They were held by marquee investors.
Right.
They had auditors which were Arthur Andersen and stuff like that. So we accept it as as an occupational hazard. That's an occupational hazard as equity investors. And let's not, get too fussed about it. The fact of the matter is that we assume that this will not happen to 100% of our portfolios. We might have bad eggs, maybe 1 or 2 or 5% of the portfolio. If we lose 50% on that, we are still okay, because on the ones we will make money on will more than make up for the bad eggs. I mean, that is the only way you can live with the bad eggs in your portfolio. And you will have a few. And the smaller cap the company, the smaller the cap of the company, the more the risk, because they're untested. We don't have enough data governance. And a lot of managements also, as far as I can see, have to go through a cycle of misgovernance to improve back into governance. Okay. And they believe that they are smarter than the market, and then they can fool the market, they can fool regulators, they can fool agencies. Then they realize कि नहीं boss, ऐसा नहीं होता है. But एक बार problem, then they have a second coming. Okay. Right. So I mean, Mahalakshmi, we will all get taken for a ride. Accept this. I accept this. I have limited view of. I own probably 40, 50, 45 stocks, maybe 50 stocks in India. Am I 100% sure of what they're doing behind the books? No way. Am I sure that 1 or 2 will come up with very shocking things? 100% sure of that. We just hope remain at 1 or 2 and not 50% of the portfolio.
Right. So, are there any questions that you ask? Again, Shankar, anything that take us through your checklist?
The checklists are very simple. We look at obviously the quality of the board, that is of reasonable value. But more than that, I'm not saying big 4 or big 6 are some holy grail of good auditing. They have made enough. In Satyam, we had Pricewaterhouse, Enron and WorldCom had, Arthur Andersen at that point. In Byju's, we have seen Deloitte, do things which I would imagine are not possible. So, the fact of the matter is that there's no guarantee that even a good brand name auditor will be able to protect minority shareholder interests. But tax payments are critical, very critical. Company paying tax, full tax is a decent bet. Company paying dividend, even better. These 2 hygiene checks, if you broadly keep in mind, I'm not saying it's 100% foolproof, but back of the envelope, tax payments and dividend payments would ensure that the company is generating cash and not just accounting profits. And that is a good enough reason to buy a small position in a company from a retail investor standpoint. That's back of the envelope. That is a hack, I can tell you.
Sure. And any segments that you find particularly interesting in this space? Take us through. Even if you don't want to name, take us through some of the stocks that you're really bullish on.
No, so I am, like I said, there was a period in the last 2 or 3 months' time when I was very concerned about market levels, and more importantly, fairly uninitiated people making a lot of money.
Yeah.
Okay. Those things typically don't end well. We have seen that. I'm not saying they are ending right now, but at least for experienced investors like us, that they begin to sound an amber kind of, show an amber kind of light. And the markets did then undergo a very, very sharp and a brutal correction. Okay. Things look like being stable. Numbers of many companies that are coming out are still very strong. Even the fact is that some of them have corrected, yet numbers are very strong, which sets up the market for a good move hereafter. I am not a believer in going sectoral in small caps because people say defense companies or railway companies. I'm not a fan of that approach at all. At all. I would caution against that. Because these are in small caps, the sectors are yet to be fully formed. They're not like large cap sectors which are very discrete and easy to identify. You get boxed into what is the current flavor of let's say the season, like railways has been or defense has been. I think you should be very cautious about. You might own one or two, but don't put like all and most of your portfolios into sectoral plays in small caps. The beauty of small caps, Mahalakshmi, is that it allows you to buy a very wide range of companies.
Right.
Very wide range of companies. I mean, I just bought a company which is into marketing technology. We call it Martech. Okay.
Right.
They sell garments, but they also manage through their algorithms the marketing tech for a large online retailer. Now that's an interesting space. Now, what industry do I fit it into? Do I put it into garments?
Right.
Put it in tech? God knows. So I'm not getting boxed into all this. I like to buy companies, good outlook, decent valuations, and then we leave the rest to God.
Right. So tell me, what are the narratives in the market, Shankar, that you won't buy today? There are lots of narratives. For example, you talked about railway story. There is also the defense story. There is the power story. So many of these, even if you look at companies within those baskets, each one will have a very different model. But as narratives, what do you bust?
I definitely like to stay clear of public sector companies. I know they have been in very, very strong flavor, and I like to stay clear of companies we do business with the public sector or the government. By and large, that has not worked out well. And now, hey, maybe I'm too old
because
for
of the
this.
Receivables problem, because of the
payment problems, kickback problems. I mean, the whole gamut of things that you need to do as a company in order to win business from the government. And irrespective of any government, all these things happen. They happen. They happen today. They will happen. They happened yesterday. They will happen tomorrow.
But that is also the segment that has got truly re-rated in the last 2 years, right? Because government was the biggest, spender in the industrial space, and a lot of small companies' balance sheets actually got repaired only because of the strength of government orders.
I agree. But that's the point, right? The beauty of this market in India right now is that while for mutual funds there is a limitation on number of stocks you can own.
Yeah.
For high net worth or substantial investors like me, forget about lower size investors. You are spoiled for choice, Mahalakshmi. I mean, you have literally hundreds of companies to choose from. So we don't have the mutual fund problem.
Right.
So why do I need to necessarily buy what is in flavor and where I'm not comfortable with?
Right.
I can buy things I'm comfortable with. We take risk. It's not that there is nothing. I mean, there's no risk in the stuff I buy. I mean, I like to take risk in my investing. That's well and fine. But not a particular kind of risk like companies dealing with the government of India. Okay. I have many other companies that I can do business with. I mean, I'm not invest in and make a fairly good return. But my view is that anything to do with the government, it depends on government policy, number one. Number two, it depends on budgetary allocations. And you don't know what the next budget might, even if railways, the finance minister says the growth is not so much in the budget, these stocks can crash 30-40%.
Right.
Same with defense.
Right.
So they are very sensitive to government policy. That's the point, to budgetary allocations. And that makes it a very high risk play from my perspective.
Sure. And so fine. So you said PSUs is a no-go. Anything else? Banks, you said you have no exposure to banks at all. So again, I mean, is this narrative as the economy grows, if we were to look at 6-7% growth on an ongoing basis, how can you ignore banks at all?
Please don't say this, Mahalakshmi. I remember in 2007, the same story was talked about infra. That if India has to grow 6-7%, infra has to grow.
Right.
Well, India has grown 7%, but trust me, those infra companies don't exist anymore, or most of them.
Right.
So India will keep growing irrespective of what happens with the banking sector or the infra sector. Some newer players come up. like I said, they are already, the good ones are of a size where in order to grow, they will necessarily need to take more risk. And HDFC Bank's NPA numbers that came out a while ago, we know what kind of reaction that elicited. So, the pool of lendable retail assets, nobody wants to lend to the corporates, none of the private sector banks. They're not interested. Everybody is chasing the retail loan segment. In that, the bankable retail loan is probably done and dusted. So you're going to the unbankable or moderately bankable, which is the unsecured part, which has become like a larger and larger pie of incremental bank lending. That's what makes me extremely uncomfortable. Extremely uncomfortable. These blow-ups happen in banking worldwide. We will be no exception. Mark my words, in 2 or 3 years' time, these same loans will come back to haunt these banks. I will be then around, hopefully, to pick up these banks when they're trading closer to book value rather than trading at 2.5 or 3 times book value.
So, but the fact that, for example, a Bajaj Finance, has such a remarkable track record of, managing an unsecured book for such a long time, does it not give you the confidence that, yes, this business can be done? Or is it sheerly because of the base that you think that now it can't be done?
I mean, I'll be honest with you, I think Bajaj Group is the best, absolutely the best managed group in the country. I mean, I've said this for decades. Okay, so this is no comment on Rajiv Bajaj or Sanjeev Bajaj as entrepreneurs or the late Rahul Bajaj. I mean, I've considered them to be fantastic business people, very capital efficient, focused on bottom line, focused on cash flow, focused on risk. I'm a fan, let's put it this way. That said, when you reach a certain size, you necessarily will go off on the risk spectrum. Okay. Earlier, Bajaj Finance could grow because the pool of lendable assets was there. Maybe now they are getting close to what is now the ceiling of that. We'll see. I mean, let's say I'm a fan and I hope they defy my skepticism, not just on Bajaj Finance, but I'm talking retail lending as a business itself. But I want to be taking that risk. If other people want to do that, they're welcome to do that. That's absolutely fine.
Fair enough. Okay, talking of the, of global macros, the last time we spoke, I think, was in March, and you were telling me that largely the worst of the interest rate cycle is behind us because statistically, we will be looking at numbers based on last year's high base numbers, and therefore the inflation trajectory will be down, and therefore the interest rate cycle will also reverse. Now there are again, fresh concerns. There is this Israel Hamas, conflict that has come up. Once again, we are, the market is somewhat nervous about what is to come. Labor market continues to be strong. Does this worry you, or do you maintain your stance?
Well, I mean, again, somebody told me, I don't know whether the statistic is correct or not, the world is right now undergoing 13 wars, big or small, which is quite a number. But at least we know of the 2 big wars. And I can't remember the last time when we had 2 major conflicts going on simultaneously. All of that is, and, they are in oil and gas producing areas, be it the Ukraine or the Middle East. So unfortunately, they are in that region where that drives inflation to a large extent in this world, which is energy prices. So obviously in March, we never knew that this was going to happen in Gaza. These problems have kept the Fed on tenterhooks. And I mean, not with you, but with Prashant, I remember like a couple of years back when the rate cycle had not started tightening, I'd said that the Fed has been extreme. I think that was 2021 March or April. When I said that they will have to tighten because they have been too loose, and when they tighten, they will not stop at moderate tightening. They will go
overextend. Right.
They will overextend. They will overcorrect their laxity of the previous 10 years, and that's exactly what they did when they went from 0 to 5.
Yeah.
And that's where we are now at. Now they're just making noises that we'll stay put and all that. But these new problems are not helping the cause. I doubt if they're in a position to raise things because we know the problem that average mortgage rates are causing in the US. We know the problems of high interest rate, but we know the strain it's putting on bank balance sheets for that matter in the US. I don't think the Fed can raise. So it's literally between a rock and a hard place. I'm glad I'm not the Fed Fed governor, to be honest with you.
Right. So the probability of raising rates from here, you would say, is zero? And
Nothing is zero. I would think it's next to zero.
Next to zero. And the possibility of a rate cut by June, is it possible to hazard a probability to that?
They say a week is a long time in politics. I think it's a long time in markets. You're talking now 6 months or 8 months.
But then markets are looking ahead, right? I mean, you say this more often than I would ask you, that markets are already looking 6 months, 1 year ahead.
I can probably hazard a guess that you might get a beginnings of a rate cut in June, because that's still 8 months out and a lot of water can flow under the bridge. But you don't know about this war in Gaza. I mean, the Ukraine war is probably now more discounted, but the Gaza war is becoming seriously problematic. Of course, that also means that there can be a ceasefire. So, it's more violent. It's more in your face. The pictures are much more damning than the pictures from Russia, Ukraine. So, yeah, there is a case to be made for a ceasefire. We'll see. June, hey, it's long enough out for us to be optimistic and say there can be the beginnings of a rate cut.
Sure. Elections next year, do you think the markets will start, what is the market assuming right now? What could be the potential risks? Because you look at various reports, people are talking about 20 to 40% risk to markets in case the current administration doesn't come back with the strength that they need to form the government. Would you agree with that? What are the other possibilities?
We say this, Mahalakshmi, I am bullish on India. Baat khatam. It doesn't matter which party runs this country. I can tell you this country is destined for greatness. And that's my simple one-line view. I'm not interested in getting into the politics of who will do better or worse. I think we have been blessed as a country to have had great leaders right from independence up until now. And it will happen 50 years from now, long after, hey, I don't think I'll be dead by then, but let's assume that I'm around. We'll still have great leaders out there, and India has got a growth path which is so clear in my mind. Given our low rates of per capita GDP, we need to be there at 10,000. The energy of the people, the entrepreneurship of the people, the creativity of Indians. I mean, what can stop this country? I mean, there can be temporary speed bumps. The BJP doesn't come, Congress comes, or some other. I mean, maybe we get a 10% down day. I don't think that's going to happen, by the way. But, I mean, I'm not saying which party comes. I'm saying the markets won't fall because markets have seen what other parties have delivered. So let's not waste time looking at which party comes to power. I'm bullish on India.
But in the short term, markets are always like that, right? They will sort of react to these things because there is an assumption that all this growth and everything that we are factoring in terms of public spending, fiscal prudence, whatever it is, there is a certain premium that India has got because of this narrative. Isn't that
India
correct?
Good premium. I remember 2007 in Davos, India was the toast of Davos. It was India's decade and India's century. 15 years on, it's exactly the same story. It's just that we have recency bias. We think that India suddenly become the toast of the world. No. I'm sorry. Let me correct you. Back when the BRICS story was formed, and within 5 years of the BRICS story, people realized that only India and China are the viable, sort of part of the BRICS formation. And now China, because of its own problems, has fallen off, and India is the only man standing, or let's say person standing. India is destined for greatness, irrespective of which party rules it.
So you're saying, irrespective of election outcomes, the market's not going to react to that?
Even if it reacts, I think that's going to be the
Temporary.
buying opportunity the decade, like it was in 2004.
Fair enough. And what is your prognosis for the entire year? By next Diwali, what are your predictions? Where do you see the markets? What do you see as outperformers? Where are you putting your money?
I think I'll be richer next Diwali than I am.
That you are every year, irrespective of where the market goes.
No, I pray that, like me, there will be millions of, medium, small, big investors talking the same. Mutual funds, like I said, have a problem of the large caps. I'm not so sure large caps are going to deliver substantial, let's say, inflation-beating returns. But hey, for millions of investors, large caps are probably not the right place. I think it's going to be the small caps. As long as you've chosen 15, 20, 30 good stocks, assume 10, 20% will go bad. The rest will make you substantial money from now up until next Diwali. I'm very certain of that.
Sure. So 25,000 by next year, will you bet on it? On the Nifty?
In percentage terms, I'll bet on small caps delivering that. Nifty maybe half of that.
Okay, okay. So this is not a question, Shankar, but please sing us a song describing last year and a song which captures your sentiment towards next year.
My God, why do you keep putting me in this very difficult situation?
You are the Mohammad Rafi of the Lal Street, so.
Okay, so now that you mentioned Mohammad Rafi, okay. I'll sing one Mohammad Rafi for the last year. Okay. तेरे मेरे सपने अब एक रंग है हो जहां भी ले जाए राह हम संग है हो तेरे मेरे सपने अब एक रंग है हो जहां भी ले जाए राहें हम संग हैं तेरे दुख अब मेरे सुख अब तेरे ये दो नैना चांद और सूरज मेरे ओ मेरे जीवन साथी तेरे मेरे सपने अब एक रंग है हो जहां भी ले जाए राहें हम संग हैं. Okay.
Awesome. One for next year.
Okay. किशोर कुमार. पल पल दिल के पास तुम रहती हो जीवन मीठी प्यार ये कहती हो पल पल दिल के पास तुम रहती हो कल तुझको देखा था मैंने अपने आंगन में जैसे कह रही थी तुम मुझे बांध लो बंधन में ये कैसा रिश्ता है ये कैसे सपने हैं बेगाने होकर भी क्यों लगते अपने हैं मैं सोच में रहता हूँ डर डर के कहता हूँ पल पल दिल के पास तुम रहती हो. Okay, done.
Wonderful, wonderful. Thank you so much, Shankar. Such a pleasure talking to you and of course listening to you even more. Thank you so much. Wish you a very, very happy Diwali.
Likewise to you, to your family and all the viewers of Money Control. Have a fantastic Diwali and a fantastic next year, guys.
Thank you so
Bye.
much. Bye. Hello and welcome to Money Control. Well, continuing with our special conversation series on Diwali, I have yet another market veteran, Nilesh Shah, CIO of Envision Capital. Nilesh, thank you so much for your time this morning.
Thank you. Thank you so much, Mahalakshmi. It's a pleasure to be here.
Absolutely. So, first of all, take us through your experience this past year. You know, what went right for you, what went wrong for you, any new learnings?
Well, it's been a wonderful year. It's a wonderful year for all. It's a wonderful year for the economy, for the markets, for all of us as investors. Mostly things going right. It's one of those very odd years where not too many things have gone wrong. In terms of what has worked well this year, essentially is the entire capital goods space that I believe is worked out quite well. Some of the bets on the digital side, they have worked well. What has not worked as well is the consumer staples piece, especially businesses which are more focused on the mass market. That essentially has been languishing in the year gone by, but thankfully those are the things which have not worked are probably smaller in proportion to what has really worked.
Tell me, I mean, this year really feels like a year of two halves, right? Till March, there was almost like fear on the street, especially in March, right? We went sub 17,000, and then there was this huge rally in mid caps. Till that time, you know, even in March, starting of March, if you had asked somebody whether this was in the offing, one couldn't have seen it coming. So, what was that period like? And today, is it starkly different, or are you seeing this as some kind of catch up, or have we got into some kind of an exuberant mode?
Well, it's probably a combination of both, especially in the post-COVID period. The mid and the smaller companies, or the tier 2, tier 3 companies in any sector and across sectors have been performing exceptionally well or significantly higher than their large cap peers. You look at the technology space, the tier 2, tier 3 companies have done a lot better than, say, the big technology companies. If you look at banking, the smaller banks have performed better on all parameters versus the larger banks, and this is true for sectors across the board. Also, we were coming out of a period from October 21 to about the end of 22. Where the mid caps, small caps had gone sideways. You could call that more a risk off mode of the market. And so when we were in the early part of 23, we had a situation where the mid smaller companies had grown exceptionally better, stock prices had not moved, and therefore there was more value.
Correct.
And what we have then seen is sustained performance in terms of businesses from there on, and a lot of catch up in the stock prices as well. So it's been a combination of all, where valuations were attractive, growth, capital efficiency, the texture of the balance sheet, they all were a lot of better. And Mahalakshmi, one more thing is that the mid and smaller companies have significantly upped their investor communication. Versus remaining in a shell and remaining undiscovered. They have caught the attention of fund managers and investors, thanks to also the kind of proactiveness with which they have been communicating. So it's been a combination of all of these things which probably have conjured up around the same time.
So, but tell me more about this, because this is a very interesting point that, you know, companies have upped communication. So is that good or bad? Because, you know, when promoters and obviously, you know, because there has been so much money that has been made in equity markets, and many of these entrepreneurs are also, promoters are also investing in markets and making money, right? So if they up communication, is it like talking up the story, talking up stocks? What do you make out of it?
That's inevitable. Okay. That's probably, you could call it the side effect of this initiative. But the good part at least is that you are under a much larger scrutiny. You are under much wider scrutiny. You are open to being questioned. People are trying to understand your businesses in a very different way. Most of these earnings calls, I think there are very pointed questions around how is this quarter going to be, how's the next quarter going to be, how has growth been, why is it lagging, competition, margins, cash flows, governance, so many things. So the positive side of it, I would look at it, is that I think managements are essentially not just saying this is my business, please keep off, versus that I think they're saying is, look, this is my business, but please feel free to ask me what you want, and I'm open to public scrutiny. And that to me I think is a positive step, or I would probably call this a a giant leap forward from those hundreds or thousands of mid and small cap companies, and that I think bodes well, that augurs well.
Right. And how do you read into, there was this period, I think around August or so, when there were a lot of block trades that happened, a lot of promoter stock got into the market. Of course, private equity also, because they were looking for exit. So how do you read into promoter blocks coming into markets and in such large numbers?
So yes, I mean, a supply of anything is always not necessarily a good thing. And there are two things. One is that there are buyers who want to buy, and either you issue them fresh stock. Obviously, the company takes in capital, but if the company doesn't need the capital, what does it do with it? So that can either lead to your capital efficiency getting more subdued, or it could lead to capital misallocation, and you would end up taking suboptimal decisions or decisions which are potentially disastrous from the long-term trajectory. That's one side. The other side, of course, is saying of course there are buyers. And there are promoters who essentially are willing to oblige and give the stock, which I think is less of a problem versus companies issuing capital, taking money when they don't need the money. I think also, Mahalakshmi, for a lot of the promoters, it's been a long, arduous journey of 10, 20, 30 years of having built a business.
Right.
Okay. I think it's only fair that they basically chip away, they take some money off the table so that they and their families at least are financially secure.
Right.
And I don't think one should grudge them against this.
Right. Right.
I think that's perfectly.
No, it is not. It's not about grudge. I think it is about signals, because most of the time insider sales is interpreted as a sign of market speaking out or a business speaking out, at least in the intermediate term. So in that context, should we be reading it like that, or are there other dynamics at play? So we shouldn't read too much into it.
So I think, Mahalakshmi, in several of these cases, the markets have positively surprised even the promoters themselves.
Right.
Okay. I don't think any of the promoters thought that we would one day become a $100 million, $1 billion, $5 billion kind of company. Maybe also in their minds, probably they think that yes, it's been really good. Might just be a good time for us to essentially take away something and essentially at least be financially secure. I think in most cases it's more about these promoters having come a long way and wanting to now be financially secure. I think it's more of that rather than them saying is that this is, because if they thought that it's now this is the peak or this is the end of it, they probably would want to look out for strategic sales. And we're seeing is that strategic sales, which is complete lock, stock and barrel wanting to sell out, those transactions yet are very rare. I would probably get worried when, promoters wanting to completely sell out their business, that probably might be a more worrying sign than, them wanting to just sell off 2%, 5%, 10% of their business.
Sure. Another big picture question before we get into, sectors and stocks and pockets of value, etc. Is this, there is this a statistic that was in focus a couple of weeks ago, which is that, there are about, 420 odd active mutual funds in the country focused on equities. And the number of stocks, the universe of stocks that equity funds put money in is just about 380 odd or something. And this number itself, over the last 15 years has not gone up. It was about 250, 260 about, 15 years back. Today is about 380 or so. In comparison to that, if you look at the assets under management in mutual funds, overall AUM of the mutual fund industry, even as far as, 2013 or 2014 was not more than 7 lakh crores. Today it is 45 lakh crores.
Yes.
Of course, that time also maybe about 60% would have been in equities. Today, it might be just about the same.
Yes.
So when you look at the leap in the assets under management and the leap in the markets, it looks like assets under management have gone manifold. Markets have gone, at least 4 times. And stocks, the universe of stocks they invest in has gone up not even twice.
Right.
How do you explain this? And we say that, there is a large runway of growth. There are huge opportunities. How do you explain the fact that the universe of stocks that, institutions are willing to put their money in continues to be just less than 400?
So, well, yeah, that's a very interesting perspective. I think for all mutual funds, no matter what your size is, there's a limitation to the number of stocks you want to buy or you have in your portfolio. So it doesn't mean that if your size was say 1,000 crores invested in say 25 stocks and suddenly tomorrow you become 20,000 crores, it doesn't mean that you are going to have 25 into 20, 500 positions. You essentially will still be, probably that 25 will increase to 30 or 40 or 50. Okay, so I'm not too sure if that's the that's probably the appropriate way to kind of look at the situation. Number one. Number two, no matter how big your universe is, your investable universe is not going to increase in a proportionate manner, because you're still wanting to put your money to the best performing companies. Okay, in the assessment or the judgment of the fund manager. It's not necessarily that if there are more companies, you're going to go and put your money into more companies. You're still going to be cherry picking and picking those businesses which are performing the best. It doesn't mean that the businesses you don't own are not growing or are not good companies. It's just that probably in the pecking order, they are not as great as maybe the top 30, 40, 50 or 100 companies. So I think mutual funds or any long-term investors will always be selective irrespective of their size. Now, yes, in the process when you end up going and buying the same set of stocks, the stock prices are bound to go up, and that's unfortunately, it does happen. That's one more side effect of an uptrend or a bull market.
Sure. So a related question to this is, we use this term loosely, that too much money is chasing too few stocks and therefore the valuations are going up. Now, based on just this analysis or this thesis, is there a case for us to get accustomed to higher valuations because there is more money that is going to get apportioned over the same set of stocks or similar number of stocks?
So my take on this is that over a period of time, valuations come in from essentially the intrinsic value of the business.
Right.
Liquidity and some of the other things, sentiment, are all only enablers. They are only hygiene factors. But the core essentially is the quality of the business, growth, the capital efficiency, the capital allocation and the governance. These are the only drivers of long-term value. And my take is that the best times for India lie ahead. We are probably the only large economy in the world growing at 6-7% in real terms and 11-12% in nominal terms. China is probably growing in nominal terms is growing at half the rate. Maybe the United States is growing at a fourth of the rate at which we are going. And along with that, there is continuous improvement in the regulatory framework. Our markets are becoming a lot better. I think companies are governed better, governance standards are better, communication is improving. When you mix high growth, better capital efficiency and some of these softer issues, I clearly believe that this calls for a sustained level of higher valuations from versus what we have seen in the past.
Right.
Okay. If you just look at the Nifty companies, I'm not sure if the valuations have changed quite dramatically. I mean, our markets are used to trading at about 20 times on a trailing basis. I still think they're probably at around 20-21 times.
Right.
So my view is that a lot of the upside from here will depend on the growth of the businesses and sustained capital efficiency rather than any expansion of the P multiples.
Okay, fair enough. So now let's steer back to where we started off. You said, industrials is the space where there was a lot of action, especially in the mid cap also, there are lots of stocks in that space. How do you size up the opportunities for this year? Is that an ongoing trend that you would continue to bet on, or have stocks run up? So there needs to be some level of consolidation. How do you see that space?
I believe consolidation has been happening along the way. If you look at the markets tend to do very well for a few days, few weeks, and then there's some knee-jerk reaction because of which stock prices correct 10-15%. This is something which is an ongoing process. In terms of pockets of opportunities, clearly believe the opportunities will continue in the space of digitalization and premiumization on the consumer side. These are the two big places where you continue to see, and this is essentially, digitalization is more about technology adoption. The young consumer is willing to adopt technology and prefers to transact online versus transacting essentially on the offline mode the way their parents or the earlier generation did.
Right.
Premiumization is more aspirational. Thanks to social media coming in, thanks to what you see around, thanks to how your peer group is behaving, you want to kind of consume better and better. You not necessarily want to consume more and more, but you want to consume better and better and move up there. I think these two are very enduring opportunities, and I believe that this will continue to, they have played out, they will continue to play out in the year ahead and maybe in the years ahead. The other pockets are around infrastructure build-up and industrialization. Both these are essentially two important themes which I think will play out for the medium term. There is a window of opportunity for the next 2, 3, 4, 5 years where this theme will play out. I mean, it's estimated that by 2030, India is going to be investing more than $1 trillion in infrastructure. Across railways, across ports, airports, waterways, a whole bunch of areas. This is where you're going to see a continued traction, and businesses which are either supplying components or equipment or providing services in building up India's infrastructure as well as in helping India to industrialization and becoming a part of the global supply chain. These are some of the themes, some of the pockets, some of the sectors which I believe will outperform in the year ahead and in the years ahead.
Sure. And in the mid-cap space, do you still see value in these pockets?
Oh, absolutely. I mean, this is, I think as long as there is growth and capital efficiency, I think they will continue to perform. In the last 1 year or so, returns have also come in from P expansion. Yeah. But I don't see room for that going forward. And so companies which will continue to grow will continue to essentially reward investors. Companies which do not grow or falter on growth or deliver below expectations, I think those are the kind of companies where the markets can also get equally ruthless with them, where they could get punished and stock prices could essentially have a collateral damage. So one has to be very careful from here. You are almost like kind of priced to perfection. It will have to be a 10 on 10 performance. Any kind of
so you're saying with respect to industrials or with respect to all?
I think across the board. I think across the board. There is no room for complacency or there is no room for disappointment. India is a growth market. These sectors have become growth sectors, and in growth opportunities, there is no room for disappointment, especially with the kind of up move that we have seen in valuations over the last year or so. So one has to be very careful. One will have to be more selective. This uptrend, this bull market could get narrower and narrower. So you could actually see more concentration happening because after a particular point of time, not all companies will grow at the same pace. Correct. The low hanging fruit is behind us. Right. We will now have to be very careful in terms of what we are buying. Sectors may remain the same, but within those same set of sectors, you're going to see a lesser number of companies continuing to sustain performance because as the
but why would you say that? Usually that happens right at the end of the bull market where the pyramid is really sharp and the market is really narrow. Now if we were to really project now the capex cycle has just about started. A lot of private capex has not even come about the way one thought it would come about. So that is still perhaps a few months away, and then we get into elections, etc., which we'll talk about. So isn't there case to be made for a far more broader economic recovery driven, industrial growth?
There will be broad-based, but as any kind of an uptrend or a recovery or a growth momentum, as it upscales, you are not going to see every company being able to deal with that scale. Managing scale itself has its own set of challenges, and not everybody essentially can deliver on that. And what has happened over the last 1 year is valuations of pretty much most companies have gone up in the hope that they will continue to deliver. But as the game gets bigger, as the economy becomes bigger, challenges of execution will come to the fore for many individual companies. And those individual companies which fail to live up to expectations will get punished, and companies which deliver in line with expectations or more than expectations will get rewarded and will probably continue to get rewarded disproportionately. And that's essentially the nature of the market.
Right. So from a mutual fund manager's perspective today, people say that large caps and mega caps have not performed over the last 2 years. Therefore, valuations optically look cheaper than mid caps and small caps. From an individual investor's perspective, I mean, you don't have the problem of liquidity, impact cost, etc., etc. So that is also a good playing ground. But purely from a risk reward perspective, how do you see the opportunity in large cap versus mid cap?
I would still think we all have to be bottom up. Mid caps, small caps have done well because also the growth differential has been significantly higher, like what we were earlier alluding to. And take the case of banks. It's a classic case where some of the well-run large banks have totally underperformed or not given returns over the last 3 years.
Absolutely.
But that's because not that their performance has been weak. It's just that there are a whole bunch of maybe another 6 or 8 or 10 banks and maybe another 6 or 10 specialized lenders who are growing at say a 20-25% versus the big banks growing at 15%.
Right.
The smaller banks, specialized lenders are also improving their ROE.
Right.
They are preserving their asset quality and have restored and repaired their balance sheets.
Correct.
Versus the damage which had happened in the COVID period.
Right.
I think so when that happens, I think that's the time investors say that, why not be in these versus the large cap? We do not want to be in large caps just because they are large caps.
Right.
We want to be in pockets where there is higher performance in a relative terms. It's also true that the markets will get to a stage, which I don't think that stage has come, will get to a stage where maybe the smaller pockets will get more than priced in.
Right, right.
And that will be the inflection point or the rallying point for some of the large caps to come back in vogue.
Okay, okay.
So
So we are not there yet.
We don't seem to be there.
Yeah, no, I was asking this question only because you were saying that, we could see a narrowing of the rally and the
Yes.
fact that, now companies might get into this area where execution may become
Yes.
a bit of a challenge.
Right.
In which case, is it a good idea to take shelter in companies which probably show moderate growth, but, you can be reasonably sure that they are more proven track record, the managements are more reliable, you can be assured of certain level of execution. So therefore the incidence of accidents may be lower. So my question was more from how we go from here.
I think from here, I still believe that, the mid cap, small cap still present a very attractive opportunity.
Sure.
I think one of the challenges for the large cap space is that at least foreigners or foreign investors or foreign managers find a lot of comfort in the large caps. Unfortunately, they don't yet seem to have taken that leap of faith. Though April to September was good in terms of FPI flows, but again, they have resumed their selling.
Right.
It's quite likely that they're waiting for the outcome of the 24 elections.
Right.
While we here on the ground don't think of that as so much to be a challenge, but I think in their minds, they do wait for some of these events. They want to essentially be past the uncertainty. My view is that maybe once there's even a better sense on the outcome of the 24 elections is when you will see a lot more money coming in from the foreign investors.
Sure.
And when that happens, you would again see the large caps at least regain some of the lost form. I'm not sure how much they will outperform, but at least in terms of even absolute returns, I think they will regain their lost form when you see a gush of liquidity coming in from the foreigners.
Sure,
and my view is that that's probably just a few weeks or few months away.
Sure. So two things have to go right. One, the election results. You're saying that FPIs are actually holding back.
Yes.
And letting this pass and want to be more certain about who comes to power and with continuity of reforms and so on and so forth. And of course, what's your view on the rates? Is that still an overhang? Wait and watch. Risk from US Fed?
No, I don't think that's kind of a risk, and I think the way the yields have behaved in the last few days, I think market is taking that leap of faith that the US Fed is done with the rate cycle. That's basically, I think, seems to be the consensus view. Though higher for longer still remains, in the sense that it's not that the rate cut cycle is going to start anytime soon,
right.
But it's quite likely that we're probably seeing the peak. Just that from the peak we may just get into a plateau mode where we may not see any hikes beyond this, but it may also imply that there may not be any significant cuts. What we have to watch out for in 24 is how the US consumer behaves. If there's a slowdown, then that could be an important trigger point for the Fed to start cutting rates. But I still think that's some time away. We will have to live with this environment of elevated rates.
Okay, cool. Any obvious pockets of value or pockets of exuberance that you see in this market?
From I think value, I think it still continues to be, I think, across the board. Again, areas like digitalization or the infrastructure, industrialization space, I think that continues to be good. I still think financials look very attractive. I think the runway of growth for them is still very, very long.
But in the mid small cap space, you're saying?
I think the specialized guys. I think the specialized. I think the days for universal, generalized players, I think, is behind them, because every consumer, including your borrower, is looking for value in you.
Right.
They're looking for better experience, better rates, better pricing.
Right.
So all of that. Pockets of exuberance, I probably think that the electronic manufacturing space, EMS, I think they will witness good growth, but probably the markets are expecting them to grow at 30, 40, maybe 50% CAGR for the next 10 years.
Which is,
but which I'm not quite sure. I'm not sure if it's going to be linear. Number one. Number two, mind you that it's a B2B business. Your customers are always going to, in a way, push you against the wall for better deals, for more price cuts, for longer credit periods, which means pressure on your working capital cycle. And keep in mind that you are going to be doing the heavy lifting on behalf of your customers, because they want you to set up the facilities, invest in factories, invest in brick and mortar, invest in machines. Which means that it's a business which is going to have growth, but I'm not too sure if the capital efficiency is going to be as great. And the valuations at which they are trading in, they again are priced to perfection. So if there's any slippage in any quarter or any year, the market's reaction could be brutal.
Sure.
So that's one area that one will have to be very careful about.
Sure. No, couldn't agree more. The other thing is also this, specialty chemicals space, which had similar kind of optimism a few years ago. People thought that this was, we've not even scratched the surface. There is so much runway, and then suddenly you see that, the destocking problem and all of that, and several quarters of disappointment, and we don't know when it's going to end. So what is your view on specialty chemicals? Do you see value there? Is this an opportunity to buy some of these companies because they have growth, or is this negative period yet to completely play out?
Well, we've stayed away from the specialty chemicals business.
Why is that?
Because I don't think
that was one of the key trends in this China plus one.
Yes, but I don't think there's anything specialty about specialty chemicals. Okay, these are chemicals. Period. They are commodities. They are cyclicals. There's nothing specialty about them. Okay, you're just manufacturing. Yes, in between the demand-supply equation turned favorable in terms of you as a producer. And you had a good time in that period where you basically had a pricing power and you had better margins, but that was about it. That's how any commodity will behave. I don't see this any different from, say, a steel company. So there's nothing specialty about them. And my view is that the valuations in still some of them again are priced to perfection, and we have seen that over the last maybe 4 quarters or so. There have been slippages, their performance has not been great, and we've seen that they have underperformed. And my view still is that they will continue to underperform for some time till margins bottom out. It also has the same challenges that you need to keep investing in capacity. So there are no free cash flows for your investors to basically harness or harvest. So it's that typical all the callings of a B2B capital intensive business and a cyclical business, which is hard to predict, and you don't know which part of the world new capacity is going to come up. We think that we are totally entitled to that capacity and to that space, but you really don't know when China will again come in or any other country will again come in. And so it's hard to kind of take a long-term view. You can take a view quarter by quarter, so you keep living by every quarter. But beyond that, I don't think these are great long-term investment opportunities.
Not compounders. Sure. Talking of which, how about these new age companies, Zomatos of the world, Paytm, PB Fintech, all of these stocks, at least these 3 stocks have done exceptionally well in the last year or so, right? After, of course, the sharp correction. But not all, Nykaa, for example, has not been a performer. So how do you size up that opportunity? Is it still worth considering at these levels, or again, easy money is gone?
No, this is a very interesting space. I spoke about digitalization, and clearly these are the companies which have essentially been at the forefront of digitalization. And my view is that they are all addressing very large underserved market opportunities. and they clearly have an edge in terms of having the early mover advantage. They have done a lot of things, they have learned, and they have become better and better, and are having a pretty nice solid market share. So for now I would think that they do have a moat. And these are actually strong consumer franchises. It's just that we think of them only as new age or online, but these are consumer franchises. It's just that 20-30 years back HUL, Nestle, Britannia were consumer franchises, and the moat was around the distribution network that they had on a pan-India basis, which means they reached pretty much every city, every suburb, every small town of the country. I think
this is also distribution moat only.
This is exactly,
but it's technology.
But it's technology-led distribution moat which they have.
Right.
So I still believe that these are great businesses, and they are opportunities which will play out. Just that we have to keep in mind that the disruptors are also vulnerable to disruption. So one has to really watch out for that as the big risk. That it's not like saying, okay, fine, nobody can come in. Unlike, say, a traditional consumer company where it's hard for anybody else to totally disrupt your distribution network. Here, with the power of technology and a better consumer interface and experience, you can get disrupted. So that to me is the only risk which is there with them. But right now, all of them
visible to you in any of these three companies which have done well.
So I think Paytm is anyway in a crowded space,
right?
Okay, but they still continue to do very well in that space,
right?
Okay, but it's in a crowded space, and you're going to have more competition from players like Jio Finance or people like Bajaj Finance upping the game further.
Correct.
But it's a crowded space. Zomato was a duopoly, remains a duopoly, and even so many quarters have gone by, but we see no third player wanting to even come into this space.
Right.
Okay, so it clearly looks to be a space where the moat seems to be more enduring. PB Fintech again still continues to enjoy a disproportionately higher market share, and we own PB Fintech. It continues to enjoy that, but there is the Bima Sugam platform which is expected to come up, and who knows, the jury is out there. Clearly they also have a right to win. So let's see how that plays out, but I think there are that space again is getting competitive. It's not that PhonePe is upping the ante out there. Many other players are coming in, but that's been the nature of the game, that every year you see players coming out there wanting to compete, but still I think PB Fintech has still been doing an amazing job both with Policy Bazaar and Paisa Bazaar. So I think competition will be there. Let's see how these managements respond.
So these are not stocks, of course I'm sure you track all stocks very closely, but this is, you cannot take a call with any level of conviction that you will hold it for 2 years or 3 years. You have to just be on your toes. How do you look at it? For example, even in Zomato, can it be challenged by ONDC? Bima Sugam again, is a threat, but like you rightly said, right now we are not able to see whether they will really challenge, challenge, whether the consumer user interface will be as good or, but at least looking at Paytm, the way the company started and what its business model was and what was thought of as the addressable market to how it all changed when it actually came to the public markets is completely different story, right? So how do you assess these risks, and how do you assure yourself, or do you have shorter time horizons? We always say invest for the long term, but are these stocks, do you think about it in reverse, that take shorter term calls and then keep continuing with it?
So the way we've at least kind of looking at this space is that essentially be guided by the long term opportunity. Okay, the long term opportunity is humongous. Okay, and have these players done things right to address that long term opportunity, but at the same time be obsessed with the risks and the competition and the potential disruption in the short term. So it will continue. You'll have to keep doing the balancing act, that on one hand be mindful of the long term opportunity, but don't lose sight of the emerging risks in the short term, and that's probably the way an investor will have to continue to look at these businesses.
Okay, fair enough. And you didn't mention Nykaa. So what's your take there?
I think that space is probably more vulnerable to competition. It's a very exciting space. Personal care is a space which essentially is expected to grow, and especially segments to do with beauty and wellness and fashion will do even better. And as we have a higher proportion of the women or the share of female workers in the overall scheme of things increasing, I think there is a nice runway of growth for a player like Nykaa. The challenge is that we've already seen the big boys wanting to come in that space.
Correct.
So my view is that maybe for the next few quarters, I think the challenges will continue for a player like Nykaa because it is the market leader.
Yeah.
And the market leader always has the most to lose or is always the most vulnerable.
Yes.
But if Nykaa can manage this challenging situation really well, Nykaa has the chance to emerge even stronger after dealing with this competition.
Sure.
So the jury is out there, and let's see.
And would you say the same for Bajaj Finance? What is the potential disruption that Jio can bring in?
My view is that I think there's room for all of them. This market is probably estimated to be whatever 100 lakh crore or 150 lakh crore market. All these players, be it Bajaj Finance or Paytm and all of that, are probably yet 1-3% of the market. So probably there's room for all. I still think India has a very large segment of unbanked players. The new to credit segment is only growing, and each one of these players will have their own strategy to make the most out of this opportunity. At least for the next 5 years, I wouldn't be worried about the opportunity. It's just that maybe a Bajaj Finance, having grown so much, will probably grow at maybe more, will grow at say maybe 20-25% in terms of annualized growth. A player like Jio Finance or a Paytm might be able to grow at a faster pace just because they are starting off and have a relatively lower base to deal with. That's the only thing, but I believe that all these players have an equal chance to win, and they will all probably grow in double digits for the foreseeable future.
Okay, cool. Now Diwali gift, Nilesh, 3 stock picks.
Oh, that's a tough one because like what we have been discussing, that it's a broad-based kind of an opportunity. So very difficult to really call that out. But my view would be that I think from the digital space, I still think that players like PB Fintech or Angel One, which we own, I think are very good. The second could be again a young bank like IDFC First Bank, which I think has been growing well and has gone through the stage of repair over the last 5 years.
Right.
Maybe it's time for them to now grow and grow at a significantly higher pace versus the industry. I think that's an interesting space. Another company in the financial space that we like is Home First. It is into affordable housing finance and is a technology-led company which essentially has pretty much done a lot of things right in terms of its technology, has managed asset quality relatively well. I think these are some of the opportunities which I think should play out very well in the year ahead and maybe in the years ahead.
Okay, tell me about Angel One. Sounds very interesting. Of course, part of the a lot of the growth has happened because of derivatives volume going up. Do you see any threat to that part of the business, or it's here to stay? Because from the regulatory perspective, also the regulators also seem to be more concerned that all the volume is happening there, and this has been articulated, and obviously the role of influencers in augmenting these volumes, and all of that is coming under regulatory scrutiny now. What kind of impact can that have on their top line?
So I'd probably answer, I think the answer to that lies in Angel One's past and its future, and we own the stock, and so I must make that disclaimer. The answer lies in its past and its future. I believe Angel One is a standout example of transformation. Earlier on, maybe 5-7 years back, it transformed from an offline player to an online player, and it did that transformation very successfully.
Right.
It saw the writing on the wall that the days of the offline physical players are behind, and it's over to now online. I believe that its future will be in Angel One successfully transforming itself from a monoline online broking platform to a invest tech platform or a wealth tech platform where it offers other asset classes, it offers other products beyond equity broking or derivatives broking. I believe that will continue to be the flywheel for the business. But if you were to ask me from a very long-term point of view, India is moving from a nation of savers to investors. And when we say investors, it's not necessarily just equity investors, but investors in bonds, government securities, commodities, currencies, international equities, mutual funds. Those are some of the very emerging opportunities. And my view is that the future for Angel One lies in it being able to successfully transform itself from being a monoline player to being a very integrated, comprehensive invest tech or a fintech platform.
Sure, sure. On that note, Nilesh, thank you so much. It was such a lovely discussion. It's always a pleasure talking to you.
Thank you so much, Mahalakshmi.
Thank you.
Well, hello and welcome to Money Control. You have tuned into Diwali special. I'm your host, Nikki Minchandani, and an exclusive chat with an ace investor, Paran Juwelier, who started its journey from a law school graduate to now a veteran investor that we have. Start off with how do you read into the current situation with the yields now inching around that 5% level? Do you think that makes for a weaker case for equities combined with the geopolitical concerns, soft earnings put together? Do you think, how bullish are you on the India's growth story right now? What are the levels that you're essentially working with?
Yes. Thank you for.
Absolutely.
See the structural story of India. You know, it's something. It's very much intact. Nothing can change it. Also, I'm very confident. You know, it's something historic. What's happening in India as an economy, and also we are lucky as a nation with the geopolitics happening around, especially the Chinese developments, the China plus one strategy helping. There are a lot of elements, and our own young demography, the many of those so-called positives of India is still intact, and it's rather improving, I would say. So we are in a sweet spot, and that unparalleled story, it is really playing out. Next 5-10 years is going to be, extremely bullish times for Indian economy, for the nation, and it will also definitely reflect in the stock market. At the same time, maybe today, this Diwali or around that, it's not a time to be excited and pick stocks. Especially value investors, I don't think it's a great time to pick stocks in India. Even though all these macros are playing out, it's very much intact. The story is going very well. We have more and more advantages happening in the global geopolitical scenario today. So, why not exciting today is because of the valuation. Indian equities, the valuation in general is very rich.
Right.
So one cannot just go on buying equities at this point of time in the short-term point of view.
Are you expecting some amount of correction? Because you're saying it's not really as exciting time for value investors. So are you expecting fair bit of correction more, especially for broader space, where the last 1 month has seen some amount of valuation coming down a bit? Do you anticipate further correction in that space?
Correction has been happening, Nikki, if you notice.
Yeah.
When we had it a couple of weeks ago.
Absolutely.
Very good correction.
Absolutely.
So people getting panic. A lot of traders, they have to sell off. The leverage comes down. So these all are very healthy kind of corrections we are going through.
Right.
So there's nothing wrong in this kind of small corrections. It's actually making the market more healthy, as I told. But more important, now it's a time to the bottom-up approach of picking selective stocks which you are comfortable with valuation.
Right.
There could be many stocks which I always mention, which are or which have been ignored by the market for a while, but there is something in it, there is fire in it for the future.
Right.
Things could be changing. Maybe some companies, some stocks may be not performing well in the past because of 1 or 2 quarters of numbers not being impressive. So those kind of stock picking without any segment, we have been now, if you see the last 1 year, what the main thing what I noticed since last Diwali, if I say, some of those sectors,
Right.
people say, okay, now defense.
Right.
It is true, it's a structural big change happening in the defense manufacturing
Right.
and that vertical in India
Right.
because of the government initiatives of Make in India and trying to become self-reliant in the defense.
Right.
So it's a real big long-term growth story.
Right.
But you see how these stocks moved. For example, I remember I used to buy this, that Masgon dock at 180 rupees, 170 rupees, which went to 2000 rupees. Now also staying around, 1800 levels. So they have already gone into very rich valuation. So people should not get excited because of a theme of defense. For example, whether it is an HAL or any of those defense or shipyard kind of stocks. You have to see the valuation. Valuation is the most important thing. Every investor, even traders, should keep it in mind, or you may get stuck some point of time. So India, I would say, this Diwali, be sober. You will see many months ahead, with sober valuations.
When you say sober valuation, you anticipate more correction perhaps coming into the markets. The last 1 month hasn't been enough, apparently. Do you see that further healthy correction, as we may put in? Are you looking more of losses coming in, and the valuations now perhaps looking after the correction? You go back and probably start looking at the fundamentals again?
Yeah, fundamentals should always be there.
Absolutely.
At every valuation, every point of excitement, every point of disappointment, you should be looking at the valuations. So what I'm trying to tell you, the correction what you have been talking, this is an ongoing process. Some of the segments get corrected. Some of the stocks get corrected time-wise, It's a good company. For example, I remember one of my most bullish stock was Tata Consumer.
Absolutely.
And it has become multi-bagger since then.
Right.
But it has been correcting for now last 1 year, maybe more. Time-wise correction. The price is not going down.
Right.
So some point of time, that time-wise correction is getting over. The stock can move to the next level.
Okay.
So this is happening even in small mid caps also. But talking about small mid caps, I feel the new investors especially should be very cautious.
Right.
I can see hundreds of stocks, penny stocks, small stocks, especially in the SME sector. Where there's, I think, different kind of trading guidelines and all whatever. So I think a lot of promoter and operator involved price management or price manipulation, I would say,
Right.
is happening. And, it's a question of time. If you invest in a company like that, the stock was 100 rupees, it moved to 300, 500 and 700 in a short period of time without strong fundamental support, then you can, get stuck in that stock at 700. Who knows, the price will not go back to 50 rupees because of the lack of fundamentals in the company.
Right.
So sometimes there is no floating stock. So either I know some promoters, they grab all the floating stock in the market with the help of some operators, brokers in different names, and the price, then they decide the price.
Absolutely.
It can be 100 rupees, it can be 1000 rupees. So that kind of things happening in the market, I can see that, but maybe not that widespread like earlier.
Yeah.
So investors have to be careful. The valuation is the key, and everything else is, technicals and trading. I don't know much about it.
I just wanted to check with you your parallels that you could draw from the scenario in 2018 when you were caught at the wrong end of the side, where perhaps some amount of wealth was eroded. That was quite a journey for you from there until now. What are your lessons from that experience, and what are the mistakes that you would now not make that you did at some point? What's going to be your 3 takeaways from that difficult journey that you've had?
I don't call it a major mistake we did. See, I have been mostly into the small and mid caps.
Absolutely.
Basically quality stocks or turnarounds. So in 2016, 17 and all, after the demonetization and the GST, all those major historic reforms have been happening in India. I got a bit excited on the governance aspect of companies. So the so-called, badly governed companies or the chore promoters, I thought in those days, they have no choice but to change, to go professional about it,
Right.
create wealth through the market capitalization, pay the taxes, and so that kind of a thing I expected. But we got in a couple of companies in our holdings where the promoter, they just took out all the money because they found it's not their time coming up.
You want to name a
Now,
few?
no, please. So, some promoters, instead of becoming good citizen or a good businessman or going ethical about it, they whatever money available in the company, they took it out. Our rules and regulations or the prevailing law is they are not very strict about it. There are loopholes where promoters can just save not money and not being responsible. So, of course, now regulator is doing a lot of things
Absolutely.
to improve and protect the wealth of minority shareholders. Definitely, that's happening. But in those days, so we had a significant capital erosion in a couple of such companies. But otherwise, the stocks which went down badly, some of them later went up by 5 times, 10 times, and 20 times. So it's all taken care in the subsequent years of 3 years, the last 3 years, I would say,
Absolutely.
especially since the COVID time. There are stocks, not 1 or 2, not 20, 40. I'm telling you, there are hundreds of small penny stocks, some of the mid-cap stocks, which have gone up by 10 times, 20 times, and 50 times. I remember one of the stocks I'm still holding, PTC Industries. Okay, it was a very small market cap company. Uh, I think that has gone now, considering the bonus, or it was a rights issue at 10 rupees, 1:1. So the stock price went to 12,000 rupees. Even now it is around 10,000 rupees from 500 rupees.
Absolutely.
So from 500 to rupees to 12,000 rupees, it's a big multi-bagger.
Absolutely.
This is not only me. Tejo is a stocks I am still holding. It is there in the public domain,
Absolutely.
in the proprietary holding. That also has moved up significantly now to around nearly 6,000 rupees, adjusted to the bonus,
Absolutely.
from around 500 rupees.
I am quite a contrarian. I'm going to play a little devil's advocate here. Burger King apparently has not done too well. You've seen some amounts, not really a sharp loss, but say 8% downtick, which has come through on a year basis. The SSSG growth seems to be better as compared to the peers. Overall, what's your assessment on the QSR space? How do you rate a company, and what's your rationale behind this one?
I think this QSR as a business, as a vertical, has a long way in India to go. There's no doubt about it. But initially, these companies are not going to make a lot of profits. They have to get established. India, when we think about this 1,400 million people, it's not a small thing.
Absolutely.
So that number is making many emerging businesses or the earlier Western businesses now penetrating to India. It has a long way to go in terms of penetration, and our tier 2, 3, 4 towns and cities are going to have this kind of a culture.
Right.
So, of course, Burger King is something we have been buying. We are still buying. We are not disappointed, or it's too early to say it is down. It is not down. The stock is fine. It's much above their public issue price. And we have been buying this stock even now whenever there's a weakness. So it's a long-term bet.
So how long is your long-term bet? Are you looking at it for 3 years perspective, 5 years perspective? What's your the duration that you're looking to hold on to this one?
I would say 2,000 years.
2,000 years.
In long-term value investing.
That's not a fair one.
Why not? Why not? Who can say? Nobody can say. See, equity is an asset class. There can be a good company which is with a consistent growth and
Okay, so
market opportunity.
let's change the question in that
No. I want to say that. No,
Okay.
this is a very serious doubt people have. This is an asset class. Maybe many generations can continue to hold that same asset class. So I think it's very wrong to say how long is a long term, whether it is 1 year or 5 years. Of course, for income tax, the capital gain taxation purpose, we have got 1 year period. I think many countries have 2 or 3 years kind of period for eligibility. to make it long-term capital gain. So we are lucky we still have 1 year period. That's very good. So, but equity, it's your ownership in the company, a small part of the ownership in the company. So you own the business. So how long is the long term? I think that question is not relevant.
Okay, so I'm going to change my question a little bit.
Don't change.
I'm going to ask you, what about Gati and Kerala Ayurveda? You've also been adding on to it, correct? What's your rationale behind this? Kerala Ayurveda is something which is a loss-making entity. You are seeing some amount of debt. So what is the investment rationale behind that?
No, Nikki, now both these are very different kind of companies.
Absolutely, completely
Now, Gati is a nationally present logistics company, or one of our core holding in PMS.
Absolutely.
Okay. The other thing is very different. It's a penny stock, risky stock. I am personally holding around 5-6% as on today.
Okay.
After the recent attending the AGM of the company, listening to Mr. Ramesh Wangal, the chairman, so I was more excited about that business. Its potential to become a very large business in the 5-10 years time.
Right.
So it's a long-term bet. Understanding the risk, taking the risk, I am doing it. So it was 100 crores, 120 crores market cap, maybe a few months ago. Today, I think it should be around 200 crores market cap. It's the sales turnover is around 100 crores, and it's a very niche. We don't have any other company listed. Now, when we say Ayurveda company, it's different from that herbal, the Himalayas or Dabur. It's very different. So Ayurveda companies, basically they have the classical Ayurveda products. And Ayurveda is basically more than curing the problem. It's keeping, wellness. It's a wellness business.
Right.
To keep you stay healthy.
Absolutely.
To avoid getting, illness. So this is something, it is getting momentum among many communities, many people globally also. But there is a lot of challenges in growing a classical Ayurveda.
Absolutely.
Products.
It is a loss-making company with some debt figures.
Some small loss, nothing much. Because of the COVID, they had a bad time.
Absolutely.
All their treatment centers had to be closed down, and they have to pay to the doctors and the other staff. So it is natural. It happened to many industries, in hospitality and in hospitals, everywhere. So I feel Kerala Ayurveda, I can never recommend this stock to somebody outside. I am taking that personal risk. So I won't be ruling out, this doesn't really work. There is an execution problem. The stock can go down on one side. The other side, if it really clicks. Now, this guy is a very capable person, Mr. Ramesh Wangal, the chairman. And I was betting on him. But he could not deliver anything in the initial years. Now I see, after attending the AGM, I feel, he's trying to do many things. There is a US business for this company. They are selling through the US Amazon.com and eBay. And there is an acceptance regulatory approval in USA. And they are having an academy in USA. So the American citizens, they come and join this academy, undergo the course, they get a certification, and they start practicing Ayurveda, for which Kerala Ayurveda is supplying the medicines. So when I see there is an opportunity, even though there is a risk because it's a penny stock, yet to be proven. So why can't this company be $1 billion company in next 10 years? I'm just seeing a potential.
Okay.
If everything goes right. At the same time, there is a risk. I will never recommend somebody to buy Kerala Ayurveda. It's just small penny stock. Please don't even.
Yeah, these are not recommendations per se. It's just.
So I hold such stocks. I may have maybe 15, 20 such 100 crores, 200 crores, 300 crores market cap in my personal portfolio. Most of them are not known outside.
Absolutely.
So I enjoy that kind of a risky
tell us something that is not known in that case. Why don't you tell me, what are you buying? What are you selling? Because something which is interesting perhaps has not caught the frenzy until now, which you've spotted.
Now, when you ask this question, Nikki, again, one more thing I would like to tell the investors, Now, these are, when a company with 100 crores market cap, I buy little shares, even the name come in the bulk deal, or it may appear in the shareholding pattern every quarterly in the 1%. So, it's not a good idea to buy stocks just because of some investors. I'm not a big investor. I'm a very small investor compared to the biggies in Mumbai and, in the industry. So, I would say, please don't buy stocks because you see somebody's name in the bulk deal or in the shareholding pattern every quarter, because we don't know, first of all, we don't know what price this celebrated investor bought the stock.
Absolutely.
Secondly, we don't know what is his intention of buying it, whether to hold it for long term or is it for a trading or a medium term perspective. So when you follow, and mostly it happens, people tend to buy the stock at a much higher price once this name comes.
Yeah.
So I would even suggest regulator not to report this 0.5% in the bulk deal. This is actually being making more issues than the benefits of it. I strongly feel so.
Okay, since I have scanned through, you made a very valid point, and doing our homework thoroughly, I think we just picked up Shalimar Paints, where it was reported as one of your bulgies, where it seems like you've sold in more than 1% in Shalimar Paints. It is a Jindal family-backed company, it has rejigged its leadership of the oldest company. So what is the rationale behind the sale? And also the company has been reporting losses to an extent of 10 crore for the quarter gone by. So what's really a bone of contention? It's just that it's a loss making.
Shalimar, in fact, we completely exited the stock recently.
Okay.
We had nearly 10% holding or 9% holding in PMS.
Okay.
Some point of time. It was very small market cap, and this is one of the the oldest paint company in India. One of the oldest paint company in Asia.
Yeah.
I think after that Japanese name and all. Shalimar was a big brand, especially their some of their metal coating kind of specialty applications. Even in the remote villages in India would be knowing it. But this company went into trouble. There was a lot of mismanagement, changed the promoters, management many times. So it was like a little risky bet. And the paint industry in this many years ago we invested.
Right.
But it did not really click. We are in a profit and we sold, that's right, but it was not very rewarding for the PMS. Even though might have made our money double. So it was not very rewarding that way. So this kind of stories
overall,
sometimes...
are you like bullish now? Are you bearish on the paint space put together? With the kind of
no,
dynamics
like
that have been playing out, the demand growth, the volume performance, how are you looking at the entire space?
See, as painting, I'm not an expert on any industry as such, especially
Absolutely.
paint industry, but what I understand, there's huge capex going on, done by many solid, rich players like, Asian Paints, or I think Jindal's investing in a big way. So I heard, even Aditya Birla Group is coming up. So, and many other building products companies are also diversifying. So, the mighty people like Asian Paints, I understand they are planning to invest 5 to 10,000 crores capex. So, small players, what will be the future? It's very uncertain. I have no comments, and becoming bullish or bearish on paint industry, I'm neutral, I would say.
Okay, fair point. Also, talk about Godrej group of companies. You seem to be pretty bullish there. What are you picking up within the group? What do you like? What's the rationale? Of course, there have been reports suggesting about the split of its 1.76 lakh crore conglomerate. Family Council is also discussing division terms as per the reports. Of the group, what do you like and why?
So this I mentioned as maybe like a Diwali pick.
Absolutely. This could be an absolutely Diwali pick for the viewers out there.
Yeah. So Godrej Industries we have been buying on weakness. Right? There is no hurry for anybody to buy this stock, and we may also buy when there is weakness happening in the future. So Godrej Industries again a holding company predominantly, of Godrej Properties, Godrej Consumer, and the other one Godrej Agrovet.
Right.
The three companies that holding value itself is very high.
Right.
But as you know, the holding companies have very low valuations. There is 60, 70, 80, 90% kind of discounts in the market right now. I expect that gap to come down. SEBI also has been noticing as a regulator, the listed holding companies. So there is some, I saw some consultation paper, where SEBI is suggesting, if they want to delist, an option to delist, so the valuations kind of things. And so this gap of its NAV and the current price can come down. So I feel Godrej, another thing, this is a stock which have not performed in the last maybe 7-8 years.
Right.
The price today of Godrej Industries is something it was quoting maybe 7-8 years ago.
Absolutely.
So it was a non-performer, and we are looking at some of those companies which has potential and which have not performed, which was not on fire, not in fancy. So I think Godrej Industries makes sense. Again, as you rightly pointed, there are stories that some family settlement could happen.
Absolutely.
I don't know when.
How are you reading into it? Something like that.
Yeah.
How does that augur well
But-
for the stock prices? How should the investor be looking into it?
So I have no idea when this will happen. But anyway, it's a very highly respected group when we talk about Godrej Group.
Absolutely.
So investors can trust the group, the people, to be highly ethical towards minority shareholders and reasonable. So that way, I feel at around 20,000 crores market cap today, Godrej Industries seems to be, a very good investment bet. But there is no hurry. You can buy it when some point of time when the market reacts or in a corrective mode. And this holding company discount, which could be around 70% for the Godrej Industries today. Suppose it goes down to 50%. Again, there is a big chance the stock can even double from these levels. Plus, they have not performed. So I feel Godrej Industries is a safe bet. But again, please don't hurry to buy it. We have been buying the stock, and it's a large company. By somebody buying or I talking on the television, it is not going to make any price movement for the stock. That's why I'm talking about this stock.
Absolutely.
So, but it
the
looks very
disclosure
safe.
is intact there.
Yeah.
But also coming to a very important point where we've been talking about the ruling party, right? There was a Jeffries report which suggested a 25% correction if the ruling party BJP faces a surprise defeat in the national polls. How are you looking at the stance, and what's your take on that one?
My wish, as an Indian, good citizen and as an investor, this regime should continue at least for next 5 years. Because I have been noticing very closely what this regime, this government has been trying to do for the long-term economic prospects, a vision for the economy for next 10, 20, 30 years time. Not for how to survive this year or how to work till the next election. I appreciate this government, especially the leadership, political leadership, looking at the long-term growth, sustainable growth for the economy point of view, and they are doing the best possible job for the economy. This economy is most important. The other things, whatever controversies are there, religious, social, this thing all we can manage anytime. Once you lose your economy, once you lose control of that, your economy, your currency, and the grip on the that sustainable growth, then everything is gone. Nothing else will work. We'll be in chaos.
Right.
Nobody can help it. So instead of too many small parties with different interest and not so good track record of the past, they're coming together and forming a government. As a citizen of India, I would love if this regime continuing, and my expectation, I strongly, I'm confident this regime will continue.
The flip question to this, like always playing the devil's advocate, you think if that was supposed to happen, if there was a surprise defeat that could come through for the winning party or the government right now, do you think that would lead to a sharp correction coming in for the markets to an extent of 20-25%, as Jeffries has been pointing out?
I don't give too much value to Jeffries' report as such, even though I just had tweeted about it. They have been wrong many times, and I don't think they are smarter than many Indian firms or Indian analysts. At the same time, if suppose it happens, the current regime changes, there will be a lot of weakness in the market. But again, that is going to be temporary. India cannot be destroyed that easily by even any newcomers kind of thing. There's a lot of we have set a platform for the future growth.
Right.
So many of those vital, important economic reforms what we have gone through, they are not going to be reversed. So our tax collection, revenue collection for the nation, everything is going to go up.
Right.
Of course, we have to keep a tab on these freebies. See, if we go on that freebie politics, actually, why I love this regime most, because of, we have been getting transformed from that dolls politics to development politics. That is the key. If I don't mind anybody coming and taking over as the government, but if we go back to the dolls politics, we are going to be in big challenge as an economy. See the 1,400 million people. We have to remember this number every day. As an investor, as an economist, as an anchor, that is the world we are living in, which is 17-18% of the global population live in India. Absolutely. We cannot afford to be like a badly managed country like Pakistan or Sri Lanka, and we cannot afford to get into a financial crisis. Everything else is fine, as long as these all are changeable. So I strongly feel, looking at various aspects, this regime will continue, and their acceptance is going up more and more. The leadership is having more and more leader approvals.
Absolutely.
And South India can remain to be a challenge, but I think this government will continue and the leadership will continue.
Brilliant. Just a small bit before we wrap it up, and of course to our Diwali wishes to the viewers out there who've been candidly watching our interview. I just wanted to understand from you how humbling your journey has been from a law school graduate to now an ace investor, pretty much people following up with what you're buying and what you're not. How does that journey feel to you? What are your lessons from the journey thus far that you want to put it in as many words?
My journey? Okay, I have been always in equities from my student life time itself. So I somehow managed to, get into that vertical, learn. I was so inquisitive about it. I used every opportunity. When I started my career in Kotak in 1990 as a floor trader in Mumbai trading ring, on a Murat day, I still remember. It has been an exciting journey. I am very happy and I am proud that I utilized my initial years to learn about it. I am not a very sophisticated analyst or fund manager.
Absolutely.
I am from my local background, and
just being very humble.
But at the same time, I am very proud of my achievements, the way I have delivered superior returns to thousands of investors under portfolio management scheme. So I am very proud, even though I have a set of clients who joined at the peak of our strategy in 2017, end of 16. There was some underperformance.
Yes.
That is accepted, but it happens to any fund manager. Every strategy of every fund manager doesn't work. But I have a long-term track record of more than 20 years. I am very proud, and I have made a lot of investors, especially from the middle class of Kerala and some of the middle class NRIs in Dubai and many others from different places. I have made a lot of wealth for many of them. They have been thanking me, and so I'm very happy to go through that.
It's clearly a period where you've redeemed yourself after 17, 18, fiasco which happened, which perhaps led to a little bit of loss of confidence, perhaps, if I may use that term. 3 takeaways from that particular period you think you would not repeat in a market like this, where you would see probably some amount of correction, you would see probably some amount of frenzied buying coming through, irrational fundamentals. 3 takeaways from that experience for us.
3 takeaways. Actually, I still do not believe I did something drastically wrong or anything. But we have tweaked our style of stock picking.
Okay.
One thing we decided never to go into much smaller companies.
Okay.
And very liquid companies in PMS.
Okay.
Because here one thing what happened was, I was having much smaller AUM in the 2013, 14, 15 kind of time. Suddenly it became, a lot of people came in because of the performance in 2017 at the peak of that time. So somehow I failed to transform myself, our organization into, going into much bigger stocks. So that is where we got into some kind of underperformance, which was of course rectified immediately afterwards. But today you see our portfolios, my top holding is Raymond. It became top holding because of, it is a 5-bagger in our portfolio.
Right.
Like Tata Communications.
Right.
Hindware we disinvested partly, we are still holding a significant chunk. Then we have got now Godrej Industries, our recent pick. So all our large businesses with very good market opportunity. The size of opportunity is also very good.
Right.
So I can sleep on those kind of ideas. But I'm telling these names, please don't, it's not a recommendation to buy. We have bought these stocks at much lower price.
Absolutely.
So please don't take this as an, a suggestion to buy at these levels. Market always give opportunity. You know, the volatility will continue. We have too many millions of traders in the market now, newcomers. So some of them are purely into trading. I would say most of the newbies are into trading. So that volatility will continue.
Absolutely.
So it may be opportunities for value investors. If you are sober, giving full importance to the valuation,
Absolutely.
and looking at the future, see, attempting to predict the future of these companies. They may be small cap, micro cap, or mid cap, or even large cap. How this company can grow in the next 5 years and 10 years. If you can visualize that with the understanding the existing dynamics, promoters' attitude, the market opportunity size of the product or the services, all these ingredients, there are no fixed 5-10 ingredients. I would say there can be thousands of ingredients when you analyze a stock, small or big. So then you have to take your call.
Absolutely.
Understanding the risk is very important.
Do your homework properly. Just don't go on the sheer names that you listen in here. That's perhaps the long and short that we're trying to drive home. Apart from that, you've also spoken about your Diwali picks. You've also spoken about
I was in fact thinking of not giving individual names because it always creates some kind of
But
issues.
you did, right?
But
You did in that
I
case.
did that. You before the interview asked me,
Yes,
and you gave me
pretty
this
much.
jacket. So it's I have these two picks. If you really want as Diwali picks this year, one is Piramal Pharma.
Right.
That is demerged from the main Piramal company, and I am impressed with the promoters. Even though there are some perception issues, what promoters have been doing in the recent past, some investors feel not fair, not ethical, kind of thing. But I feel it's a very good business, very large in size, around 7,000-8,000 crores of revenue today, which can even double in the next few years' time. And the margins are low, and they recently had a rights issue, reduced the debt by around 1,000 crores.
Okay.
And now it may be at around 12,000-13,000 crores market capitalization, maybe 2 times the sales. I feel there is a very big opportunity for this company in the coming years to improve the margins.
Absolutely.
From 12-13 to maybe 20 plus kind of margin. So in that case, this can be a multi-bagger. Again, there is a risk. Please understand.
It's a standard disclosure. Please do your homework before you make any kind of investment calls into such stocks. But I think we're just going to leave it there. And thank you for taking out the time and joining us here on the floor itself to have a very candid conversation. So thank you so much for that.
Thank you so much, and wish you all a wonderful Diwali this year. Have a great time, make a lot of money, and thank you for the interviews.
Thank you. Happy Diwali. Hello and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nikki Mirchandani. In the glow of Dhanteras lights, let's reflect on the historic journey of Indian markets in Samvat 2079. Nifty touched 20,000 on September 11, 2023 and Sensex surpassed 67,900 with both the indices gaining around 6% during Samvat 2079. However, the real outperformance, as you'd all know, came in from Nifty Mid Cap and the Small Cap Index, which gained around 24% and 31% respectively. The upmove in the market was exceptional considering the Russia-Ukraine war, Israel-Hamas war, and of course, high global inflation, rising crude price, and peak US 10-year yield and consumption slowdown. But how do we navigate Samvat 2080? What are some actionable ideas for Samvat 2080? This Diwali, we bring more than 10 actionable ideas to kickstart your Samvat 2080, curated by our panel of 3 experts. Deven Choksi, who is the Managing Director of DR Choksi FinServ, Siddharth Bambre, who is the EVP Research Head at Religare Broking, and Shrikant Chauhan, who heads the Equity Research for Kotak Securities. We also have a roundup of sorts later part of the show from Rahul Arora, but let's get started with Deven Choksi first. Mr. Choksi, greetings and happy Dhanteras to you. Your top 3 Diwali picks for our viewers this time around.
So, Nikki, happy Dhanteras to you as well, and wish you all a very, very happy and prosperous Diwali. and blessings from God. I invoke blessings from God for prosperous Samvat year 2080. Well, I think whether Diwali to Diwali, I'm not so good at, but I feel that I think some of the businesses which are appearing really promising at this point of time, I would probably like to share with your viewers. Uh, Geo Financial Services is one company which I think has taken birth in the listed market, and we believe that I think this particular company has a distinct advantage as they enter into the marketplace with four verticals, which is your NBFC or the banking financial vertical. The second vertical is the insurance vertical, which is likely to get announced. The third vertical is the AMC vertical, where they have done the tie-up with BlackRock for launch of funds. And the fourth vertical is a wealth vertical, where they are basically distributing all the products, financial products, investment products. The distinct advantage is one, they have the balance sheet size, which is close to around 1,40,000 crores net worth, which is third only to largest banks like SBI, HDFC, and now the Geo Financial. So that gives them a power to launch the business in a systematic manner. The other advantage that they have is the customers they have. Because any business, I think if they have the customers, they are probably financial business, they are probably ready to start the business faster. On a B2B side, they have got the distinct advantage of having the Kirana merchant as their customers, who comes with a proposition of, I think, having credit total addressable market of around 50 lakh crores. And on the retail side, they have the customers coming from Reliance Retail's 18,000 stores as well as their digital platform. So that gives them a power to fund the lending to the retail, particularly the subvention pricing. So that is where probably I think the NBFC vertical could possibly get the highest amount of traction, the momentum, and so it would be converted into valuation. The other three verticals definitely have an advantage as well, because distribution of financial products, you have Moneycontrol, where you've got the highest number of users, the registered users. And that is where probably I think you hold the advantage of cross-selling and upselling of different products. But to a greater extent, I think this is where they're starting from. Insurance vertical, I believe that I think they would be having the disruptive ability to come up with the micro insurances, where they would probably penetrate faster with every transaction. And that's where, again, I think their digital platform will help them. And the AMC vertical, where the ETF is going to be the order of the day, where again I think largely the focus would be on cornering the larger amount of subscription for the end users in a micro coupon order. So all in all put together, this company starts with a good proposition. Of course, revenue, profits, etc. will follow, but I think this is a business model as I see it, which is likely to work well.
Mr. Choksey, sorry to interrupt you, just a minute more on, actually a minute more for your other two bets, because we are going to be winding up with the Tata Motors, the other two bets that you have, so that we can also move on to and ask you more questions relating to your apparent bets that you've picked up.
Sure. I think Tata Motors is a fairly known story. However, the advantage out here is the commercial vehicle segment, passenger vehicle segment, and electric vehicle segment, and the JLR portfolio. Each of these areas of activities are basically now gaining traction, having worked on the cost reduction measures. Each of these areas have their own growth stories to talk about. Commercial vehicle is largely driven by the industrial expansion, the infrastructure expansion, and at the same time, I think the higher amount of expansion coming in because of the scrappage policy coming into force. So this is where we believe that the Tata Motors is offering a visibility of next 3 to 5 years from the point of view of business. And today is an opportunity to buy into these stocks with a clean balance sheet. Praveg is a third company, which is again, I think, a very interesting proposition. BSE listed, of course, at this point of time, sub 1500 crore market cap. But the opportunity out here is that a leisure travel, spiritual tourism is something which this company is basically factoring into. They have got tent city as their business model. They've got exhibition centers as their business model, in which likes of Statue of Unity, Run of Kutch, and now at Daman, Diu, and so many other places, they are basically starting with the tent cities. So these 12 locations which they are likely to start with in the current year is going to get expanded to 25 locations in the next year with the kind of program they are having. including at Varanasi, including at Ayodhya, Ram Mandir. So in my viewpoint, I think this is one company which gives you a distinct advantage because it's a fresh business. For every room, spend 10 lakhs as against five-star hotel charging, spend about 1 crore. Whereas I think the average room rate is probably higher than a five-star hotel because they give experience. I feel that this is one company which can be considered by investors from the point of view of investment. And I think at corrected price, maybe I think this could become an opportunity for investment in the portfolio.
Sure, Mr. Choksi, just a small follow-up question there for Tata Motors. The company has delivered in a poor sales growth of around 3.48% over the past 5 years or so. The return on equity also isn't really encouraging for the last 3 years. Do you think deleveraging guidance is now well priced into the stock rally? Because the delivery hasn't really been very encouraging for Tata Motors. It's been rather tepid. What do you make out of it?
Yes, I think that is what I said, that I think having corrected the past, I think they are now ready to grow. I think in a business, when you are looking at investment, I think you have to look at the future prospects which the company brings in. In this case, I think the future prospects, I think, remains extremely strong, but their past balance sheets were not allowing them to implement those prospects, which is now a situation where they are probably getting into the implementation mode. The balance sheet has been cleared as far as I think the cost reduction aspects are concerned, rationalization is concerned. And at the same time, I think that now the demand scenario is opening up for passenger vehicle, commercial vehicle, electric vehicles, and most importantly, the COVID-related effect on the Jaguar portfolio, JLR portfolio, is now also overcome. So all in all put together, I think the company is showing reasonably good growth prospects for growing, irrespective of the past where I think they could not grow or they could have tepid growth.
All right, Mr. Choksi, we're just gonna leave it at that and gonna now navigate our discussion to the second guest that we have on the show, Siddharth Bambre, EVP, heads also research for Religare Broking. Well, your top 3 picks there, and of course, a small request if you could, make it a little more crisper so that our audience could capture it all.
Sure. Firstly, thanks, Nikki, for having me on your
Pleasure.
show. And we wish, from Religare Broking, happy Dhanteras and happy Diwali to you, your team, and all the viewers. So we are playing with safes, and hence we have all 3 large cap names. And TCS is the first name which I would like to talk. Now, one thing before I talk about TCS, the overall industry, Nikki, it's been like 2-3 years we are listening that US will go in recession and IT will have a problem. And that's the reason IT stocks have underperformed in last 1.5 years or so. But last couple of quarters, despite negative news, we are not seeing heavy corrections in these names. You need to understand that either you will have a valuation support or you will have cushion of high growth. Both cannot exist together. And right now, IT has valuation support and growth will follow because there's a lot of transformation which is happening because of digital space and of cloud technology. And we believe that orders is not an issue. There is some execution delay. And TCS, why TCS? Because TCS is least volatile in terms of predicting their earnings, or be it on the margin fronts or be it on the growth front. And at this point of time, TCS is available at around 21 times valuation 1 year forward. And very rarely we see a brand like TCS available around 20. Good valuation support, order book is strong, and barring coming 1-2 quarters, we believe that again the trajectory of growth would be higher. Plus, attrition ratios have come down from 21-22% to sub 15%, which was the problem in IT space. So, I believe all factors, barring this overhang of macroeconomy, we believe TCS is a good addition to a long-term portfolio at this level. The second stock I want to talk about is Maruti. We also had this stock in our previous Samvat, and we continue to maintain it. Maruti firstly has stopped, reducing its market share. It came down from 52 to 43%. One thing I want to say more about industry. Earlier, Nikki, it used to be that if you are launching more product, then there will be room for higher growth. I think for some time to come, the situation has changed. It is not just about launching new product, but it is also about the ignition system, the fuel type transformation which companies are doing, like EV or from petrol, diesel to CNG. So Maruti no more has diesel cars. A lot of people are talking about the EV, but we are quite optimistic of Maruti meeting its numbers through sale of CNG vehicles. So all its models are now coming, at least the entry level to mid level are coming in CNG segment, and Indian audience is very welcoming towards CNG. So I believe uh, falling metal prices, falling commodity prices, growth rate to be strong. Maruti is a decent buy. TCS also we have around 20 to 23% upside. Maruti also from current levels we are expecting 23% upside. Again, valuation wise, there's a valuation comfort to Maruti. It's available at 22 times, and we are expecting around 27 times multiple we are giving, which brings our target to somewhere around 12,700. The last stock, Axis Bank, you can't be, bullish on markets if you don't talk about financials. Why Axis Bank? Why not HDFC or ICICI? Because Axis Bank is outperforming. We are seeing a decent growth. In fact, the growth is higher than industry, other peers. Also, the acquisition of Citibank customers is adding good cushion to the margins. Where other banks we have seen declines in NIMs, we have seen Axis Bank holding to its NIMs of around 4.1%. The CASA of customers acquired from Citibank is around 70-75% or so, or more than that. So I believe growth trajectory, wealth management business, credit card business are doing pretty well for Axis, and that remains a preferred pick in banking space. We don't have very aggressive target, but 14% upside from current levels. So these are three names: TCS, Maruti, Axis Bank.
Pretty much it, but I have two follow-ups for you. Typically for TCS, where you made a good point where you spoke about the valuation perhaps, and you also spoke about the growth profile. Both cannot be matched together, but a bit of concern for TCS is that despite bagging incremental large deals signed by the company, the double-digit growth really isn't likely to come anytime soon for FY25 also, according to most of the brokerages. You think the company will need a combination of cost takeouts and digital transformation deals? How soon you think this could be achievable? If not for this year, then FY25, do you expect the growth to come in by FY25 in that case?
See, I don't think so anyone has answer to that, and we all have wild guesses. What is working in companies' favor, Nikki, is, or as far as I would say for the entire industry, is that 1.5 year back, there was a lot of margin pressure because the cost of employees was going up, and that's the key cost. And that is reducing. So despite top line not growing very significantly, we haven't seen any significant pressure on margins. And I accept, and that's the reason valuations are available at these levels. That for next probably 2-3 quarters there may not be a significant growth, but one needs to understand that this growth is not because there are no orders. People are, clients are delaying because of uncertainty in macro environment, and we will not get into it that why there is uncertainty. We all know that, and that's the reason valuations are cheap. So I agree to it that growth will not be very significant in coming 2-3 quarters, and that's the reason stock is available cheap. So we would suggest buy, because as 1 or 2 quarters go by, market would start looking beyond these concerns and again would start giving higher multiples to TCS.
So that point well taken. We are now going to graduate our discussion. Both Deven and Siddharth, please stay on with us. We are again going to come back with 2 more questions for both of you. But Shrikant Chauhan, who heads the equity research for Kotak Security, also joins us. Of course, he's been there. Talk about the 3 Diwali picks that you have for us and the rationale behind the same.
Yeah. Very first, thank you very much for having me on the show, and happy Dhanteras to you and to all the viewers. My first pick is from the BFSI space, on which we are specifically bullish with a medium to long-term view. And the pick is Canara Bank. Canara Bank has reported a very strong earning growth of approximately 43% year on year. Also, if we go through with its net interest income, then there also the growth is almost around 20%, which is healthy. The bank's asset quality has continued to improve, and if we go through with the loan growth, then that is also like somewhere close to 12% year on year and 4% on Q-on-Q basis. So despite all this strong performance and consistent upward activity in the stock, as well as the improvement in the fundamentals, if we go through with its overall valuation, then it is still trading at discount to its PSU banks and peers. So it is available at 0.7, 0.8 times to the book value. So based on all these reasons we feel that Canara Bank should do well, and we have a target of close to 425. Currently, it is at 385 levels, but in case if there is any correction, then we should look for adding it because we are expecting stock to do well in next at least 6 to 12 months of time. The other stock on which we are bullish is Philips Carbon, and the company is a leading player in the carbon black industry within the country. They are also like a good position to take advantage of any opportunities that arise. And recently, we saw a quick correction and drop in the crude prices, which will help to tire industry and indirectly it will help to the company. So broadly, we are bullish on the company, and we are of the view that it has also low leverage, low cyclicality, and its return ratios are consistently improving. Also, its specialty segment is really doing well, and it has very high margins. So that will actually help the company in the long run to adjust with the cyclicality business of the company. Currently, it is trading at 17 times to its FY25 EPS. But if we consider the EPS of FY25, then it is close to 11.7 times, which is reasonable. And based on that, we are expecting stock to trade somewhere close to 260 in next 12 months of time. So fair value is around 260. So we like Philips Carbon as well as Canara Bank. And the last one is from the FMCG space. And again, the reason is same, that the crude prices are now stabilizing somewhere close to $80 per barrel, which will help achieve, I think, going to help all these FMCG companies. But in that specifically, we like Godrej Consumer Products. As we all know that it is into personal care and home care products. But apart from that, the overall, if we see the overall its business, then the company is getting its business on not only from the domestic side, but also from the overseas, like Indonesia and African markets, and which has actually helped the company when the volumes are dropping. And if we see other competitors, then there we saw a good amount of drop in the volume. But this particular company has managed to, here also we saw the drop in the volume, but still it is much better than the competitors. Also, if we go through with its current fundamentals, then it is 20% discount to its peers. So broadly, we are of the view that Godrej Consumer is also going to do well in next 12 months of time. The risk-reward ratio is quite favorable, and we are expecting stock to move towards 1130, 1140 in next 12 months of time.
All right, Shrikant, one follow-up question that I have for you. Canara Bank is a good bet. Apparently, PSU banks have been the flavor of the season, but I want to focus more on Philips Carbon. There is a few of concerns there. You think slowdown in automobile sector, put together a sharper rise in crude oil prices, given the kind of geopolitical concerns that we're sitting in with, could result in higher working capital requirements for the company?
Yeah, that is what I said. Right now, the crude was somewhere close to $95, $100 per barrel, but now it is quoting at $80 per barrel. And again, if we go through with its overall entire business, then company is moving from its cyclicality business to specialty segment, where the business is very, very high. So wherever there is a black, the company is into that. Okay, so the business is definitely going to be more and more interesting in next 12 months of time, and in fact in next at least 12 to next 1 to 3 years of time. So they are reducing their exposure from the cyclicality, the way Reliance has reduced its exposure from cyclicality to retail and to telecom. Similarly, the company is also trying to the same, and based on that, we are bullish on the stock.
All right, Shrikant, those were your 3 bets out there. But to all the 3 gentlemen out there, I would want to ask this somewhat your top advice to our viewers on what not to do this Diwali. And of course, we're also going to be getting into a special conversation with Rahul Arora from Nirmal Bang, who's going to talk about the entire Samvat put together. But first, we're going to start off. Rahul, your word before we get on to a detailed conversation with you as to what do you make out of the entire Samvat. We're going to hold on to that thought, but first go to Divyen Choksi. Sir, how are you going to view your first typical advice to the investors out there, what you ought not to do in this Diwali? Mr. Choksi?
Advise him. But I think from the experience that I have, and I would like to put it across and share with them, Uh, See, basically, you are operating the derivative market with about 95 to 96% of the volume traded, with 5 to 6%, I think, traded in the cash market. My advice to investor would be that I think now you have got another 10, 12 years in which I think you are likely to see India's market capitalization going up by 3.5 to 4 times from now on. By 2035, we are expecting the market cap to be somewhere around $12 trillion. If this particular situation is there, then I think it makes sense for anybody to take the fullest advantage of this situation by staying invested into the businesses which they select. The consumer oriented businesses are maximum preferred because they have been creating best wealth, I think, for investors. In my viewpoint, I think they should possibly focus on this aspect. Currently, I think we are seeing a typical habit of trading in the market through derivatives. Derivatives are good for short term, yeah, but I guess I think for the long term investment, wealth creation, where we are talking about, I think one should stay invested and I think give the power of compounding to your portfolio so that you can create, I think, a good amount of wealth over the next 10, 12 years.
All right, Mr. Choksi, we're going to leave it at that, and thank you for taking out the time. But I'm going to go to Siddharth and check with him what's his advice on what not to do this Diwali.
Nikki, so I would suggest don't depend on anyone else or so-called expert to make money or wealth for you. People like us come and talk and we give our advice. You need to listen to us. You need to understand it thoroughly. Go back, do your homework, and then buy it. Means I see that people, if you want to buy a phone, you see so many variations. You see so much of different type of phones, and then you make a decision. And I think same sort of exercise should be done for selecting stocks, whether it's derivatives, whether it's equity, commodity, or currency. I think everywhere you can make money and everywhere you can lose money. It is just that how disciplined you are. And I think you should now start taking responsibility of your actions rather than blaming any expert or brokers, because we all are learned and we are all now privy to all the information which is available. So take your destiny in your hand, not in hands of broker or experts.
All right, Shrikant, your advice for what not to do this Diwali?
Yeah, I would say that money management is extremely important, and if you are like not able to understand the market or maybe to invest in which company to invest and all, then definitely you can depend on the research of experts. But at the same time, money management is something where you cannot park all your funds in any one stock or in any one sector. One thing. Second thing is that the way the formation of the market and the way there are like the flows are there from the government, I think these markets are definitely going to give a good amount of returns to the investors in next 2 to 3 years of time. So the strategy should be to buy on every dip instead of panicking if there is any correction in the market. And the last but not least is that try to buy good companies, the solid companies where the pedigree is really strong. So if you follow these few, I think, strategies or maybe rules, I think you can make very good money in this market.
All right, gentlemen, we're just going to leave it at that and wishing you all a happy Diwali and Dhanteras again. But I'm going to quickly...
Thank you.
Thank you all.
I'm also going to navigate now our conversation to Rahul Arora, who is the CEO of Nirmal Bhang, and of course ask him about how Samvat 2079 has been for him, what does he expect in 2080, and of course broader themes and the stock picks that he has for our viewers. Let's start off with the basics. Samvat 2079 typically was completely a year of unexpected. We saw most of the performers, or let's just say large cap companies, the industry leaders, seeing a bit of underperformance, and of course mid cap and the small cap index pretty much outperformed the markets. Do you expect the trend to continue? And if yes, what are the themes that are typically that one need to watch out for in the Samvat?
Well, Nikki, I think when we started off last Diwali, I don't think anyone would have expected the next 1 year to be as crazy as it was. I mean, you've obviously had the Ukraine-Russia war enter into a second year. You've had crisis in the Middle East. You've had an entire year where interest rates have continued to rise in India as well as in other parts of the world, including the United States. And the US has not gone into a recession. I think that's one call everyone in the world has got wrong. I think everyone thought that the US would go into a recession at some point this year, but look at the resilience of the US economy. So I think too much has happened. And I think in the court, 19 and a half, 20,000 on the Nifty, I think it's a very good place to be. That being said, as we look ahead to the next 1 year, I would say be cautious. Don't be over exuberant. Two of the largest democracies in the world go to elections next year, with us in May, situation where you're going to have a little bit of fiscal slippages on both sides, where the government is going to look at increasing spending, either through infrastructure or for the masses. But I think all said and done, if we are sitting at similar levels around next Diwali, I'd be reasonably happy. And that's not to say that it's not going to be a volatile year. I think we are going to see 10-15% corrections. You are going to see 10-15% kind of rallies. But net, if we are sitting somewhere around 22,000 next Diwali, I think we would have had a pretty good year. Also, Nikki, don't forget, this has also been a year where you've actually competed for asset classes. Fixed deposits became a very interesting source of investments. Gold has had a respectable year. Real estate has done pretty well. So not just looking at large cap, mid cap, small cap, I think you're actually looking at asset classes competing with each other. But I think the one thing I'm sanguine about is if India is going to compete with one market for flows, it'll be the United States. So I think we're still going to be the biggest beneficiary of flows into emerging markets. And I think a lot of it find its way into large cap stocks.
Sure. Rahul, I'd want to ask, which of the themes do you think have been apparently overplayed in the market? Do you think it's broking perhaps, or defense, or for that matter, banks? Which themes do you think are a little overplayed at this point of time? And what could be the next hot theme coming in for Samvat 2080?
So I think you've kind of hit the nail on the head, Nikki. I think there are so few niche sectors that unfortunately when one gets discovered, sort of everyone rides the bandwagon. And we saw that with chemicals and specialty chemicals, at the peak of COVID and the kind of returns those sectors gave. As you rightly pointed out, I think defense is something that people have latched on to. I'm not sure if valuations make a very compelling case from a one-year perspective, but of course, if the current establishment was to win the next election as well, they've made their stance pretty clear on what they believe in terms of Make in India and how they see the defense sector evolving. So I think if you have a 5-year view, it's still a sector that you could potentially bet on. I think most PSUs have had a remarkable run over the last 1 year. So like I said, I think if you broaden your horizon to 5 years, then it makes sense. Immediately from a 1 to 2 year perspective, I'm not entirely sure. I think banks are priced to perfection. And I think you make a very interesting point, because I think even in the quarter gone by, you have seen on a case-to-case basis, there is still some pressure on net interest margins on a case-to-case basis, still some pressure on asset quality here and there. By and large, the sector is in good fettle, but can the bank nifty head to 50, 55,000 over the next 1 year? I have my reservation. So I think that the trade.
All right, we'll try and connect with him again. It looks like we are also going to be chatting about top 3 recommendation that needs to be on your watch list from Rahul. So we're going to be trying to patch that line back, but so far it's been good show that we're looking at 9 to 10 actionable ideas from the space. Rahul, just a last follow-up question that I have for you perhaps, and most of the viewers would want to know I know you don't talk much about stocks, but since it is a different occasion and a special occasion out there, 3 top picks that you think coming in from Nirmal Bhang, and also the rationale behind the same.
Sure. I think let's make it a mixture of large caps and mid caps. I think from the large cap space, I would look at, say, something like a Britannia and a Polycap. And I think from the mid cap space, we could look at something like a United Breweries and a Triveni Turbines. I think if you look at Britannia, it's been such a remarkable story, right? The distribution has doubled. The margins have expanded. I think commodity prices for them have by and large peaked out. Most of their capex is either on stream or going to be coming on stream in the next year or so. So I think this is probably a company that will compound its earnings and its top line at somewhere between 12 to 15%. Maybe, the operating, the EBITDA and PAT level, it might be a little higher. But for a company at 45-50% return ratios, 100% plus return on invested capital coming to you at 40 times, I think that looks like a reasonable investment. Polycab, I think it's been one of the biggest star performers in terms of beating earnings expectations over the last 3-4 quarters running. I do understand the stock's done really well, but I think if you hold this name, it could give you about 15-20% returns, as is the case for Britannia. I think in the case of Polycab, Nikki, the kind of investments that's going into power, right? I think you're talking about power generation going to 900 gigawatts, of which almost half of that is going to be renewable. And then, of course, you have about $3 to $4 trillion worth of investments going into the power sector. It's only going to help wires and cables, and Polycab having double-digit distribution as well is going to be a market leader there. You know, I was reading some real estate reports. Real estate is expected to grow at a CAGR of 15%. So all these things considered, I think Polycab, for the market share that it has, again, almost a 50% return on invested capital company, should look like a good one. United Breweries, it's wedding season. The World Cup is on. We head into summers after that. You know, I'm sure a lot of people are going to be drinking beer through this period. Winters is a very good time also, actually, for consumption of beer. I think the margins, which were about 8% in FY23, we're expecting that to go to about 18% in FY26, which basically means you're looking at about a 40-45% earnings compounded, which is remarkable. We value this company on an EV to EBITDA. I think it's coming to at about 26-27 times. We can value this company at about 30 times, and you probably get, you know, a 25% kind of return on this name. Again, you know, all the route to market issues are sorted out. And there's a very good chance, Nikki, over the next 3 years that the profits of this company actually double. I think from about 800 crores to about 1600 odd crores. And maybe one last thing, if I throw in there, would be Triveni Turbines from the capital goods sector. Again, you know, a sector that's done really well over the last few years. Very strong return ratios, return on equity and capital employed at 35% plus. Coming to you at about 30-32 times, not the cheapest, but for a 30-35% kind of revenue and profit growth, and the kind of growth that you're seeing in both the exports side of the business for them, as well as the aftermarket, which grew at about 70% in the quarter gone by, I think valuations are fairly reasonable. So I think these would be some of my 3-4 top ideas if I was buying into this Diwali and going into next. Something like a Polycab and a Britannia in the large cap space, and United Breweries and Triveni Turbines to the mid and small cap space.
That's pretty much sums it all. Interesting bet coming in. I mean, shares of FMCG firm Britannia, there's been in have surged on almost 20%, logging in the maximum gains. Interestingly, it was the 52-week low that the stock scaled November 4, 2022, and within 9 months, we saw Britannia actually scaling in an all-time high of around, you know, around July 6 for that matter. Some more steam perhaps left in for this one. But we're just going to leave it at that, Rahul. And thank you for taking out the time and speaking to us.
Pleasure, Nikki. Thank you so much for having me.
All right. With this, it's a wrap. And goodbye from the entire team who puts this piece together. Thank you so much for watching. And of course, happy Dhanteras and Diwali to the family. I hope to the viewers, family, there's a joy, abundant success in your investment. May the coming year, Samvat 2080, bring wealth and good fortune to you and your loved ones. Happy Dhanteras.
Hello and welcome to the Moneycontrol Diwali party. As we head into the new Samvat, the mood on the Lal Street couldn't be more upbeat. If you just pause for a moment and think about how we started this year last October, there were so many headwinds: rising inflation, interest rates, the possibility of a recession in the US, and remember the fear on the street after the SVB crisis? Well, we survived all of it and even hit an all-time high. Truly, this Diwali, no complaints, we must party. So guys, welcome to Moneycontrol. I'm Mahalakshmi and I'm truly delighted to host this amazing Diwali party. Over the course of the next 1 hour or so, we will talk about the patakas and damp slips, the stocks that lit us up and the stocks that let us down with our special guests for the evening. And then we will ask our guests for show of truth or simply challenge them with a dare. And finally, we will have the Antakshari round where our experts will be allowed to take down each other with singing. And let me tell you, you will be surprised by the singing talent in this room. So let's get started. First things first, let me introduce the special guest for this evening. Mansi Sajeja, Fund Manager, Fixed Income, SBI Mutual Fund. Amit Jiswani, Founder, Stallion Asset. Kush Bora, Founder, kushbora.com. Rohit Srivatsav, Founder and Market Strategist, IndiaCharts.com. Lakshmi Iyer, CEO, Kotak Investment Advisors. Vikas Kimani, founder, Carnelian Asset Management, N. Jay Kumar, MD and CEO, Prime Securities, Madhusudan Khela, veteran investor and founder of MK Ventures, Sameer Arora, founder of Helios Capital. So let's start this fun evening with some fireworks. Pataka time.
You're watching this mega Diwali party on Moneycontrol, where we have an esteemed panel of guests. And Diwali hai, to of course patako ki baat to hogi hi, right? So let's make this party even more dhamakedar by talking about some pataka stocks or cracker stocks. And we have assigned some cracker names to some stocks based on their performance, and we will be talking about just that. On this screen we will be bursting some crackers, and that will reveal some stock names that are corresponding to those patakas. Well, ITC, this has been one meme stock. ITC, it has been a meme stock for quite some time, but then it did manage to surprise a few by crossing that 400 rupee mark. And right now, of course, we are all waiting for it to cross another milestone of 500 rupees sometime soon. I know you don't track levels, but your overall view on ITC?
We've been lucky that we bought ITC at a good price, and I think maybe that's why Mahalakshmi remembers it. So when something is working, I normally don't try and bother about it and look for other things which are not working. Yeah, we hold it, yes. Big position.
And what are you waiting for?
We are waiting for it to underperform, then we'll sell it off.
Come back to your purchase price?
No.
Kitna underperform?
Matlab, it should look, it is tired and it is not. So what am I to do? There are so many things which are not doing well, so I spend my time on that. Things which are doing well, I have other things to worry than to why they are doing well. So it's doing well and we are happy with it.
Fair enough. Anybody who has a negative view on ITC?
Yeah. I've got a negative view. I cannot buy companies which grow at 4%. This quarter revenue growth was 4%. India's nominal GDP growth is 14%. For anything which grows less than the nominal GDP growth, there was a time it was, so you need to be super cheap. Like Sameer ji also bought it when it was super cheap. It's not that super cheap anymore. I wouldn't buy ITC. It's already 73% of India's market share of cigarettes. Volume growth last decade has been probably less than 1-3%. So I wouldn't buy it. Like as a trade, it's okay. You can keep doing up and down. But for an investment, ITC profit this year is around 19,000 crores. Do I expect this profit to be about 40-50,000 crores in next 5 years, 6 years? There's no way. It's not possible. So if you cannot even double, like if I can't see doubling of profits in 3 years, 4 years, 5 years, 6 years, unless the stock is super cheap, I wouldn't have bought it.
I am seeing Sameer charging
ahead. Portfolio is not run for bull market. People are confused about what happened from COVID to now as if that is normal. We have seen every 3 years some new stories come up and they don't normally last. If you see for the last 27 years, every time there is a new thing and an old thing. And the portfolios have to be made for har term ke liye, not just one kind of market.
Madhu, you want to add to that? All right, anybody else?
She's got better questions.
Okay, come on, go ahead.
I'll take that as a compliment, Madhu. Come on. But let's get on to the next pataka then, if you can have that on the screen. Okay. DMart. I think that was a first pataka. Well, DMart is a quality stock, of course. All of us know that. But of late, it has been stuck in a range. But, if you look at the stock performance, since last Samvat, it has lost somewhere around 13% or thereabouts. Any views on DMart? I would like to go to Rohit here.
Yeah, well, I like to just, track the strength, relative strength and momentum of each and every stock. And I think DMart right now is not showing that. And when it does, probably we pay attention to it again. But right now, it's not in the list.
Okay. Clearly a first pataka then.
It's not a question of being divana, but I don't think you can pick up a particular period and make a story like this. It is one of the biggest success story of Indian capital market. Person who was in the capital market created a real company, and it is up minimum like 10 times since the time the IPO was done. So every person who bought it in IPO post-listing has made tons of money. So it is unfair to say just because the stock has not done well in 12 months that it is it's not a good company. I think it's a great company, and every investment, whether I don't think of any investment which may not have gone. All good companies go through a period of consolidation, and they go through a period of a muted return.
That's
so
correct.
it might be you're just going through that period. You can't term DMart in that sense that it's not a. I think it's a great company. It's a great story, and we are so proud of knowing Bhai Sahab so personally well. I think it's the best well-governed company of India and the biggest wealth creator in such a short span of time.
Absolutely. So I agree with you, Madhu, and point well taken. I think that reference was only with respect to last year, and it's not a reflection of the company, it's a reflection of the stock over a very short period.
That's why I had to speak up.
Correct. So my question is this, you have a great company. We know there are lots of great companies, but they don't necessarily make for great stocks at a point in time. Jake's come in.
No, actually I go one step further. The fact that it is consolidated the last 2-3 years, and it's a company that's grown dramatically. They've opened their, I think, 340th or 338th store. The sort of footfalls across India are dramatically expanding. Every store is a success story, and the business models have actually been outstanding. So if there is a case to be made, I think it could well be a pataka into the next whatever period that we choose, because the consolidation of the last 2-3 years, to me at least, indicates a great time to pick up. A lot of people in the market, they say the difference between commodities and stocks. As prices go up, the demand for commodities goes down, but the demand for stocks as prices go up actually increases. That's greed and fear. So from that perspective, nobody likes to buy stocks when they're consolidating, but a great business, consolidated 2-3 years, and on the ground reality is that whether it's revenues or profits are growing, I think it's a good time to be actually looking at this stock, and could well be a pataka into next year or year thereafter.
Sure.
All right.
Anybody else has a differing view on DMart? Otherwise, we'll go to the next pataka.
Vikas, you have been very quiet.
You want to wait for the next pataka?
I don't have any differing view. I think what Madhu has said is absolutely fine. It's a great company, and there are times when companies do consolidate. So of course I do find it slightly expensive than what our flavor is, but there's no question about it.
To sum up your view, essentially you're a buyer in DMart right now. I mean, this is bad time, but it could be from a stock perspective a good point to sort of enter.
I think if people like good businesses that are consolidating, and especially for periods of time that it has, I think it's a great time to look at it. Because from the year-to-year numbers in terms of whether it's revenues, in terms of stores, etc., nothing has stopped.
Sure.
So my own feeling is, for stocks given you that luxury of consolidation of this kind, you should look at it.
Fair enough.
All right, we'll clearly watch out for DMart, next Samvat, since, people have, of course, such great things to say about the company, and of course, rightly so. But let's bring on the next pataka. Let's see what pataka it is.
Lakshmi Bomb. Or is it a food pataka?
Okay.
All
This
right.
has also
All
kind of disappointed us a little. But given the fact that, we have spoken about consumption stocks at length now, but this stock is also, of course, from the consumption space. Volume growth remains an issue for some of these, large cap FMCG names. For somebody who's looking to invest in these companies right now, do you think the kind of dip that it has seen since last summer, 3% or thereabouts, do you think this is the time to actually accumulate these kind of companies, because the long-term story remains intact, right?
Only our leader can speak.
They can instead invest in Helios FlexiCap fund.
I can add to that. When we look at the MNC consumption stocks, they've actually had a very cyclical behavior. 10 years of outperformance, 10 years of underperformance. So through the 90s, they were outperforming when all the cyclical sectors in India were not really doing well. Then you had a phase where the economic sectors were really doing so well that these sectors were not really attracting money, and they really underperformed for 10 years. And then the same thing repeated through the 2010-2020 period, where you had outperformance by the consumption stocks all over again. So my sense is you're now again in a phase where you're investing in growth, and therefore you would underweight this sector.
Fair enough. Next pataka.
Don't tell me it's a Lakshmi Bomb again. That doesn't take off. Of course, Nykaa. I was actually waiting for some of these new age tech companies. Nykaa has been one stock that has not been that has not managed to make a comeback. Unlike names like Zomato, PB Fintech for that matter. 26% drop since last Samvat. Anybody has a view here? I see Kush smiling, and I can see even Vikas looking to answer this one.
I mean, we've never bought Nykaa, and Nykaa is again a great business run by a great entrepreneur. But in investing, you always look at risk reward of investing. Just because, I mean, they are a consumer company, but just because it is delivered through internet does not mean that, you can get obscene valuation. So, I mean, technology, the way I understand it, technology is an enabler. It's just a normal consumer company with added technological enablement. And of course, they created a very nice niche and all. So it's definitely good at a price, but I think it will still consolidate. If I were to look at normal metrics of how do you value a consumer company, I think still it is probably will give some time, and as the revenue grows, I mean, you might see still some sort of underperformance or negative performance continuing for some time till the time revenue catches up or market cap catches up.
Sure. So Madhu, why is it not performing? I mean, is it because of potential disruption? What is it? Because other stocks, I mean, I see a lot of people have a lot of, optimism around Zomato, for example. Samir has bought Zomato. Lots of other people have also bought. They see it as a company which has strong competitive advantages, strong moat. But Nykaa, lots of people don't agree.
So I think one perspective to look at these things, what kind of value has Nykaa created in the last 10 years? Right, you go and speak to a private equity investor who invested at a very early stage. He is still laughing his way to the bank, right? And whenever you have this kind of disproportionate return, obviously the natural outcome is some period of consolidation, even in great companies, right? And we have seen markets for 30 years, and it is not very unnatural. So as Vikas was saying, some of these companies either will have to show some exceptional growth to justify this valuation, or they will have to pass consolidation period of time, or the prices have to fall. What happened in case of Zomato, it fell by 75-80%, and it became attractive. From the price it got listed, and of course we have seen tremendous growth happen quarter after quarter in all the metrics. That's why the stock is doing well. And at some point of time, Nykaa will fall also into that category, and that's a period which we have to wait.
So it is purely a function of valuation, you're saying?
Absolutely.
It's not to do with the moat.
Function of valuation and growth.
Okay.
And see, my philosophy is very different. See, either you can be proud to own a company, or you can be happy to own a company. I always focus on happy to own companies, not proud to own companies. So a lot of these companies, they look very good on your portfolio if you have to show to the world and you have to say that, okay, I'm investing in very good, beautiful blue chip companies. But there are periods when blue chip companies also don't do well, right?
Surely for this year that is true.
Sure.
Lots of them didn't do. Next pataka.
Well, let's take a look at the next pataka that will be coming up on our screen. Hopefully, it won't be a bomb going kaput this time around. But I think plenty of other patakas we have assigned. वो सब misfire हो रहे हैं for some reason, but I'm sure this time around we will take off. This time around it will take off. Let's take a look at the next pataka. I'm sure it will take off this time. Okay, this is a rocket that we are trying to fire, and looks like PB Fintech. Okay, of course it has been a rocket stock. It has taken off like a rocket over the last 1 year. You have. I want to get in Jake's view on some of these new age companies, including PB Fintech.
I think the market faced the music when they fell, so we don't need to sing right now.
That's a good one.
No, the way I see this is some of these companies have continued. I mean, they fell to valuations which were 50, 60 to 80% from their issue price. So they became, optically inexpensive. But companies like Zomato or Paytm, for that matter, have stayed with their knittings. So, just to take off from the Nykaa, one of the things I could have maybe as a fault against Nykaa was that they've opened up the moat and moved into other areas where things like fashion, etc., where money is being burnt by most companies. So one could say that the what's called BPC, the beauty and personal care platform, has been, that moat has been given up, if you will, or you've opened up other fronts. Whereas that's not the case with these companies. They've actually stayed with their knittings, and as Madhu put it, the numbers that have come out, financial performance, on specific metrics, whether it is, Zomato's case, or it is PB Fintech's case, or Paytm for that matter, have improved dramatically. And my personal feeling is that the market's given them not just a second or a third chance, because they optically fell, they actually fell 70-80%, and they have now performed subsequently because the financial metrics warranted it. So I think the market's very discerning, and to that extent, the points that I made are specifically for these three companies.
Sure. So at these levels, Amit, you are a buyer again in some of these counters. Do you see value?
Mahalakshmi ji, we look at frameworks. For us, our understanding is that in Q4 2024, like in the next 2 quarters, Paytm will be PAT positive. Zomato for last 2 quarters is already PAT positive. PB Fintech, if tomorrow are the numbers, so it may be PAT positive tomorrow. The last quarter losses were 12 crores. But I can with 99% conviction say that in Q3, December quarter, because the ESOP cost is going down by 40 crores, it will be PAT positive. So when an entire sector becomes PAT positive, the supply has largely been absorbed, and there is high growth of 30-40%. See, we can change minds. If the growth doesn't come, we change minds in one day, in a few minutes also. So, but till the time the growth is there, like Paytm, I'm telling you, the adjusted like ex ESOP cost profits, we estimate around 1,000 crores this year. So at 50,000 crores market cap or 830 rupees stock price, that is the way we think about it, that if the growth is 30-40%, you will get, it typically trades at consumer facing companies with network effects, trade at decently high multiples. And for us, if we go right in 20, see, the whole game is that how much do you lose if you go wrong, and how much do you make if you go right. So Zomato, PB Fintech and Paytm as a basket will become massively PAT positive next year. If we go right, we make a lot of money. If we go wrong, we lose some money and move out and find something where we think we'll make money. So for us, these are...
So neither a buy nor a sell right now for you, it's just a hold.
Yeah.
Well, we have just 2 months more to go to the year, so looks like they may continue to be net sellers in equities, but net sellers in fixed income, and that's been the trend in the last maybe 3 to 4 months. Everything that a woman doesn't carry, which is no makeup, no mirror, no lipstick. But it's got all the plastic cards, because I'm a no cash person, so all my credit cards, my charger, which is the much needed caffeine to my phone, because I'm a zero caffeine person. That's about it.
Retail investors to capitulate?
Yeah.
Absolutely not.
Okay.
I think retail investors are in fact the
I think it's a strong possibility. Powell is just about there. A few data points that they may look at, and yes, it's possible. आज मैं ऊपर आसमान नीचे as today I'm on a high and the sky is below me. I really don't know where I'll end up, but 2024 is something to look for.
Mostly unlikely, but if it does, then you'll have to give up some of that in the following years. Closest guys to me here are Madhu and Jakes. Madhu Kela is making so much money that if I could copy that, that would be enough. Jake sings very well, and if I could do that, I'll be happy with that too.
Amit, I'm sorry. You said laddu. I mean, I can't give you sweets, right? So this is for Lakshmi. She doesn't have anything that she said a woman has in her purse. So yeah, I mean, wouldn't hurt, right? As an exception.
Okay, now time for some more patakas.
Adani stocks. So, of course, a topsy-turvy year for Adani group of stocks. I want to get in Madhu's view.
So again, I'll repeat the same point. If you look at from A point to B point, things look different. But if you look at the history of these companies for maybe 5 years, they have, I think, produced extraordinary returns for people who had conviction in some of these stocks. And as a disclaimer, I must say I'm a beneficiary that I had the conviction at that point of time. So obviously, some of these companies had become more valued. There is no doubt about it. But if you look at the performance of some of these companies, I think long term, selectively, so I don't want to say Adani Group. I like companies, I like renewable company, I like specific companies, and I would continue to be invested in them.
Sure. Right. Sameer, your thoughts on this, because there are a lot of multiple views around Adani stocks. Of course, domestic mutual funds were never big on Adani stocks, but the fact is that going into elections next year, it's seen as a politically connected stock. So there is a lot of mixed feeling around whether the value that one sees in, let's say, ports or Adani Enterprises.
Can I comment that on the political front? You know, Adani is biggest in all Congress states as of today. Their business is very little in actually BJP-run states.
No, I'm talking more about the stock market perception.
So
that will there be more back?
We did not own it before, but we bought it in Feb, and I had to tell everything on TV. So I said that Adani Ports had fallen too much to some 450 or something. I even bought a Muja at that time. I still own both the stocks.
All right, cool.
All right, the next pataka, let's light it up then on the screen. Waiting for it to fire. Okay, so it's the ground. What do you call it? Chakri in Hindi. Infosys.
Chakri. It's a ground wheel.
Chakri in market parlance means something else, but it's the
ground wheel.
Ground wheel. That's the right word, of course. Thanks, ML, for helping me out there. But Infosys, of course, IT stocks have had a very painful year, so to say. They did try to make comebacks, and now slowly people are expecting FY25 to be the year of recovery for some of the IT stocks. I want to get in Vikas on this one.
I think we've been very positive on IT. I mean, not so as much on the large cap IT, but mid cap ITs. But I think there was a narrative in last 12-18 months that in US IT demand is slowing down. But that is probably not the case if you look at the order book of the IT companies. Of course, when the environment is so fluid out there, management might not be very comfortable giving very aggressive guidance. But you know, especially the kind of companies which we have invested into mid caps, this year are up between 60 to 80%. All are growing between 18-20% kind of bottom line. So I think, you know, you got to, and these are the large companies. So Infosys, again, a great company. After Salil Parekh joined, I think it has created huge amount of wealth. And last some period, it has been going under consolidation. But I do think that IT, from a risk-reward perspective, I mean, if I were to compare it with the consumer stocks, they have similar kind of profile, but better valuations. I mean, they have similar kind of cash flow, similar kind of growth trajectory. In fact, some of the IT companies grew faster than that. So we've been kind of very positive on IT sector per se, and we like Infosys as well.
So I wanted to just come in on the IT sector and see, you took that that Jameen Chakri as an example. Also, we need to understand that eventually it will radiate light. I think that is where the perception is for the IT sector, because there is free cash flow generation happening in the IT sector, and after the price point correction that we have seen, some of them are really I would say own worthy. The sector per se, if you look at the entire mutual fund pack, also the sector is a pariah. It's absolutely under-owned. So there also, if you believe in the theory of mean reversion, so maybe it will take a lag, maybe of another quarter or two. But I think eventually, with every pocket of safety, and typically people try to own, I won't call it defensives as such, but in times of volatility, people tend to rush to safer havens. And I think IT sector, by virtue of being that under-owned segment, could call for a recall. But as I said, it takes a lag, because everyone wants the patakas which don't fuse out.
Sure.
That's a good one.
Next
but
one.
let's take up the next, or let's light up the next pataka, so to say. It'll be coming up on the screens as we speak. Yeah, it's an anar. I can see that, and it settles on Larsen and Toubro. Of course, we are entering an election year, and capital goods stocks, construction stocks have been in focus. Lots of positive sentiment around these stocks. Perhaps I would like to go to once again Vikas on this one, and then we can go to Rohit for levels, and even Kush in case he wants to give us some levels on L&T.
I mean, we own Larsen for last 3-4 years, and I think it's a clear. I mean, it's a stock which, if India does well, it cannot happen that Larsen will not do well. So if you see, I think the capex cycle which is going on across infrastructure, industrials, residential real estate, hydrocarbon. I mean, there is no segment, defense, there is no segment where L&T is not benefiting from, and all of the L&T segments are having a supercharged growth kind of thing. And on the top of it, in last 4-5 years, management has done a super job in terms of improving the ROC profile, and they've really repaired their balance sheet. And more importantly, I think now L&T is getting significant benefit from the Middle Eastern investment cycle, and which is again added advantage. So I think L&T will continue to remain flag bearer of Indian stock market, at least till at the next 3, 4, 5 years, till the time I think we have this massive capex cycle. And I mean, you can't have India doing well and L&T not doing well.
I'll just add to what Vikas was saying. In fact, this is one of the few large cap companies which I also own. It's been a 4-bagger in last 3 years. Since the time of COVID, it was available at around 800 rupees, now close to 3,000 rupees. A clear-cut flag bearer for the overall infrastructure sector, in which we've been vocally very bullish. So this is one company which has really done well in the large cap space. And mind you, this has happened in a period when there is hardly any return in overall Nifty.
Right.
Last 2 years, Nifty has hardly given even 5% return.
Correct. So Lakshmi, what is your view on the overall industrial space? Because we've seen a huge run up as far as the market's concerned. Some segments of the market, investors feel that we may have overshot in terms of price performances. Not to question the recovery, which is still at nascent stages, but in terms of stock performances, a lot of optimism already has set into the stock price. What's your view?
So, the private expenditure is yet to pick up in a meaningful manner. And when that happens, some of the re-rating in some of these segments are also not unlikely. Though the price point action obviously shows a lot of dhamaka. In fact, when you actually flash this stock as the anar, for the sector per se, what actually came to my mind, have you seen this movie, Rocky or Rani?
Yes.
Okay, in that there is this very interesting dialogue, which Rocky Randhawa says that taad lo jitna taadna hai, dekhne ki cheez hai, badi mehnat se banai hai, original hai, no steroids. So I think that is very much applicable for this segment and the sector. It's very synonymous. If India is going to grow and India is shining and we are all aware of it, then it's but natural that industrials led by the capex growth have to be part of it. There is no two ways.
Sure, I like that narrative. Guys, you guys are like, come on, movie dialogues and stories and songs. Lakshmi, you set the tone. Thank you so much. Come on.
Hello, next pataka, very quickly on the screens. Okay, Samir is getting bored, so the next question is coming to Samir.
Atom bomb hai.
Tata Motors, atom bomb hi hai ye. So, Tata Motors, of course, the kind of run-up that we have seen, I think it's, of course, rallied somewhere around 60%, if I'm not mistaken, on, somewhat to somewhat basis. But, Samir, I want to pose this question to you. Tata Motors...
not only Tata Motors, also the entire...
Also the other, Tata...
So, Tata Motors, I don't like. Because I don't like businesses where the capex is so much that for 5 years you have to spend about 3 billion a year, and nobody explains what will be the payoff of that. Because you were making cars before, you're making cars now, except that you have to put $15 billion to change from IC to EV. I don't see. There is a lot of discussion in the US now how EVs are actually destroying productivity. Because in the sense, not productivity, but it's a waste of capital. The cars were being made before, cars are being made now. Nobody is saying that you'll make more margin. Nobody is saying you'll have bigger volumes overall of cars. So everything is dependent on whether your capex will make your EV better than other people's EV, and who knows about that. So I don't like it.
So I want to ask you a question here, because you say your fund tagline is "Har term ke liye." So, for example, Tata Motors and M&M, at least in that space, is this term ke liye. Right now, the market
It's
seems to be
not true.
recognizing
It's
that,
not
you know,
true.
they are ahead in the EV race.
No, I agree. But I'm saying, just say, for example, if the stock is up 61%, there would have been maybe 20 stocks which are more than 61. If you have one of those, it pays. I mean, whether it's this or that, there are so many
So
stocks
the
that do
entire
well.
auto sector is a no-go for you.
No, Maruti I think is a little better now because Maruti
Because
is
they're not
moving
investing.
yeah,
They are not investing in EV.
actually, you
So-
should have a strong parent. Simple as that. Or in this case, the Suzuki is not a strong parent, but at least they should have some angle that you cannot assume that 100% will move to EV. These things we have seen in the past that things never move. You will always have IC engine, you will always have IC cars, and you will always have need for lower cars. And plus they have a roadmap, simple, that now you will sell more SUVs, your ASP will go up, your margin will go up. It's sort of easy to understand. This EV bit I don't understand.
I think I have a slightly different view than what Samir has said. I think probably Samir has missed
Yeah, I know that this
the
is as divided as
transformation
the
which has
sector.
happened in Tata Motors. I think if you see in last 5 years, after in Tata Group also, after Chandra sir had taken off, the transformation which has happened, if you see 7-8 years ago, Tata Motors was losing market share on CV. Passenger vehicles, they were not even there by any, well, only probably you could have Indigas and taxis and all those things. They were not there anywhere, right? That was there. JLR was a pain for them. If you see now from fast forward, they are CV, they are gaining market share. They've got the price realization better. PV, which was, generally it's not easy to create a market share. They are now gaining and leading market share. Gaining market share over last 3 years consistently. Today you see more Tata cars across. In EV, they are largest player from zero. At least in the new age or whatever new technology, they have become the largest player in the country, which is no joke. From nowhere in 5 years, the kind of transformation you have done. And now they are, this year they will generate $2 billion of free cash flow. They are guiding in 2 years time they will be debt free. The company which was saddled with all negativity suddenly is buzzing. If you interact with the management, is buzzing with energy and innovation and what they want to achieve. To me, this transformation is what Indian story is, and if you ask me what,
but that is already reflected in the price.
No,
That
this
is also
journey
the
can be long way.
transformation.
See, it's only starting point. Today, if you see EV is just, if India is a market, right, which is we're touching the EV growth story or PV growth story in that sense. So, if you count again on India growth, both CV and PVs will do well, and Tata Motors is taking lead in that. So I see no reason why this stock will not do well. Disclaimer, we own it.
This company is too complex to be analyzed by simple individuals. In one quarter, they lost $1 billion because the Brexit happened and they refused to recognize it till the CEO was fired and the next CEO came. You have 18 billion of hedge books. You have countries, 20 countries. We have to worry what is happening in China, what German companies are doing, what the in Brussels, what the policy. BMW trades at 5 times price to earning. We have no idea about the world. In India, it looks cheap because in India, everything is expensive.
But there's another side to this. By the way, while all this is there's an interesting thing in Tata Motors where from its lows, the Tata Motor DVR has given a 7x return. And I think, so you could actually play even without knowing the story too much, where the discount was 60%. And the management, we thought if nothing else, at least this particular aberration will get corrected. So it's up 7x from the lows. So just as a...
You missed it.
No, it may have been missed, but it is not being missed.
Okay.
All right. I think we had a long discussion on Tata Motors.
Not
Let's
short
move on
the
to-
stock.
Let's move on to the next Pataka on that note. Another bomb. HAL, defense stocks. How can we not
Alrighty.
talk about defense
All
stocks? HAL, any views here? Gentlemen, I leave the door, in fact, I leave the floor open to you if anybody wants to speak about this particular sector.
We own the stock, again disclaimer. We know that what has changed in the defense story in India over last 5 years, ever since new Prime Minister has come, and in the last 5 years specifically, and post-COVID even more specifically, right? And HAL is, if you look at in US and all, a lot of companies came, Lockheed Martin and all, became very big, supported by the government initiatives, G2G initiatives and all, right? I think first time we are beginning to see such kind of things happening in India. So I think government's vision is to export defense related equipment and defense related, and HAL is, a leading company in that space. Today also it's not very expensive. It had, at one point in time, it had actually, when we bought it, had like 5-6% dividend yield. So you have a, fast growing sector with a dividend yield and, where government is pushing. And today government is doing sales for them. G2G sales are happening, right? What else you can, expect in a sector which is witnessing a superior growth? So I think this stock probably for 10 years will continue to do well.
You know, one of the companies
I would just add here, this has broken the biggest myth in people's mind that you can't make money in public sector companies, right? Whether it is public sector banks or public sector companies, right? And this is the whole sector is up 10x. Forget individual companies, right? So that is a bigger point to be noted here, that at the end of the day, these are all cycles, right? If you look at for 15-year cycle, they would have actually lost money, or they would not have made as much money as a lot of private companies.
Right.
But if you look at the reverse point, from point to point, these companies have done exceptionally well, and which is why our philosophy, always be open-minded, always listen to what the market has to say, and always be open to react to what the reality is. The people who have made rules, they are only to be broken.
All right.
Yeah, but I think Kush wants to come in here.
I'll mention something, or I'll pick up on something, that Madhu just said, which is when this story whole started a couple of years back, everyone thought kitna badega. And now the fact that it's already run up so much, people are still asking, or kitna badega? So till the time there is disbelief in the market from here on, I think there is still room to grow. Even at the current levels, the stocks has gone into a bit of a consolidation mode, but that's again a good thing after the sharp run up. So I think the entire sector still has a lot of steam. HAL leader in the pack, I think again has a lot of room. So technical, fundamental, everything aligns.
We're doing a number, it's very interesting. The entire public sector market was in the low of COVID 3 years back, was 14 lakh crores. It went to 46 lakh crores, the whole sector.
Right.
It has been 3x for all public sector companies put together, and there are individual companies which has gone up even 20x within the public sector basket.
Right. No, fair enough. The only question I wanted to ask about HAL is also, we've spoken, Amit, about this, that the company is in the end growing only at 10%. So people say, okay, the addressable market is huge, this could continue, defense spending can continue, etc. But the top line continues to grow.
I'll give you an example.
You should look at the order book. Just look at the order book, where the order book was 3 years back.
on execution in the past, isn't it? I mean, the execution has always failed.
If you buy initially extremely cheap, then there's a very high probability. Like if you get anything for free, if you give me idea also for 0.50 paisa, I'll buy idea also. Like I won't buy, but I'm just giving an example. I'm just giving an example. Like
your idea talking about
you. So if you get low growth stocks, less than nominal GDP growth stocks, you need to make sure you're buying it extremely cheap. Like we also have some stocks which are growing at 10, 11, 12%, but we think that we bought it very, very, very cheap. But
okay,
yeah.
Fair enough.
Yeah. So, if I just come in from the larger theme, that what has happened on the fiscal side in India is that they have used the COVID period to really boost the sectors and to repair balance sheets, not just for the government, but also, a lot of companies. So receivable periods and all the past dues and, order book execution. So whether it was industrials or power or defense, a lot of it has flown through from there. And hence, then we need to see that what happens after the election next year. Till now, COVID gave them space to, improve fiscal materially and target spending in these sectors as well.
So it's a very good point. So so what do you see there? I mean, what do you see the next 2-3 years as? How important is election from that perspective?
I think with elections, we always say that it does not matter who's at the center, but the stability of policies which matter. And we have seen some very good decisions coming from the bureaucracy in India and from various parts of the parliament or parts of the segment. There's a lot of realization that government is not to lose money with every investment, and I think that has played out well till now.
Sure. In terms of spending itself, for example, headroom for spending in infrastructure, spending in defense, all of which lays the foundation, which has laid the foundation for the kind of growth that we've seen, because everything that we are seeing, whether it is HAL or, several other railway companies, all of it is government, triggered, right? how much headroom do you see for that kind of growth to continue?
So there is a fiscal consolidation path. You've been running deficits of 7%, then 6.5%, and this year the target was 5.9%. But there is still room for targeted spending. You know, with the revenues growth that we have seen in H1, and the government numbers were just there. You know, there's no denying that government would have. You know, a decent budget going into the, you know, of course the first one would be the vote of account, but you know, going to deficit numbers of even 4.5 target would leave, you know, this year the capex spend was 10 trillion.
Yeah.
It could probably be there. You know, given the growth in GDP, and then still the nominal capex could still be 10 trillion or more.
So we are not looking at any cutbacks in public expenditure in that sense.
The math does not suggest till now, but we'll have to look at the budget.
Sure. Do you see that as a risk factor, Lakshmi?
No, very unlikely, I said, because capex is like, you know, everyone saying Karan Arjun aayenge. And finally, when Karan Arjun are going to come, you know, you can't really nip in but the movie and say that ab ye climax ho gaya, khatam ho gaya. So I think that will be self-goal. There will be nothing short of self-goal from a, you know, policy perspective. And today, that's the biggest risk. Today, the risk is that about probably doing self-goals in policy, which I don't think willy-nilly anybody would like to do.
I can't agree more with her. If you look at, you know, we track the EPC sector very well, and we have large investment in some companies. And there's complete neglect even now in the market, but you look at the qualitative improvement in the balance sheets of a lot of these companies. They've become virtually zero debt, net debt free. And they now have order book of 30,000, 40,000, 50,000, 60,000 crores, which are never seen in the history ever.
Right.
Right, so at least for the next 3-4 years, there is a predictability of revenue, there is a predictability of profit, because there is obviously less competition, which is there as compared with what it used to be in 2008. So you can't generalize this thing saying that this whole segment is very expensive.
Right.
There are pockets which are still offering decent risk reward. Is what I would say.
Mahalakshmi, there has been, in some sense, you know, the sum and substance of it is, if you look at the balance sheets, is actually a Swachh balance sheet abhiyan. That's what has happened. So, you know, one can't disregard that totally, you know, finally.
No, and the most important thing, if you see, is corporate balance sheets, not that they are deleveraged, but the greatest consolidation in most of these spaces have happened. If you had 150 EPC companies 15 years ago, today you can't count 5. It's just
or 15.
I mean, when I say 5 is literally top 4-5 hai. 90% of the thing goes to the top 5. So really speaking, that consolidation and that strength of the balance sheet is reflected in the orders that are coming
and
through.
there are nuances in the details. There were 32 banks supporting these companies. Now there are only 12. Right? It's so difficult to even get a bank guarantee for a mid-sized EPC company. You know, to that extent, even competition has actually gone
can
down.
you pick up?
Yeah, I made my point.
Sure. So we are going to come to that pataka, but thank you so much, Mansi. You picked up that point and triggered that conversation. Thank you so much.
I think on that note, we'll take a look at the last pataka for the evening. Let's see which one am I bursting this time around. Okay, that's the 10,000 lari, it seems. Let's see which stock or which sector comes up for this one. Okay, PSU banks. We've discussed PSU great banks. But let me come to Rohit and talk about PSU banks. Which is the one that you like in this pack? You know, because, you know, of course, we've seen a great run. Even now, when private banks are not doing all that well, PSU banks continue their run. So which one would you prefer from the pack?
So actually, I'd like to wait a bit and let them consolidate. And the reason for that is we have seen something that we call as a volume climax on the buying side. You know, so if we look at the rally that happened in August, September, the volumes are very, very huge. And typically when we've seen that, it's taken a couple of months of consolidation before the highs get taken out again. So it's good to really wait. Let us get better prices, let it consolidate, and then we come back to the sector.
Madhu, raring to go on PSU banks.
Absolutely. So, if you remember, I came on television and made this comment कि इन्होंने पड़ोसियों को भी प्रोवाइड कर दिया है. अपनी बैलेंस शीट का तो कर दिया, पड़ोसियों का भी प्रोवाइड कर दिया है. And it has come down, it has come up. I'm so happy.
पड़ोसियों के लिए भी बढ़ गए हैं.
नहीं, ऐसा नहीं है महालक्ष्मी. See, again, technical, I'm not a technical expert. I don't look at charts and invest. I look at many other things. Let's talk about balance sheet and fundamentals. Let's talk about declared results.
Sure.
So Canara Bank has made 7,000 crore profit in the first half. And their guidance is they will do at least repeat of what they did in the first half. So their 15,000 crore profit, and still market cap is 75, 80,000 crores. In what way can you call 5p the stock is expensive? It's less than 1 time book value. It's just that अंगूर खट्टे जिन्होंने इन्वेस्ट नहीं किया ना, they have to find reason for consolation कि अभी थोड़ा कंसोलिडेट करेगा, बढ़ेगा नहीं, बहुत ज़्यादा बढ़ गया है, इसलिए थोड़ा रुकते हैं. ये रुकने का कोई खेल नहीं है यहाँ पे. ये एक क्वार्टर का रिजल्ट आएगा and you look at the extent of performance. A lot of these private sector banks have given virtually zero return in the time frame when some of these public sector banks have given 400, 500, 600% return.
Absolutely.
But again, I say this is true for a period of time. We have to buy them very, very cheap and you have to sell them cheap.
Sure.
And
Lakshmi, you want to comment?
Malakshmi's
please.
point I want to make.
Sure.
See,
Everybody jumping at PSU banks.
PSU banks had three, if you see historically, three problems: asset quality, governance, and technology. Right? Asset quality was at worst. Governance was at worst. They had no technology. They were losing market share to private. If you see in last 4 or 5 years, every aspect of that asset quality got provided. As Madhu was saying, they went to extreme extent. They provided a lot. Right? Then you had governance which got fixed, where there is no interference of the government in the operations of the banks, and they.
वो तो next cycle में पता चलेगा.
No, आपको believe करना नहीं.
आपको believe करना पड़ेगा.
अभी आपको पता चलेगा. 30 days, 60 days, 90 days का period देखो कितना NPL accrue हो रहा है. And you can't hide it for one day.
No, but correct me if I'm wrong.
You can't hide it for one day today.
NPA cycle, I mean, you have to go through the next capex cycle.
No, governance. People who believe governance got fixed.
I'm just questioning this point that you're making, that the governance issue is gone away.
Yes.
I mean, we'll have to wait.
It's gone away.
It's gone away.
Okay,
in fact, just to add
you do a dipstick check with 10 PSU chairmen. You are a journalist, respected one. You go and speak to them and ask them in last 5 years, how many calls did they get from Delhi to do a loan?
You will get the answer, yeah.
Informal, you'll get an answer.
And the last point, see, the governance is one. Thirdly, technology. See, earlier, private sector bank had a huge advantage of technology. Today, in last few years, each PSU bank has spent to their own 500 crore, 1,000 crore to get the technology
multiple
right.
Of that, Vikas.
Today, technology is no more innovation. It is plug and play, right? So they can deliver the same or maybe sometimes better service than a private sector bank. So in fact, that is what I'm trying to tell you. It is for you to believe or not. People who believe will make money like Madhu and me, and people who don't believe will, say angur khatte hain.
But there is one other
all
point.
these three things have transformed.
There's another point. If there is an X amount of money that goes into the financial services space, what the last 2 years has shown you is that money has moved out. Because if at the end of the day, the balance sheets in the business mix today is as much retail focused as most private sector banks. And there is no the project financing has reduced dramatically, provisions have happened. Then why should private sector banks be quoting 3 times book or 2.5 times book, and in some cases only 2 times book like HDFC Bank and not lower? And these quote still struggling to come up to 1 time book because the gains are difficult to digest. And so the idea here is we can talk consolidation, but in a macro sense, if nearly 42% of the index weightages are towards one space like this, redistribution of that allocation is happening even as we speak.
Correct.
And I think therefore the believers...
मैं आपको interesting number देता हूँ, which will put the whole argument to rest.
Right.
From year 2015, when the consolidation started to begin, the total provision being made by all banks is 17.5 lakh crores, out of which 14 lakh crores was being provided by PSU banks. So the entire operating profit which they made in this time frame was provided for, or slightly more was provided for. That accounts for roughly 25% of the overall balance sheet size.
Fair enough.
And people were still skeptical that at 0.3 time book value, they are not cheap enough. After all of these provisions have happened.
Right.
So when you look at the numbers in the context, it is staggeringly clear. And उसके बाद भी जिसने नहीं लिया है, उसको कुछ तो मन बहलाने के लिए बात करना पड़ेगा ना, क्यों नहीं लिया?
One of the chairmen recently told me.
I take that point. My only point is from here on. Are we confident that they will be able to grow?
आपको decide करने का 5p में महंगा है कि सस्ता है?
No, Madhu bhai, दूसरा पीर छोड़ो. One of the chairmen told me, हम लोग जब when the asset quality was bad, we used to do adjusted book value, right? What bank had book value, we would adjust downwards.
Correct.
One of the chairman told me,
Right back
मेरे पास 1 लाख करोड़ का gold mine है. which is outside the book value. He said, I have written off. वो gold mine से आप 30,000, 40,000 crore, तो आप जब adjusted book value you were doing downwards, why not upwards? So if you consider that, PSU banks are available at 0.5, 0.6 book. But currently market is not giving any value. Each PSU banks,
they are giving value.
or most PSU banks are now 17-18% ROE. Now, tell me how many private sector banks have that kind of ROE? So, and still trading at 2.5-3 times book.
And मैं 30 साल के एक्सपीरियंस से आपको बोलता हूँ महालक्ष्मी, कोई भी सेक्टर जब चलता है ना, it has to become expensive enough for it to peak out. In my career, I have not seen a very large theme play out, which will get busted out in between just suddenly.
Agree to that. Fantastic point. Lakshmi,
So,
you want to come in on
if
that?
the PSU banks were animated and they were actually in this room listening to this entire thing, what would they say? Have you seen the movie Pushpa? Any one of you?
Abhi fir you have heard the song, but I haven't really
Okay,
seen
so
the
you know,
movie.
in Pushpa, it's a Telugu movie. So Pushpa mein there is this dialogue which says, Pushpa naam sun ke ladki samjhi kya fire hai main. So these PSU banks would say, PSU banks नाम सुन के government don't समझे क्या पटाखा है
You
मैं.
need more preparation next time. Fantastic. Pataka. And next time you guys have to do some homework on this movies and music.
So that was, by the way, I didn't even know your stock list. I didn't even know your sector list. So this was.
You only need one.
So there is this movie, I don't even remember the song, which is not even, but for some of us like Lakshmi and I would probably know about it, which says खंबे जैसी खड़ी है पटाखे की लड़ी है आंखों में गुस्सा है होंठों पे गाली है देखो 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 मुझको समझती है क्या. So that is the PSU bank story.
Sure. Samir?
I have owned State Bank of India for a long time.
Well, on that note, it was clearly a dhamakedar segment with so many pataka stocks, and it's very difficult to get these gentlemen to talk about, stocks and sectors in such great detail. So it was a great, discussion, debate, what have you. But of course, it was kind of good of these guys to come around and talk about stocks, which they rarely do.
Well, we're not done yet. It's time for Antakshari, but with a twist.
And where's the party when there's no song and dance? And we're here to do exactly that. And I know that my guests here, we have some great singers, and this gives us an opportunity for all of our viewers and also us to see a new side to all of you. So we're really excited about this segment. So I'm going to open the floor to an Antakshari, but with a stock twist. So what happens here is I'm going to hand over this bowl, you're going to pick up a stock, and you're going to sing a song that best resembles a sentiment towards that stock. So that's a plain simple brief. We have two teams here, Surile Sensex as well as Nightingale Nifty, or what we want to call them, Nashile Nifty if we have to. But let's open the floor and let's start with
the thing, and Kela will sing, Madhu will sing. Geo Finance. Geo Finance.
Yes, Geo Finance. What does Surile Sensex have for Geo Finance?
कोई कहे कहता रहे कितना भी हमको दीवाना कोई कहे कहता रहे कितना भी हमको दीवाना हम लोगों की ठोकर में है ये जमाना जब साज है आवाज है फिर किस लिए हिचकिचाना हम लोगों की ठोकर में है ये जमाना.
Let's go next quickly. ITC.
What is the song? Huh?
No, you have to sing a song that resembles ITC. They have ITC.
What is this talk?
Okay, that's the song is, what is the song, Mansi?
मैं जिंदगी का साथ निभाता चला गया हर फिक्र को धुएं में उड़ाता चला गया.
Well, next up.
I do for the group. Zomato.
So this one is आजकल तेरे मेरे प्यार के चर्चे हैं ज़बान पर सबको मालूम है और सबको खबर हो गई. This is an official disclaimer, disclosure. आजकल तेरे मेरे प्यार के चर्चे हर ज़बान पर सबको मालूम है और सबको खबर हो गई. तो क्या
Okay, next up, Nashili Nefti. What do you have next?
Coal India. Coal India.
Okay.
Coal India.
Alrighty. Coal India says, हम काले हैं तो क्या हुआ दिल वाले हैं. हम काले हैं तो क्या हुआ दिल वाले हैं. हम तेरे 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 चाहने वाले हैं.
हम काले हैं तो क्या हुआ दिल वाले हैं.
Finally, let's do the last round here for both the teams.
Federal Reserve.
Okay, nice. This is, by the way, since nobody understands the Federal Reserve, this is even more important.
Perfect.
न तुम हमें जानो, न हम तुम्हें जाने, मगर लगता है कुछ ऐसा, ये इंटरेस्ट रेट साइकिल बंद हुआ. न तुम हमें जानो, न हम तुम्हें जाने, मगर लगता है कुछ ऐसा, ये तेजी का माहौल बन गया.
Perfect. Let's go to the last round here. What do we have?
HDFC Bank.
All right.
That's a tricky
Okay, and the
one.
song is Vikas. देखे जरा किसमें कितना है दम.
I think everyone can agree to
जम
this.
के रखना कदम मेरे साथिया.
One more line, yeah. Come on, they are beating you guys. Come on. One more line.
There's Sir's already singing. He's joining also. This is a bonus round. Sing, sorry. You could हाँ, go for it, sir.
अरे ये लोग
For HDFC Bank.
For HDFC Bank.
Lakshmi is accusing you of cheating.
तेरा वादा
For HDFC
वो
Bank.
कसम वो इरादा भूलेगा दिल जिस दिन तुम्हें वो दिन जिंदगी का आखिरी दिन होगा.
क्या हुआ?
By the way, whom are you complaining to? The management has already changed.
Well, we have one song for the indices. Take it away.
पल पल
Everybody should sing
दिल
together.
के पास तुम रहती हो, जीवन मीठी प्यास ये कहती हो, पल पल दिल के पास तुम रहती हो.
Thank you so much for joining on this Diwali party. It's been an amazing evening. Hope you all have a great Diwali and a great year ahead.
Happy Diwali!
Actually, if you look at this year, it started off in a rather tepid manner. The first month and a half was pretty tepid, but I could clearly see the momentum gathering pace, particularly in the last half of first quarter. And thereafter, the momentum only continued increasing. So I would say this year, while it started a little slow, it has picked up rather well. And quarter two, I must say, was a record quarter for us. All our businesses fired. And when you just look at quarter two, which concluded some time back, we ended with a all-time record profit after tax. On a YY basis, the profit after tax has gone up by about 41%. Sequential basis as well. So it's been, I would say, all-round good quarter for us.
have had a wonderful year in as Samvat, last Samvat to this Samvat. Particularly last 6 months and last quarter have been really good for us. When I look at my H1 to H1 number, like for current fiscal with the last fiscal, our revenues have increased by 22%. Our turnover has increased by 129%. So we are in a happy space. We've done well in this period. Coming back to the markets, I think markets have also done well in this period. You have to look at market from a very different lens. If you look at just the Nifty performance, you may get only 9.5 to 10% kind of a growth or an upside. But if you look at from the lens of the mid cap and small cap, you will see that customers have got good 30% to 34% return in the mid and small cap. In fact, PSU's bank stock index has given 34% return. The only, I think, the spoiler was oil and gas sector where we've got negative returns. So mid cap and small caps have given decent returns, more than decent returns to the investors who have stayed invested. Of course, we have our own bouts of volatility in this period, and the volatility is something we like as brokerage house. So that helps us to add value to our customers and play a significant role.